To some sort of kind of impact when it comes to tariffs and bring those prices down. Of course, banking very much in focus as well. UniCredit announcing record profit, really giving Andrea Orchel the backing he needs for those acquisitions. Spanish banks, on the other hand, Banco Sabadell, getting perhaps a little bit more support from the Spanish government versus BBVA Guy. But right now, all eyes on that presser in Geneva.
Absolutely. So the press conference is about to start. We don't know exactly when. It could be now, it could be in 2 or 3 minutes' time. So in the meantime, let's just talk about what we're seeing in terms of the risk-on move that we are getting here in Europe. We are anticipating that European stocks go up by, let's call it circa 1%, just maybe a little softer than that. We are going to see potentially, though, some quite significant divergence in some of the sector narrative that we are watching carefully, because you're going to see the pharma stocks clearly under significant pressure. We're up by around 0.6%, but some breaking news already on the trade story.
Absolutely. Redheads crossing the terminal from both sides. China to lower tariffs on U.S. goods to 10% from 125, but only for 90 days. That's the line out of China. Out of the United States, they're looking to cut tariffs on Chinese goods to 30% from 145% for 90 days. We are still waiting, again, for that press conference for the full details from this, from the Intercontinental over in Geneva. That's what we're waiting for when the commentary comes out of Scott Bessent, the U.S. Treasury Secretary, as well as U.S. Trade Representative Jameson Greer. At the same time, we're going to get the, I believe, Chinese, Foreign Ministry making some comments as well. But these are some massive numbers for 90 days.
So the figure was, we were worried that it would be 80%. That's what Trump pointed us to on Friday. We are way below that number. So in some ways, Scott Bessent, you could argue, has delivered a big win for Trump. Trump wanted this, he wanted a win. He needed progress. He told us to buy stocks on the back of it and told us that that was coming. So we are starting to see some of the commentary coming out. Scott Bessent, the press conference hasn't actually started yet, but just a few moments ago, officials handed out a sheet of paper which clearly had some of the details on it. Bessent says that neither the US or China want to decouple, which is quite significant. So that is a fairly positive story coming out of this. But the details appear to be that we are going to see a substantial reduction in the tariff level that we are seeing both out of China and out of the United States. You're getting a market reaction to it, as you can see. It is interesting to see that the dollar is moving down against the US dollar. But in terms of what we're seeing elsewhere, S&P futures spiking sharply higher on the back of this. And in terms of the European market open, we've now got the Euro Stoxx 50 up by 2%. The FTSE is something of a laggard. The CAC 40 is up by 1.3%. The DAX is climbing, now up 1.5%. The FTSE MIB is up by 1.8%. So some big gains coming through. There is an area that we are focusing on, which is the pharma stocks. But in terms of that's not the story right now. The story right now is this big risk-on move that we are seeing as we see a substantial reduction in the tariff level for a limited period of time.
Massive across the board. Scott Bessent, according to these remarks, saying neither the U.S. nor China want to decouple. In the meantime, we're also seeing comments coming from the Chinese Foreign Ministry, spokesman beginning their briefing. So we're still waiting for the U.S. in Geneva. We are getting, however, headlines coming out of China. They're releasing their white paper on national security as well, according to Xinhua. But I think that's a key point, because you mentioned the equity story, you mentioned the bond market story, you mentioned the currency story. Oil now at almost $66 a barrel for Brent crude, really highlighting the growth concerns that were coming out of this. It looks like China reiterating what Bessent has saying in terms of not wanting to decouple, saying they're committed to the stability of Sino-U.S. relations. Now, as we await that commentary, let's get a little bit more analysis, if we can here, from Elizabeth Engelson, the Assistant Professor of International History at the London School of Economics, but also an expert on those U.S.-China relations. Professor, talk to us a little bit about that immediate reaction there. These numbers for 90 days, not too shabby.
Not too shabby at all. I mean, there were real, I think a lot of people came into these negotiations with very low expectations. Trump had, over the weekend, set a set of expectations around 80%, but these are significantly lower than those expectations. So I do think that this is a really positive sign. But it's also important to keep in mind that 10%, 20% are still very high tariffs that in the rest of the world were what caused sort of the Liberation Day panic. So I think we're coming from a very low base, and that is the most significant shift, I think, that this is indicating real change in the US-China dynamic.
Is the 90 days significant? Like, should we worry about that? Is this... 90 days is a fairly decent period of time to get something at least sort of... to get progress on some key areas. Is that enough time? How should we think about those 90 days?
It's a fairly standard amount of time, actually. It's not, I don't think it's anything to be worried about, but I think what it indicates is a real willingness now to continue the negotiations, to continue to work towards a more sustainable way of trading between the United States and China. So this 90 days gives that buffer, but the fact that it's coming at the tariffs are much lower than expectations indicate real potential for progress.
Talk to me about the sustainability of those 90 days, because this 145% was supposed to be for 90 days. Now we've seen it peeled back. Is there a chance something like this ratchets back up?
There's a real chance of that. And I think this is something also to keep in mind, the fact that both the United States and China couldn't even agree to who it is that initiated the conversations or the need to meet in Geneva in the first place. There is real underlying tension between the two countries, even as we have today a real signal of a willingness to work together. And this really is a signal of that willingness.
Okay, Scott Bessent is speaking. Let's take a listen to what he has to say.
Government for facilitating this trade meeting here in Geneva. We had very productive talks, and I believe that the venue here on Lake Geneva added great equanimity to what was a very positive process. We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. We had very robust discussions. Both sides showed great respect. It was a chance for me to meet the Chinese delegation. The vice premier I had previously had only a video call with. Ambassador Jameson was familiar with two of the other leaders on the delegation from his previous time. So there was very good personal interaction. Both countries represented their national interests very well. We concluded that we have shared interest, and we both have an interest in balanced trade. The U.S. will continue moving towards that. I will let Ambassador Jameson talk about the President's initiatives that began on a historic announcement, trade announcement on January 20th, which no other president has ever done, following to April 2nd, when we implemented the reciprocal tariffs.
Thank you, Secretary, and I will echo your thanks to the Swiss government and Swiss officials for hosting us this weekend. The atmosphere was very conducive to discussions, and thanks to them, we were able to have very constructive and positive conversations with our Chinese counterparts, who clearly came to deal this week. the rapid nature that we were able to conduct and conclude these discussions is a testament to mutual understanding and mutual respect between the Chinese and U.S. sides. With respect to the U.S. Trade position, our interactions with China, and the agreement today, please keep in mind that the United States trade deficit has ballooned over the past several years, ending up at $1.2 trillion deficit in goods as of the end of last year, which was an approximately 42% increase over a few years prior, when there was an $850 billion trade deficit at the beginning of the Biden administration. So that is a rapid and expansive increase in the trade deficit. And our view is that this is driven in large part by non-reciprocal trade, among other things, and the result has been offshoring of manufacturing and other negative impacts on the U.S. economy. And so on January 20th, when the president was inaugurated, he released the America First trade policy, which was comprehensive and flagged that and actually directed agencies, including U.S. Trade Representative and others, to research this issue and to provide options, which we did, and the president elected to impose reciprocal tariffs on April 2 to address this national emergency of the trade deficit. There was a global baseline tariff accompanied by higher reciprocal tariffs for each country depending on the level and intensity of their trade surplus with the United States. In all of this, China was assigned a reciprocal tariff rate of 34%. China was the only country that chose to implement retaliation against the United States for this reciprocal tariff. All other countries, withheld and decided that they wanted to negotiate with the United States or simply not retaliate. And so we've been in detailed discussions with other countries for several weeks at this point. China, as you know, retaliated not only with tariffs but with disproportionate and asymmetrical non-tariff measures in order to maintain the effectiveness of the reciprocal tariff measures. The president increased our tariff rates to offset Chinese retaliation. And as you know, this escalated to a point where both sides had added 125% tariffs, and with the Chinese side, additional non-tariff measures, amounting to an embargo in some senses on trade, an effective embargo, which of course was not a sustainable practice for either side. And so today, with this agreement, we come to agreement that our reciprocal tariff rate will go down to 10% on the United States side, so it goes down 115%. We enter into a 90-day pause period for negotiations, which both the Chinese and the United States are very committed to, and the Chinese on their side also go down 115% to 10%, and they remove the countermeasures that they have in place. To be very clear, other measures that the United States has put in place in the past, whether it's tariff measures from 2018 or since, tariffs under other statutory authorities, tariffs related to fentanyl, those remain unchanged for now to the side. I'll just make one point, is that both the Chinese and the United States agreed to work constructively together on fentanyl, and there's a positive path forward there as well.
Okay, great. So let's start with some questions.
Well, just if I may make a few final remarks to give you framing and context. I think throughout the trade process, we have had a plan. We have a process in place, and now with the Chinese, after this weekend, we have a mechanism for continued talks. So, process, plan, and mechanism. I would say one of the big takeaways from this weekend, the United States will continue a strategic rebalancing in many areas that were exposed as supply chain weaknesses during COVID, whether it's medicines, whether it's semiconductors, steel, we've identified 5 or 6 strategic industries and supply chain vulnerabilities, and we will continue moving toward U.S. independence or reliable supplies from allies on those. But the consensus from both delegations this weekend is neither side wants a decoupling. And what had occurred with these very high tariffs, as Ambassador Greer said, was the equivalent of an embargo, and neither side wants that. We do want trade. We want more balanced trade, and I think that both sides are committed to achieving that. We would like to see China open to more U.S. goods. We expect that as the negotiations proceed, that there will also be a possibility of purchase agreements to pull what is our largest bilateral trade deficit into balance. That has gotten out of balance, and much of this has happened through neglect over the past 4 years, as the previous administration did not engage on this issue. That was put forward to us by the Chinese, in fact, and we can see it in what happened to the Phase 1 agreement. We are only looking forward, and we look forward to very good discussions now that we have the mechanism created in Geneva this weekend for talks.
Great. And with that, let's kick off questions. I'll start at the front row. Jenny, Leonard Bloomberg.
Thank you so much. Going into these talks, the president posted on Truth Social that he believes an 80% tariff on China seems right. It obviously went down substantially more. How did you end up going to 30%? Was that the president pushing you, or the Chinese not budging before you went down? And then secondly, you have a 90-day pause now, as you have with other countries. What specifically do you want to see in those 90 days? What kind of progress do you want to see in those 90 days and have agreed to by then to not ratchet up the tariffs? Because it is just a pause, right?
Yes, so
the tariffs then snap back, basically, if you don't have something agreed upon that is substantive. So
the Chinese April 2nd number was 34, continues to be 34%. I'll let Ambassador Greer answer the first question. And just like with all our other trading partners, as long as there is good faith effort, engagement, and constructive dialogue, then we will keep moving forward.
I would just say, Jenny, with respect to, the president's message and ultimate rates, I mean, everything is a negotiation, right? And the president, he gives the Secretary of the Treasury and I and other members of the cabinet direction and advice on how to proceed. And we ended up at a result that is very good for the United States, very good for China as well. We retain our 10% global baseline tariff, which we have on other countries. We have, in addition to that, previous measures that we've retained, which have been, frankly, effective in reducing the U.S. bilateral trade deficit with China over the past few years. So that leaves us in a very good position all in with respect to measures on Chinese imports, but more importantly, leaves us in a constructive path forward to have a positive conversation with the Chinese on how to rebalance and have more constructive trade.
Great. In the back, Associated Press.
Associated Press. Hi, I'm Jamie from Associated Press. We just heard our colleague talk about 30% tariffs. I'm just trying to understand these numbers here because they're all over the place. We were at 145 before, apparently, and 125, I believe, from the Chinese side. So can you say clearly now that, I think the question was, right now for the 90-day period, the U.S. tariffs on Chinese goods will be down to 30%? Is that correct for the 30? Could you speak?
So again, this agreement is really about the reciprocal tariff, which was imposed by the United States on April 2nd, and the escalatory steps which followed. Those on each side, the Chinese side and the U.S. side, ended up at 125% on each other. The Chinese had additional non-tariff countermeasures. That has all come down by 115% to 10% each. The United States earlier this year imposed 20% related to fentanyl. That still exists. So if you're looking at Trump Term 2, tariffs on China, right now effective, it's 30%. There are prior measures which change by product, by sector, by level, et cetera. You can't really give a specific number on that right now. What matters for the agreement today is that we each agreed to come down on the reciprocal tariff and related retaliation to 10%. So a reduction of 115% down to 10%. Fentanyl is on its own track, but on a very positive track where we're having very constructive conversations with our Chinese counterparts.
And I would add a couple of things. This does not include any sector-specific tariffs that have been put across all of our trading partners. And as the ambassador said, I think he would agree with me that the upside surprise for me from this weekend was the level of Chinese engagement on the fentanyl crisis in the United States. They brought the Deputy Minister for
Public Safety.
Public Safety, who is not traditionally part of the trade team or the negotiating team, and he had a very robust and highly detailed discussion with someone from the U.S. National Security Team.
Great. Next, John Huddy with Newsmax.
Mr. Secretary, will there be any immediate impact that U.S. consumers will see from this? And what was the toughest part of the talks? The Chinese are, notorious for being very difficult negotiators. Was there any moment that you felt the talks could break down? And as far as the fentanyl, I'm sorry, I know there's 3 questions here, but what are the Chinese willing to do in terms of the fentanyl crisis? Did they make any promises or any agreements to combat fentanyl?
Okay. Well, there's a lot to unpack there. So let me recap that. So you're asking U.S. consumers, the last one was fentanyl, and what was the second question?
The toughest part of the negotiation.
Well, I'll start there first. Both sides represented their national interest well, but we also concluded that we had shared interest and that neither side was interested in a decoupling. And again, a lot of back and forth on various differences in views on fair trade. We informed them, I had a discussion that trade deficits are a result of 3 things. 1, terms of trade, 2, currency, and then 3, the United States fiscal position. We informed them that Trump administration is working very hard on containing this out-of-control fiscal deficit that we inherited from the previous administration. 2, there was no discussion on currency. And 1, it was on terms of trade. And on fentanyl, again, for the first time, there was engagement between 2 teams with detailed knowledge. And I think for the first time, the Chinese understood the magnitude of what is happening in the U.S. In 2018 in Buenos Aires. They did a good job of banning the actual fentanyl. But what we have seen is substantial interaction between bad Chinese actors and many North American drug dealers, especially Mexican cartels. Treasury has designated several of the Mexican cartels as foreign terrorist organizations. We made that clear to the Chinese. They were very receptive. As you may or may not know, the Chinese have very draconian measures for the sale of illicit narcotics in China, and we have asked them to be equally as draconian with the people who are poisoning Americans.
And let me make a point. Your question about what was the toughest part of the negotiation. I would submit it was actually, in the lead up to the negotiation, trying to repair the channels of communication that had atrophied under the last administration, where, our office, for example, the Office of the United States Trade Representative, had almost no substantive discussions with the Chinese side on trade. And although we have significant differences with the Chinese on trade and economics, and we have major complaints, you have to discuss these complaints. You have to have a channel for discussions, and overcoming that was a substantial challenge. And a lot of work went into that over the past several weeks, so that by the time we got here, we were able to be very pragmatic with each other. And to be sure, there were tough things to deal with on, the level of removal, the timing for implementation, managing each side's, domestic politics, et cetera. And I won't go into too much detail. But I would say the toughest part was simply getting to a position where we could, in good faith, both sides work with each other. And once we did, we were able to do this in a couple of days. This is not the first time I've done trade negotiations with the Chinese, and sometimes it can take a very, very long time to overcome misunderstandings. We were able to do that effectively over the past few weeks, which enabled us to be very pragmatic and effective this weekend.
And I think we leave with a very good mechanism to avoid the unfortunate escalations as we saw after April 2nd from happening again. What had been very unusual about the relationship was that President Trump, Party Chairman Xi, they have a good relationship, but that the nature of what has happened since April 2nd could have been avoided if we had had this kind of mechanism in place, and I believe it is in place now. I think we leave today with a process that will move forward, and again, great mutual respect for our Chinese counterparts. I believe they showed us the same.
The impact on U.S. consumers? U.S. consumers see any resulting result out of this?
I mean, Mr. You're the Treasury Secretary, so you're better suited. But I would say on the front end, there's been a lot of talk about impact on consumers that just never really translate to the numbers. Consumption remained high, et cetera. And so I think what we're going to see is that we're going to have our economy continue taking off as we put structure around these negotiations and get global trade into a better place.
And as I reiterated last week, the Trump economic plan is three pieces: trade, tax, and deregulation. Trade has been implemented first, and that process is occurring. We believe that the tax portion is going very well. Speaker Johnson, Leader Thune, who I am in constant contact with, believe that midsummer that we will pass, as the president likes to call it, his one big beautiful bill, and we believe that that will provide substantial relief for American households. And then deregulation, a hidden and pernicious tax on American households, is regulation. We believe that the last administration added several $1,000s a year to American families' cost, and that we will be not only cutting those rolling that back, but cutting those substantially.
I think we have time for about maybe 2 or 3 more questions. The most, sorry, ma'am, name and outlet, please.
Yeah, it's June Phillips, BBC. It's very heartening what you're telling us. I'm wondering whether you think it might have been a better idea to start at this point of negotiation rather than start with the big list of tariffs and all the global turmoil that caused and the fear, frankly, in some countries around the world. How about, do you think with hindsight might have been better to reach out and say we want to talk to you guys about this?
I disagree entirely. We have spent decades at the World Trade Organization in multilateral and bilateral negotiations trying to get other countries to reduce their tariffs and non-tariff barriers to be more reciprocal with the U.S. We've had one of the most open economies for decades. The promise of the WTO and the multilateral system is that everyone was going to come down. It turns out the U.S. went down significantly. There were other economies that had low tariffs as well, but retained very high non-tariff barriers. We have tried really hard to work within the system, and the net result is a $1.2 trillion deficit in goods. The net result is manufacturing went to China, East Asia, Mexico, et cetera. So we tried all of that. So the idea that we can just keep saying, well, why don't we just talk a little bit more and we'll have a different outcome, I think just is totally detached from reality.
And I would add a couple of things, that as our 18 important trading partners come to us, many with very good deals, as the UK, who skipped to the front of the line as our oldest ally, as Ambassador Greer and I look at their proposals, again, to lower tariffs, to lower the non-tariff trade barriers. Obviously, UK does not have a currency manipulation problem. And the subsidies for labor and industry, we look at these, and I think, how did we get here? How did we get here? And I echo part of what President Trump said, that he doesn't blame the other economies for taking advantage of a taking advantage of the situation when they were allowed to do it. He blames previous U.S. leaders. So we are just trying to restore a healthy equilibrium. That the U.S. economy has become very unbalanced. On one side, we have a forward-leaning, the deepest and widest financial markets in the world. We have financial innovation. We have the tech sector that is the envy in the world. On the other side, we are a natural resources economy led by energy. So it is a barbell. But in between, precision manufacturing, especially precision manufacturing, has been wiped out. And it is our intent to bring that back. So we want to rebalance. And I think that there is a big opportunity. If I think about this weekend, the Chinese, they have gone the other way. They are unbalanced in terms of overproduction in the manufacturing sector. They have stated, but have not yet rebalanced toward a more consumption-oriented economy. And there is a chance, if we can open up trade to China, have more fair trade toward the U.S., that we could rebalance together. So I reject the notion that business as usual would have worked.
Great, and I think this will be our last question as we're just about out of time. Swiss outlet, Urs Geringer with Walsh.
Yes, I have a question in regard of the setting of these very successful talks as we hear. Switzerland has been in the center for international conferences for many decades. In recent times, we've been under tremendous pressure. The ambassador of Joe Biden to Switzerland called Switzerland the hole in the donut. My question is, how high does your administration value reliable Swiss neutrality for conferences or meetings as we just witnessed this weekend?
Well, I won't speak for the previous ambassador. My neighbor in Charleston, South Carolina, is the ambassador under President Trump, Ambassador Ed McMullen, who was highly respected here. He continues to engage with the Swiss American Foundation, and he has led this administration's effort to re-engage with Switzerland after the past 4 years. So we value the relationship. I believe Switzerland is now one of maybe the sixth largest investor in the U.S., which is incredible for an economy with 9 million people. We hope that Switzerland will bring some of its very robust trade training programs to the U.S. as we re-engage the manufacturing sector, because I believe the U.S. has a lot to learn from Switzerland. And again, the U.K. and Switzerland have moved to the front of the queue for the trade deals, whereas the EU has been much slower. So we value that also.
And I would say, with respect to the negotiating dynamics, and this may not seem important to those not involved in this, but the atmospherics provided by the Swiss government were incredibly conducive to the conclusions we had this weekend. They allowed us to use the grounds of the residence of the Swiss ambassador to the United Nations, which had a very intimate internal rooms, and importantly for us, where a lot of the key negotiations happened, were outside under a large, beautiful tree on a set of patio sofas, frankly, where we had the most important discussions on the most challenging issues. And having this setting, as opposed to, no offense to the Intercontinental, which has been great, as opposed to a sterile hotel conference situation or conference rooms, I think let us develop a personal relationship with our counterparts and lead to the successful conclusion we had.
Great. Thank you so much, everyone. I think that's it for us in time today. Thank you so much for coming out. And
Thank you.
We're concluding the press conference in Geneva at the Intercontinental Hotel in Geneva. The Treasury Secretary Scott Bessent, the USTR Jameson Greer, updating reporters on the result of the talks that we saw between the US and the Chinese officials over the weekend. The market reaction has been swift. We have seen European equity markets gapping higher. This news came across as we opened the market this morning here in Europe. As you can see, the stock 600 up reasonably sharply. There is a takeaway, a little kind of deduction you need to make from this, and that is what is happening in the pharmaceutical sector. We'll come back to that a little bit later. But at the moment, you have the German DAX up by 1.5%. Chinese equities also responded to this. The FTSE 100 is only up by around 0.5% at this point in time. So you're actually getting quite significant divergence here in Europe. US futures do look like this morning, as you can see, sharply to the upside. They were already up. We have added to that move this morning. This is a risk-on move that we are seeing. So while equities go up, we are seeing bond yields coming under pressure. The US 2-year is up by 8, nearly 9 basis points. The Swiss 2-year seems germane, up nearly 9 basis points. The safe haven sort of status of that market, obviously in focus. The front end of the German market is moving quite significantly. So you're getting a big kind of risk-on move into equities, out of the bond market, Chrissy.
Absolutely. Well, the positivity continues when it comes to the FX space as well. If we were concerned about more dollar weakness, that is not the story today. Take a look at euro dollar, for example, 111 there. We did hear Scott Bessent talking about how the EU is falling further back in the line, the UK and Switzerland moving forward. I think that's the go-to currency to look at in terms of those comments. But we have to go back to the Asian piece as well, because dollar yuan, the offshore yuan at 720, and the Chinese yuan actually appreciating against the dollar. And I think that's crucial there. Meanwhile, you are seeing the dollar appreciate against the Japanese yen as well. So 147 on dollar yen, 720 on dollar yuan. A lot to digest there. Let's talk about the commodity picture as well, because if you're concerned about growth, the first place it's going to show up is in that oil sector. We're looking at a 65 handle on Brent crude, continuing to rise higher by about 2.8%, and a VIX that briefly, emphasis on briefly, dropped below that key 20 level for the very first time since Liberation Day. So positivity across the board. I'll even throw a little bit of gold in there. Yeah. Down about just shy of 3%.
Yeah, it was down around 2% going into this. We've seen that move continuing. Let's carry on the conversation and provide you with some analysis as to what we have just heard. Elizabeth Ingleson is assistant professor at the Department of International History at the London School of Economics, a trade expert. Benedict Lowe, equity and derivative strategist for Europe at BNP Paribas Markets 360, joining us around the table as well. Professor, let me come back to you. Just give me your takeaway. What you just heard, what does it mean? Walk us through the significance of what has just happened.
Yeah, it's been really interesting. I think what we're seeing from Scott Bessent, first and foremost, is a real attempt to take the tension, to diffuse the situation, and to start to normalize the dynamic a little more. He spoke about process, he spoke about plan, he spoke about sort of having mechanisms in place. And that's real. That tells us something about the direction that he and certain members of the Trump administration want to take things into. But it's really important to keep in mind just how volatile things still are within the Trump administration. So it's significant, for example, that it was Scott Bessent calming things and really taking pushing things in a particular direction, and that someone like Peter Navarro, for example, another key trade advisor of Trump, wasn't involved in the talks in Switzerland and hasn't been involved in this dynamic. So we're seeing a real push on the part of Bessent to sort of diffuse tensions and normalize relations with China. But it's important to keep in mind that it's sort of papering over a much deeper, I think, set of tensions within the Trump administration that we will still see unfold in the next 90 days, if not sooner.
Well, the papering over is very much working for these markets. As Guy and I just laid out, risk sentiment is on and exacerbating what we already came into that presser with a lot of optimism built in over the weekend. Benedict, come on in here. How sustainable is this optimism that we're seeing? You just heard Elizabeth there talk about throwing a little bit of cold water on the sustainability of this deal. What about the sustainability of these gains?
Yes, I would start by saying this is, first of all, a material de-escalation. I think that was much better than what was expected by the market. And I think that it really matters from a conviction standpoint. The rally that we saw after the post-liberation day sell-off was a low conviction one. And what I mean by that, it was mainly driven by systematic strategies, such as vol target or CTAs. The more discretionary part of the investment were kind of stayed on the side, especially in the US. So that will bring a bit maybe more breadth, but also just on the fact that systematic strategy has still room to re-leverage on that. So on the back of a positioning angle, there's still more to go. There is a point where too much positive news is priced into the market, and maybe there's a moment where we want to take the reversal trade, but at the moment, over the next few days, I would expect a bullish environment to be in global equity markets.
Money's coming out of the United States. Does it go back into the United States as a result of this?
Yeah, so we've seen this kind of switch from there is no alternative to there is an alternative with Europe that's benefited from that at the start of the year. We estimate that over the past 10 years, there's over $2 trillion that was invested from European investors into US equities. And we think that now there's a growth alternative in Europe. There's a German fiscal stimulus package that is there. Some of that money could be reallocated into Europe. Even if you say 10%, 20%, we're talking about 200.
Does that limit US gains, therefore, on the market?
It limits potentially US gain, but also offer all alternative opportunities for Europe that can kind of take the lead in terms of performance.
Benedict, what's the red herring there in that situation? You talked about a bullish environment over the next few days. You talk about these kind of fund flows re-entering the United States. What for you is the red flag that spooks you?
I think the red flag is too much positive news getting priced in, so kind of equity market going back to their year-to-date highs in the US, and the pocket actually where we are a bit more cautious and where we like to hedge at the moment in the US is the Russell. They have low pricing power, they're more sensitive to higher rates, so this is kind of the area where we would say if you want to hedge, go into the Russell. Maybe not the 5E, maybe not the S&P after the good earnings we had on tech sectors, but the Russell is the pocket where if too much positive news priced in, this is where we want to hedge.
Is 30% still a big number? Like, 30% sounds really good right now. Like, it's a lot better than it was before, but is it still a too high a number for small, medium-sized businesses in America? You talk about the Russell. Like, is that where we sort of see the pain showing up first? I spent my weekend reading piece after piece about a small business owner here and a small business owner there that used to import a lot of stuff from China. 30% still sounds, I suspect, like quite a big number, and the US consumer's already retrenching a little bit.
I think it's still a very material number, but I would say we're coming from such high numbers that were so punitive on the economy that just this has to be in the short term a relief rally. If those numbers comes in and if we stay there and there's not a re-escalation, because that's always a risk that it's a 90-day pause, we don't know what will happen. There's going to be a volatile environment, that's for sure. But if we stay there has to be risk on at the moment in equity markets.
Okay.
Benedict, we have to leave the markets conversation there. We're going to dive into the policy in just a moment. But equity and derivative strategist for Europe at BNP Paribas, Marcus 360, joining us this morning. We thank you so much for the immediate reaction on some of this optimism. Let's stick with the conversation when it comes to the policy. Elizabeth Engelson still with us from the London School of Economics. I'll put the same question I just put to Benedict to you. What is the red herring here? What spooks you?
One of the things I think that's really important is to think about the long-term structural changes happening. So yes, this is a deal or an agreement that is coming from very, very low expectations, and that is something to really hold on to, right? This is indicating a willingness on both parts to negotiate and to try and sort of find a way forward. But I think the sort of bigger sort of concern for me is the long-term changes happening happening in the global economy. So in many ways, China has already, for a number of years now, been moving the structures of its economy and its trading dynamics further and further away from the United States and more as much as it can towards this policy of self-reliance. So we've seen a real decrease in China's trade with the proportion of its exports going to the United States. We're seeing even sort of in the last sort of few months with the tariff problems, China turning to its neighbours, to Vietnam and elsewhere as ways of skirting through the tariffs. So I think long term there is a structural shift happening within China to move as much as possible away from a reliance on trade with the United States. So I suppose the concern here is we hear Besant speak of, no one wants to decouple. That is reflecting in many ways a reality that decoupling is impossible, and it has been, and these tariffs have shown that. But what China has been doing over a much longer period, and what China is continuing to do, is to shift the way that it manufactures and shift the way that it trades and produces its own energy, in fact, in ways that create a less of a reliance on the United States.
How does Besant talks about rebalancing? He wants to rebalance.
Yeah.
Is it possible with the numbers we've got here? What is a result out of these negotiations that leads to a balancing of the US economy and the US trade deficit?
So this notion of a rebalancing and of changing the economy that way, it's really misunderstanding the way that trade operates today and the very fact of the trade deficit, right? This trade deficit has been decades in the making. It's a consequence of the way in which global manufacturing and global finance has operated really since the end of the Bretton Woods system in the 1970s. So this is the trade deficit is a product of a much longer term set of structures of the international economy that no kind of tinkering around the edges, even attempts on the part, there's less tinkering and more destructive, the Liberation Day tariffs, they're not going to be able to redress this much longer structural part of the US economy and the global economy for that matter.
I thought it was fascinating that in this press conference he talked about, or I should say that China has been increasing their partnerships with the likes of Brazil, with Mexico. He mentioned the fentanyl story, the cartels even came in. Here's what he didn't mention. He didn't mention the Treasury story. That's what the markets are freaking out about. As the U.S. Treasury Secretary, no comments on that. Yeah. He did, however, kind of create a little dig there when it came to currency manipulation, which to me, those are the two red flags there, the cartels and the currency manipulation, that you could very easily pin any sort of reversal of this optimism to. Do we need to be looking at Mexico next when it comes, or Brazil next, or some of these kind of other emerging markets in terms of the ripple effects of this?
I think I think this is really important, the cartel conversation, and part of what's important there is that is Besant speaking to a domestic US audience as well. He's very much sort of flagging and connecting the trade talks with China to a domestic situation and the fentanyl story there. In terms of what's happening in terms of the treasuries, the other thing I'll say before I get to sort of Mexico and your question there, it's really, I think, also important, you're absolutely spot on, the absence of talking about the treasuries is in many ways an absence of the sort of, for want of a better word, trump card that China has in wanting, it could escalate things if it had wanted to. And I think it's not in China's interest to sell off treasuries or to escalate things financially, but it's certainly a possibility. It's within China's interest narratively in terms of politics to present the United States as the one that's been creating the problems. But that is a sort of factor underlying a lot of these dynamics too.
Do you want to talk about Brazil? Should we talk about Brazil?
Yeah, talk to me about Brazil. Yeah. Because, and I say this because when we showed soybean pricing this time, it's kind of having deja vu from the first Trump trade war, because soy and corn are the two largest American exports. I think the number two is like Boeing aircrafts in terms of value. So walk me through that story in terms of China getting their soy and corn from other places.
Yeah, and this is really, really important because that is a significant sort of soft point, if you will, in sort of China's own reliance or the sort of the interdependence with the United States. And we've seen again that not just very similar in many ways to the ways that China has been shifting its manufacturing supply chain dynamics to sort of other parts of the Asia Pacific region. region, so too has it been shifting how it sources and gains its agricultural needs. And this has been a longer term shift. And we're seeing that real crunch point happen with US farmers. We saw it in the first trade war, the first US-China trade war, in the first administration. So many of the sort of hardest hit within the United States were the farmers, were the soybean farmers and elsewhere and others. And part of what we're seeing, I think, is China's capacity to shift over a longer term where it sources its agricultural needs. And that's part of, I think, why with the trade deal with the UK, for example, having agriculture within the conversation in the UK-US trade deal was so important, precisely because of what you're saying, Kriti.
If you're sitting in Brussels, what's your takeaway from what has just happened? What do you learn from this? How does it change the way you think about the way that you are going to be dealing with the United States?
I think what this is indicating, if you're in Brussels or even elsewhere, is that there is a real thread within the Trump administration that is seeking to de-escalate the chaos that has been marked the first few months of the Trump administration. There is a thread that's trying to create a set of norms and a set of ideas underpinning the actions that have been taken. I think it's very important, though, if I'm in Brussels or elsewhere, to keep in mind that this is very retroactive, right? Yeah. That the chaos has already been unleashed. And what Bessent is doing is cleaning up the mess. And it's a really important cleanup, and it's an indication that there is a willingness on the part of both the United States and China to negotiate. But it also, we need to keep in mind that it's coming from a place of having had the shop completely sort of uprooted. And that is a much more important, I think, longer-term thing to keep in mind, that there are members of the Trump administration, I mentioned Peter Navarro, but there are others who do take a very different approach to the way in which trade and the United States' place in the world should operate. And that isn't going away yet. It might, but it hasn't yet.
Not yet.
Not
Elizabeth,
yet.
Elizabeth, thank you very much indeed for joining us this morning and providing us with analysis. Perfect timing as we have watched that press conference and the news from it unfold this morning. Elizabeth Ingleson, Assistant Professor at the London School of Economics and author of Made in China, When US-China Interests Converge to Transform Global Trade. I want to leave you with some pictures that are coming out of London. Another press conference is taking place as well this morning. Actually, I'm not going to take a break. I'm not going to leave you. I'm just going to show you these pictures because Keir Starmer, the British Prime Minister, is currently addressing the issue of immigration in the UK. I bring these to you for a number of different reasons. Obviously, it is significant that the Labour Party is moving right on this issue and taking a harder line when it comes to immigration, but also the impact that it's going to have potentially on the labour market in the UK. Just keep an eye on this. This is a significant factor in terms of the labour market and how you think about the labour market is going to evolve here in the UK and potentially the tightness of it. Let's take a quick listen to what the Prime Minister is saying.
For many, many years. Thank you. I've got Jack from The Sun. Jack.
Thank you, Prime Minister. You said just now this is a comprehensive plan to bring down legal migration. You also said in the election you had a comprehensive plan to bring down illegal migration, and so far it seems that isn't working. Small boat crossings are going up on your watch. So why should voters think that your plan to bring down legal migration will fare any better, especially given you're considering an EU youth mobility scheme, which could actually increase it?
Well, let's tackle that head on, because nobody should be getting in a small boat to cross over the channel and illegally entering this country. The last government lost control of the borders. It falls to this government to clear up that mess in the same way we're clearing up all the other messes that they left behind. I am convinced that the way to do that is to take down the gangs that are running the vile trade. And for that reason, we've drafted and put before Parliament a borders bill, which follows through on the promises I made, which is we need to give law enforcement greater powers, going down the counter-terrorism powers. The thing that distinguishes counter-terrorism from other law enforcement is you can take action earlier. You can be preemptive. You can operate in a completely different way. That's why we've gone for a package that allows law enforcement to get in much earlier. That is going through Parliament. Who is voting against that? The Tories, who caused the problem in the first place. Thank you, Jack. Martin from the Daily Mail. Martin.
Prime Minister Martin Beckford from the Daily Mail. Gary asked if you've been on a journey on net migration. Similarly, you talked about tough enforcement. One of today's measures is for foreign nationals convicted of any offence to be considered
Okay, we'll leave Downing Street. You can continue to follow that, obviously, and we will continue to cover it here at Bloomberg, the press conference that is being delivered by Keir Starmer on the issue of immigration and the UK government's new plan. But let's return now to the issue of trade. And we were addressing just a moment ago with Elizabeth the issue of how the EU reacts to this. And I think that feels really relevant this morning. How is Brussels perceiving what has just happened?
Absolutely. A very telling line from Scott Besson that the UK and Switzerland have moved ahead in the line of trade deals, but the EU has fallen behind. Let's bring in Oliver Crook, who, of course, is monitoring how Brussels is bracing. Ollie, the view from Brussels, what did you make of that?
Yeah, so listen, Kriti, as I think for a number of us, but particularly everyone in Brussels, really the ears perked up when we heard Scott Besson basically saying that the UK had shot to the front of the line. So too had Switzerland, that the EU has been falling behind. We know that the sort of EU trading relationship with the United States is the most important for the European Union, really one of the biggest trade relationships on the planet, $1 trillion every year. And the question is, have they made any substantive progress? And it sounds like they really haven't. We were expecting to get some of the proposals from the EU in front of the U.S. administration to begin to have a sort of concrete conversation in terms of where there could be compromises, where they can make those sort of advances. It does not sound like that is happening right now. When we listened to what we heard from the Treasury Secretary there, Scott Besson, really talking about Switzerland, how much of a better job they have done. And I remember just a couple of weeks ago when we were in Warsaw at the finance ministers meeting, the Swiss president is also the Swiss finance minister. And when I spoke to her, saying that she had really been on that call with Donald Trump and trying to impress the importance of the Swiss economy and how valuable Switzerland is to the U.S. economy. And you actually heard Scott Besson talk about that, a nation of 9 million people, talking about the hundreds of billions of dollars that Switzerland invests in the U.S. economy, especially on pharmaceuticals, especially on advanced manufacturing. So those are the sorts of appeals that seem to be cutting through to the Trump administration. But as for the trillion-dollar trading relationship of the EU seeming to fall down the priority list is something that obviously is going to be very closely watched by the finance ministers here convening in Brussels. All the EU finance ministers will be meeting today and tomorrow, and we'll be speaking to one of those finance ministers in about 45 minutes' time, the Greek finance minister, and get sort of his appraisal of basically what we got from the U.S. administration, what they can read into it from the European side, and what critically non-tariff barriers are the Europeans willing to bring to the table, because I think that that is still the very sort of great unknown in these trade negotiations between the U.S. and the European Union.
Ollie, great stuff. Thank you very much indeed. Ollie Crook updating us from Brussels on how the EU is reacting to the news out of Geneva this morning. I want to say we're going to hear from the President at 9 a.m. Eastern this morning. We're anticipating that he is going to sign an executive order relating to the pharma sector. Healthcare stocks are down really sharply in Europe. But the big story for the President is going to be his trip this week to the Middle East. And ABC News is reporting that he could receive a luxury jet from Qatar to replace Air Force One. But I suspect that we are going to be paying attention to what he has to say in terms of policy as well. Let's bring in what we should expect, Jumana Basechi from the Middle East. Jumana, lay out what the big kind of roadmaps, parts of this trip that we're going to need to focus on are going to be.
Yeah, well, Guy, you know better than anyone the value of those Boeing jets, and we're talking about something in the ballpark of about $500 million, and it raises a lot of legal and ethical questions because technically the U.S. president is not allowed to receive a gift from a foreign government without congressional approval. So you can imagine it's caused a lot of uproar back home, even though the Qatari side say that this is still in discussion phase, nothing has been agreed. But it certainly sort of lays the foundation of what is to be expected out of President Trump's visit to the GCC this week. And that is essentially, it's going to be about deal making, perhaps less about peacemaking. There's going to be a Saudi-U.S. investment business summit taking place tomorrow. Some of the biggest CEOs from around the world are flying in. Larry Fink from BlackRock, Jane Fraser from Citi. Lots of discussions about energy, artificial intelligence, potential partnerships on critical minerals. And you may have noticed that last week that several changes have been made to facilitate trade into the U.S. as well. So all of that on the agenda for this week.
Jumana, we're looking forward to the coverage throughout the week out of the Middle East. Jumana Basechi joining us, as you can see, from Riyadh. That is it for the opening trade. It has been something of a busy morning, but the coverage continues right here on Bloomberg. Francine Lacroix and The Pulse up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Global stocks surge as the U.S. and China announce a cooling off of the trade war following a weekend of talks in Switzerland. Now, Chinese tariffs on U.S. goods are cut to 10%, while U.S. levies on China will be 30%, but only for 90 days. Plus, pharma stocks in Europe tumble after President Trump announced plans to dramatically cut the cost of prescription drugs in the U.S. So let's take a look at what markets are doing. As we were just saying, they're kind of on a tear at the moment. Investors definitely rushing back into stocks, powering a 3% surge in S&P futures, but also a lot of, a bit of a rally here in Europe. Now, China and the U.S. agreeing to cut tariffs and de-escalating the trade war. The breakthrough, of course, in these talks delivers a short relief to investors, causing risk assets to rally, treasuries and gold to tumble. So you can see gold 3,227 and yen 147.88. The European markets map, so there has been also a read across to Europe. Let's get that up. And the CAC 40, you can see, powering ahead 0.8% higher. The DAX almost 1% higher. The other thing we need to watch out for is pharmaceutical stocks on the down, reacting to Donald Trump's plans to cut drug prices. And this is one of our worst performing sectors. For example, Eli Lilly down 3.3% pre-market, and it's also having a read across here in Europe. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. and China will temporarily lower tariffs on each other's products in a move to cool trade tensions and give the world's two largest economies 3 more months to resolve their differences. Now, the combined 145% U.S. levies on most Chinese imports will be reduced to 30%, while the 125% Chinese duties on U.S. goods will drop to 10%. It follows talks between the two countries in Switzerland over the weekend. Now, the U.S. Treasury Secretary Scott Bessent said the tariffs applied on China during the first Trump administration remain in place.
Neither side wants a decoupling. And what had occurred with these very high tariffs, as Ambassador Greer said, was the equivalent of an embargo, and neither side wants that. We do want trade. We want more balanced trade.
Well, let's bring in Brendan Murray, who's Bloomberg's global trade czar. As our global trade czar, you've been extremely busy, especially in the last hour. I mean, there seems to be concessions, but this is like a moratorium. It's a 90-day window in which to negotiate. So it feels like a big deal, but will it last?
Yeah, it's definitely a surprise, especially in the amount that the U.S. gave up. The U.S. had all this leverage on China, as you said, 145% tariffs. They basically take the 145 down to what every other country has, a 10% baseline, and the 20% fentanyl tariffs. And so if you're China, you're looking at this and going, we didn't give up much to get a lot from the U.S. So we were already hearing our contacts say that this represents basically a retreat from Washington's perspective, particularly when we heard Donald Trump say just a few days ago that 80% would be a reasonable rate. Here, the U.S. is coming back with 30%, less than half of that. So obviously, markets are liking that, and they're certainly liking it in China.
So what does it mean for U.S.-China relations? And again, do we know why the U.S. gave so much? Do they need a deal at all costs? Do they need China for something else?
Well, I think we're still sorting through a lot of those details, and not only what was in this deal, but what wasn't in it. What's happening with critical minerals that China has restricted the exports of? Are there non-tariff barriers that China tentatively agreed to lower that will be worked out over the next 90 days. 90 days is a very quick span of time to negotiate trades disagreements, and so it's going to be interesting to see how this plays out and how much the U.S. can actually accomplish, particularly now that they've given away all this leverage that they have.
Yeah, so interesting. Brendan, thank you so much. Brendan Murray there. I know we'll go to Brendan as often as we do now to try and understand what the next step in this trade is. Now, we're also joined by the BlackRock Global Chief Investment Strategist, Wei-Li Wei. Such a great day to speak to you. As always, to be fair, it's always a Wei-Li kind of day. But to understand trade, I mean, you understand dynamics like few people do in the markets. Is this a long-lasting kind of agreement, a good basis, or could it turn around very quickly?
Today we definitely had good news, better than expected versus expectations heading into the weekend. There is now a mechanism for engagement, and also typically after meeting statements tend to differ, US-China, but this time they are both consistently positive. But of course, there is still a huge amount of uncertainty. 30% is still quite restrictive by historical standards, but today taught us two things. I would say confirm two things for us. Number one, there are lots of uncertainties during negotiations, but there are also immutable laws that can govern the destination of these negotiations. The two immutable laws that we have identified helping us try to gauge the landing zone is, number one, the debt dynamics in the U.S. 25% of the U.S. debt is owned by foreign investors, and there is a debt sustainability concern that one has to consider as one engages in negotiations on trade. And the second immutable law is around supply chain. Supply chains built over decades cannot be ripped out just overnight, and the level of tariffs between U.S.-China were at a level that is essentially trade embargo. And then at this point, we're not talking about higher prices anymore. We're talking about critical access being cut off, no longer having essential goods on the shelf. And these are important considerations that can help land the negotiation. And the last thing I would say that today has confirmed for us is that elevated uncertainty does not mean certainty of a bad outcome. It just means a wide range of outcomes. So this is why we have been positive through this period of uncertainty, because we believe immutable laws can govern the landing spot.
I mean, I guess, Wei, that the markets are greeting this as progress. If you look back to 2018, there was a bit of a wobble. There was progress between the U.S. and China, and then there was, the U.S. soon backed away from that deal. So what's the best way to position yourself in markets right now?
I think it's important to focus on fundamentals during this period of policy uncertainty. If we look at earnings so far, that has the earnings season day is just wrapping up. We're still having U.S. corporates surprising to the upside versus expectation at the beginning of the quarter by about positive delta of 2%. We're still seeing companies committing their AI capex. You look at hyperscalers capex commitment, that has not decreased, it has actually increased. But of course, companies are citing greater uncertainty. Companies are pulling their guidance. Companies are giving out for the first time scenario-based guidance. So the longer this uncertainty lasts, the greater the risk of this sticking and dragging down overall outlook. But for now, fundamentals are still okay. U.S. data, hard data, is stronger than sentiment, soft data. So fundamentals still support a somewhat positive view on equities, which is what we have. And the last thing I would say, you talked about 2018 as a parallel. The difference between Trump second term and the first term is that in the first term we had the tax cuts before the tariffs announcement, but this time around we had the tariffs, the bet for market bits of the policies being announced first, and then the good bits for markets, good bits of the policy that can be good for markets could be around the corner. We're seeing reconciliation being debated in Senate and House. We're seeing talks of deregulation. So I think these parts of Trump policies could support sentiment later down the line, which again is why we have been positive despite a huge amount of policy uncertainty plaguing sentiment.
On trade, are you expecting actually the U.S. to, I don't know whether it's a turnaround again, it seems that the U.S. gave in quite a lot to China. So do you expect a new U.S. that tries to, temper some of what they want in these trade wars because they just realize that they need the economy and they need investors on their side? Or is that wishful thinking?
I think trade policies are expected to deliver two things. First is to try to bring down trade deficit, as we saw with the announcement of the April 2nd, and the goal there was clearly to try to close trade deficit across the board. And the second goal of trade policy and tariffs is to collect tax revenue, because the U.S. needs that additional tax revenue to fund the tax cut, to fund additional spending. So it's designed to achieve both, which is why a landing zone somewhere between 10-20% is perhaps realistic versus just going all the way back to before trade negotiations and tariffs talks started. So markets are reacting as though we're going back to all the way to the beginning of this trade route, trade-driven volatility. I think somewhere in between is perhaps a reasonable landing spot because of the multiple objectives trade policies are expected to solve for, one being revenue collection.
The other thing is that, last week, at the end of last week, we had a couple of Fed presidents really putting more of the focus on inflation rather than labor dynamics. Are you expecting the Fed maybe to wait to cut rates a little bit more than what the market's pricing in?
I think that's fair. We're expecting 1-2 cuts for this year. Markets are expecting Fed cuts to kind of resume or start being talked about in the second half of this year. That feels right. And depending on the inflationary dynamics, we could see that being pushed out even further. What we have seen so far is that markets are expecting the Fed to respond more to potentially deteriorating labor market dynamics or deteriorating growth dynamics, but both Fed speakers as well as we believe that inflation is still a number one consideration, especially in the context of structural forces pushing up inflation over the structural horizon, one being aging population, one being geopolitical fragmentation. So because of all these structural forces and trade considerations further further adding to that stagflationary concern, we believe inflationary dynamics is something that the Fed will have to prioritize. We're not going back to an environment where the Fed can readily come to the rescue of a weakening economy. We're talking about high for longer for U.S. rates from here on.
Wei, thank you so much, as always, for joining us. Wei Li there, BlackRock's Global Chief Investment Strategist. Now, coming up, we'll be joined by the EBRD President, Odile Renaud-Basso, as the bank also expands operations into sub-Saharan Africa. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Welcome back, everyone. The conversations that matter and the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, stocks in India and Pakistan are rallying after U.S. President Donald Trump announced a ceasefire on Saturday following 4 days of clashes. But Bloomberg has been told that the announcement took Indian officials by surprise. Now, let's bring in Roz Matheson, our EMEA news director, for a roundup of the main stories today. Roz, I mean, tell us why some people in India are angry, including officials, and rejecting U.S. offers to mediate between the two countries.
Well, obviously, the issue of Kashmir is a very long-running one, and India is always seen as a bilateral issue that it wants to negotiate directly with Pakistan on. And it says those conversations were happening, and then, in a way, Donald Trump sort of stole Narendra Modi's thunder by just announcing on social media there was a ceasefire. And in a way, in doing so, according to India, put Pakistan and India on the same footing when it comes to the Kashmir issue. And that's something that India is very sensitive about. And so the optics of it didn't land very well in Delhi as a result. The idea that, the attack that preempted this bout of military tension and the military actions that followed was somehow equal for a start, and that Pakistan and India are equal players on the global stage in discussing it. And so all the way that came out obviously hit a nerve in Delhi, and we can see that in the reaction that we were hearing about. I mean, markets are cheering the fact there's a ceasefire. This ceasefire does seem to be holding, but in Pakistan there were almost scenes of jubilation off the back of this, again, because it looked like Pakistan had gotten something out of it. And so optically for India, it's all a bit awkward.
Turning to Ukraine's ceasefire negotiations, now the president of Ukraine is challenging Vladimir Putin to engage in talks this week. Will he?
Well, that's the interesting thing. I mean, Zelensky says he's going to go to Turkey and sit there and wait and see who turns up. And we're expecting someone will come from Russia potentially. Is it going to be Vladimir Putin? That would be really surprising, because Putin first wants to sit down, no doubt, with Donald Trump and then maybe talk with Zelensky face to face. So the question is, who would show from the Russia end? And is that someone who's senior enough to keep all these balls in the air with Donald Trump, who's showing some frustration here? He's like, guys, I want you guys to meet. I want a deal done. What's taking so long? And so Putin has to manage, the US side of this as well. He's obviously trying to stretch things out to avoid the resumption of sanctions. Europe is saying, if you don't get ceasefire straight away, we'll put sanctions on you. That can probably go to one side until we see what happens on Thursday. And do we get those direct talks between Ukraine and Russia? Who's involved aside from Zelensky, and what is the pathway from there?
Ross, more broadly, I don't know whether there's a shift actually. The U.S. administration was pretty generous with China today on the trade deal. There's also, he's getting under scrutiny because of a plane, because, that's $500 million worth of plane that Qatar gave him. Like, what's being said inside?
Well, it's interesting to see. There's a lot going on here, right? Donald Trump's about to head to the Middle East. There are reports, that he maybe will get gifted a jumbo jet, a luxury jet from the Qataris. He could use as Air Force One for a certain period. That would be the most luxurious donation ever to a U.S. administration. So there's a lot of complexities around his time in the Middle East. Meantime, we do have some progress on U.S. and China. It's a pretty good deal for China too, in terms of getting these tariffs down for 90 days. If you look under the hood, there's a lot that's still undone. This is reciprocal tariffs, not sectoral tariffs. Where does it leave rare earths? No discussion around currency. This is a complex, big relationship. But the fact that they got something they could announce today together is interesting, and certainly that set things on a pathway, perhaps, to some of those more complex issues going forward. The question is, with all these things in the air, you've got Donald Trump wanting to sort out China, Ukraine, the Middle East, big trip again this week, trying to get investment coming in from the Saudis and others. And he's got trade tensions still with Europe and trade deals to do with Asia. It's an administration that's trying to do a lot very, very quickly, and in rushing policy potentially at times in order just to say you've achieved something. The devil in the detail perhaps raises some questions.
Yeah, you don't know where it ends up. Ross, thank you so much, as always. Rosalind Matheson there, Bloomberg's EMEA News Director. Now, continuing support for Ukraine will be high on the agenda at the European Bank for Reconstruction and Development's annual meeting in London this week. Now, the EBRD has already deployed 7 billion euros in Ukraine since the start of Russia's invasion 3 years ago. The bank is also extending operations into sub-Saharan Africa for the first time. Well, I'm delighted to be joined by Odile Renaud-Basso, the president of the EBRD. Thank you so much for joining us, as always.
Thank you, Francine.
Congratulations also on expanding some of your operations in sub-Saharan Africa. This is a region with substantial infrastructure gaps, pressing need for expanding access to clean energy. So what sectors will you focus on at the start?
Exactly what you mentioned. I think that investing in clean energy, investing in key infrastructure, focusing on what is needed to develop the private sector, which is at the core of the mandate of the bank. So we will probably start working with financial institutional trade finance to facilitate trade, export, import, but also finance small and medium-sized businesses, green energy, renewable. There is a lot of potential, so we will start with projects like that. But in all these areas, trying really to develop the private sector, also to create jobs, because Africa is our countries with very high demographic growth, and they need a job to be created also to grow and to be sustainable.
Because of course your choices will then translate into some opportunities for international investors. So have you received positive feedback from them?
Yes, exactly. There is a lot of interest also from business from countries in which we work. For example, we have a big partner in renewable in Egypt, which is willing to invest with us in sub-Saharan Africa, or banks from Morocco. They are very active in a number of sub-Saharan African countries. They are going to be our first partner in expanding in these new countries. And a lot of, European business, international business willing also to invest in the region.
How much capital are you expecting to unlock? I think, you've been clear to invest in 6 countries and up to 6 countries through 2030.
Yes, exactly. So we will start by a few hundred million, and we expect to go to billion of investment. Nigeria is likely to be, it's the biggest countries in which, we will start to invest, and I think that there will be a lot of opportunities. So it will be above 1 billion in the course of the years to come.
Odile, one of the things that we've been also trying to figure out, of course, this is a continent that has huge opportunities. That's also really courted by China's Belt and Road initiatives. We know that also Gulf state investments want to go into Africa. So do you feel like you need to, is it a tougher crowd because you have so many people in, or is it good, is competition good for investments?
Competition is always good for investment, and the needs are very, very important. And I think the focus on the private sector, rather than only public sector, big infrastructure, is where we will make a difference. And we will also bring together with our financing the capacity to advise government on reforms, what is needed to unlock private investors.
But will you compete with some of these projects, or can you also align with some of the
we
strategy
work.
of others?
We work with other MDBs. We work with African Development Bank, for example. We also work with AIB, which is investing a bit in sub-Saharan Africa, and we will work with IFC. So a lot of partnership also with our other MDBs.
Odile, leaving the politics to one side, trade and tariffs make it more difficult if you're in the middle of a war, like trade war, to understand exactly the cost of capital, where to deploy capital, and all of the like. Does it mean that, some of you finding the projects will be delayed because of U.S.-China and U.S.-Europe?
It may happen. The level of uncertainty is extremely high, I think, at the historical level, and that's not good for investment because, as you were saying, investors wait to see where to deploy their capital and so forth. It could also, all this reorganization of supply chain and so forth could create some opportunities for countries in which we invest because, they could benefit from proximity with Europe and so forth. So that's also an area for opportunities. And what I believe is that with such high level of uncertainty, the role of multilateral development bank is even more important. We play a counter-cyclical role, and I think the likelihood that we will be even more needed is quite high.
Talk to me a little bit about Ukraine. I know the EBRD has been heavily invested in the country. What needs still? There's a lot because we don't know whether there's ceasefire. So this week will be crucial. The next couple of months will be crucial. But what have you seen in terms of project, in terms of infrastructure, in terms of how much money is needed in Ukraine?
So we see a huge need for continued support. We are continuing to focus on the real economy. We have already invested more than 840 million euros this year, 20 projects with the private sector, a lot of financing, more than 260 million for Naftogaz, so to create some storage capacity in terms of gas and be ready for what comes next. So still a lot of need for support, but we see the resilience is still there. The capacity of private sector to continue to invest and to develop their activities in Ukraine is still there, and that's why they need support.
Is energy, without a doubt, the most, the biggest opportunity in Ukraine?
So out of the more than 7 billion we invested in the last 3 years, 2.4 billion in energy, and in energy storage, to build storage, as I was saying, build storage capacity by gas, but also development of renewable. And it's interesting to see investors from Germany, from outside Ukraine, starting to invest in renewable in Ukraine. So it's a very positive signal of trust also.
If you have a ceasefire, but it's a ceasefire that could be short-lived, does that make a difference in terms of investment in the country, or do you just have to...
It could facilitate, but to have real appetite from foreign investors to invest a substantial amount in Ukraine, a full-fledged peace and sustainable, credible peace would be, would be better. But a ceasefire would already be a positive development. I think that helping, giving some sign of confidence that things will improve over time.
Odile, thank you so much, as always, for joining us. Odile Renaud-Basso, the president of the EBRD. Now, let's also look at markets, because there's quite a lot going on in the markets. We saw that U.S.-China trade deal, or trade agreement to lower tariffs in the 90-day cool-off period, and that's really sent a lot of the markets up. S&P futures gaining some 2.4%, NASDAQ futures gaining also 3%. Now, again, a tariff reduction is really a move to cool trade tensions and give the two countries 3 more months to resolve their differences, with talks potentially leading to purchasing agreements by China. Coming up, pharma stocks tumble after President Trump announces plans to cut the cost of prescription drugs in the U.S. We'll have the details next, and this is Bloomberg.
what is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London, and these are your top stories. Now, global stocks surge as the U.S. and China announce a cooling of the trade war following a weekend of talks in Switzerland. Chinese tariffs on U.S. goods are cut to 10%, while U.S. levies on China will be 30%, but only for 90 days.
We both have an interest in balanced trade. The U.S. will continue moving towards that.
Plus, pharma stocks tumble after President Trump announces plans to dramatically cut the cost of prescription drugs in the U.S. Now to the Middle East, where President Trump is spending the week touring the region. ABC News reports that he could receive a luxury jet from Qatar to replace the aging Air Force One during the visit. Now let's bring in Jumana Bersace, a Bloomberg Horizons Middle East and Africa anchor in Riyadh. Jumana, thank you for joining us. Tell us a little bit more about the gift. It's a very lavish gift. It's an expensive gift.
Yeah, most definitely. But also beyond that, Francine, it raises a lot of legal and ethical questions. Just to remind viewers that the U.S. president is not technically allowed to accept a gift from a foreign government without congressional approval. So when this news story broke yesterday by ABC, it certainly raised a lot of eyebrows and lots of questions about conflict of interest. Now, President Trump did indeed confirm that those discussions are taking place vis-a-vis the transfer of ownership of that Boeing jet. But then a Qatar media attaché to the U.S. did confirm also that the discussions are taking place, but that no decision has been made yet. So still something that is in discussion mode. But again, raises a lot of questions ethically, legally, and then also around conflict of interest, because even though President Trump has stepped away from the day-to-day running of the Trump organization that is being run by his sons, Donald Trump Jr. and Eric Trump, a lot of deals have been signed in the run-up to his trip to the GCC. You had Eric Trump in Dubai a few weeks ago announcing the inauguration of a new Trump Tower. You have his son-in-law, Jared Kushner, who has opened up a fund that has received funding from the Saudi Sovereign Wealth Fund. You have live golf tournaments being played at multiple Trump resorts. So definitely there is this backdrop of a conflict of interest question, even though the White House say that President Trump is no longer involved in the running of the business of the Trump organization. But that is the setup going into this week, and I think tells you a lot about perhaps what President Trump is looking to achieve. This is less about peacemaking this time around, but more about deal making and what potential investments the U.S. can get from some of these GCC nations and what deals can be signed. And some of the sectors that they've been talking about is in the defense space. There's been reports of a $100 billion defense deal to be signed between US and Saudi Arabia, critical minerals, AI, with UAE and Saudi Arabia pushing for watering down of some of those rules, the diffusion rules that the Biden administration took into effect. And of note is that tomorrow, which is the day that President Trump actually lands in Riyadh, there is going to be a U.S. business investment forum with some of the biggest CEOs from around the world flying in, including the likes of Larry Fink from BlackRock and the CEO of Citi, Jane Fraser.
Yeah, a lot to unpack there from the plane to everything else that Donald Trump is doing this week. Now, we also, as we expected, given the oil price drops, Saudi Aramco reported a decline in Q1. What can you tell us?
Yeah, and that's a really important data point, Francine, because it also just sheds light on the economic backdrop of Saudi Arabia this time around. It was obviously the place where he visited first in his first term in 2017. This is 8 years later, and Saudi Arabia's finances have actually evolved. You look at the numbers that came through from Aramco yesterday showing a decline in net profits and in net income around 5%, still better than some of the other energy majors out there, but also they've cut down the dividend. And why is that relevant? Because it is actually still an important source of revenue for the Saudi government. The Saudi government's NPIF still own 97% of Aramco, and so the fact that this dividend has been trimmed suggests that they will have to find other sources of revenue to fund some of those mega spending plans. Already, the IMF forecast that Saudi Arabia are going to enter into a current account deficit. They have a budget deficit, which means that the scope for them to come out with these lavish spending plans abroad or quote unquote to live up to their image of being big spenders is becoming smaller. There's going to be more focus on Saudi Arabia to channel investments internally. And this is why those numbers, the Aramco numbers, the oil backdrop, all plays into some of the discussions that are going to be taking place this week, because it's not only going to be about GCC and Saudi Arabia investing abroad, but also them trying to get U.S. money invested into Saudi Arabia as well.
Jumana, thank you so much. Jumana Bersacha there in Riyadh. Now let's continue with a lot of earnings here in Europe as well. UniCredit earnings beat estimates, setting the tone for a busy week of corporate earnings as Donald Trump's promise of an executive order on drug prices is roiling the pharmaceutical sector today. Well, Charlie Wells is here with an update. So, Charlie, how do UniCredit's earnings help or hurt the bank's M&A ambitions?
Yeah, Francine, so these earnings are the best quarterly earnings that UniCredit has ever posted in history. And this is certainly a boost to Andrea Orcel as he pursues M&A, not just in Italy, but also in Germany. You can see the CEO putting out this statement this morning, talking about searching for growth opportunities from a position of strength. He also told Bloomberg that the company will be in discussions with Rome about BayPay-M and some of the limits that the government had put on a potential deal there. But as these deals take longer and longer, you can see some of the share price moves of some of these targets making that more difficult. You can see the likes of BayPay-M heading upwards. You can see Commerce Bank as well. Now, this will undoubtedly, and we're seeing this morning, provide a boost for UniCredit, but we can see that the length of this negotiation process has been difficult for the bank, so this provides an important boost at a crucial time.
Charlie, what other earnings are we expecting this week?
Francine, so it is a busy week across insurance, across luxury. We've got some of the biggest names in those sectors reporting. We've got Munich Re tomorrow. We've got Burberry the day after, Allianz on Thursday, and then Richemont rounding out the week. Now, it's interesting, some of the big themes here in insurance, how these firms have been navigating market turbulence. On the luxury front, we'll get a really interesting kind of side-by-side from a kind of soft luxury on the Burberry front, and then Richemont, more of the hard luxury. When consumer sentiment goes down, we tend to see a hit on more of those soft luxury companies. And zooming way out, looking at how these European firms have been reporting, about 80% have reported so far. A majority have been beats, but the focus really has been on that forward guidance that's been much more of a mixed picture.
Charlie, pharma definitely in focus, in fact, getting slammed today. Tell us more.
That's exactly right, Francine. So this is one of those mornings where a Trump social media post really upends a global industry. We're seeing this Truth Social post where Trump is talking about how he wants to lower the price of prescription drugs for Americans. We know that Americans pay the most for prescription drugs of anyone in the world, but there's not a lot of clarity on how the president would enact this policy. Nonetheless, we are seeing these firms across the globe get slammed. Here in Europe, we're seeing a lot of red. We're seeing a lot of negativity around this sector. You can take take a look at some of these European pharmaceuticals taking a hit this morning. And then if we flip the board and take a look pre-market at the United States, you can also see negativity there in this space.
Charlie, thanks so much. Charlie Wells there with the very latest, of course, on earnings that have been and the ones that will come, with a nice focus on pharma. So let's get more on President Trump's drug price plans and bring in Sonia Wind, Bloomberg healthcare and consumer reporter in Frankfurt. So, Sonia, what exactly do we know about what will be announced and whether there are winners and losers?
Hello, good morning. Well, the details are very scarce. What we do know is, as you mentioned, Trump will sign an executive order today mandating that Americans do not pay any more than other people in countries around the world where drug prices are lower. He said that could lower drug prices by 30 to 80%. However, how he wants to do that is not clear. It's important to note he already tried something similar during his first term. Back then, this idea was struck down in court. So the details are still yet to be announced. Maybe we'll get some later today. As of now, it's more of a headline than really a defined policy.
And how would an order like this actually work?
So the idea is that the U.S. would benchmark its drug prices, which are the highest in the world, to the drug prices in other countries where prices are lower. Trump also mentioned that drug prices would rise around the world as a result of this. So that's the idea, that drug prices would then push up prices so that the benchmark in the U.S. wouldn't be forced lower. However, how realistic is that? It's not very realistic. Here in Germany, drug prices are very tightly regulated, and it's not possible for companies to simply push up drug prices. And then, of course, the question is, where would it apply? Would it cover all drugs? That, of course, would be the worst-case scenario. Will it affect Medicare, Part B, Part D? Would it affect Medicaid? That would be less of a negative outcome because there are already some discounts there. So the details here really matter, and of that we don't really have enough yet. So let's see what we will see later today.
Sonia, thank you so much. Sonia Wind there, of course, on the latest with these pharmaceutical stocks. Now, the Kurdish separatist group, the PKK, has agreed to disband after ending its 40-year war for autonomy against Turkey. Now, the group declared a ceasefire on March the 1st, and the decision to disarm was made at a Congress last week. It's unclear whether Turkey will offer amnesty for the group's leadership and exiled militants, and how it will address demands for improved rights for Kurds. Hamas says it will release Eden Alexander, the last living American hostage still being held in Gaza. Now, the news follows renewed talks with the U.S. in recent days over a ceasefire with Israel. Hamas did not say when Alexander would be released. Well, meanwhile, Israel has endorsed President Trump's plan for a phased resumption of food distribution to Gaza civilians. The United Nations had warned of a growing humanitarian catastrophe in Gaza due to the Israeli blockade. The UK is tightening citizenship rights and raising English-speaking requirements for migrants in an overhaul to cut immigration. Now, the Prime Minister, Keir Starmer, is introducing a bill to end automatic settlement after 5 years and limit low-skilled work visas. Now, migrants will need to spend a decade in Britain before applying to settle.
Today, this Labour government is shutting down the lab. The experiment is over. We will deliver what you've asked for time and again, and we will take back control of our borders.
Coming up, EU finance ministers meet in Brussels. We'll head there next for an exclusive conversation with the new Greek finance minister. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Well, right now, there's a lot of uncertainty about what's happening with trade policy. Right now, the economy is in a really good place in the U.S. Unemployment's in 4.2%, inflation's 2.3%. The other indicators show we're still a pretty solid economy. So right now, we have time.
Overall, we see health still in the real economy. So that gives us time to make sure that we continue to make progress on inflation, and we keep our inflation expectations very well anchored.
Well, that was, of course, the Fed's Adriana Kugler and New York Fed President John Williams speaking to me at the Reykjavik Economic Conference last Friday. Now, Eurogroup finance ministers are meeting in Brussels today as the EU seeks to strike a trade deal with the U.S. Well, Trump has targeted the bloc as part of his broader effort to reshape global trade. Officials will also discuss funding for Europe's defense push. Well, Bloomberg's Oliver Crook is in Brussels with the Greek finance minister. Ollie, over to you.
Yeah, that's right, Francine. I mean, listen, it's a very filled docket here in Europe dealing with a number of different issues. And of course, I think front and center, probably what you're going to get is this question of trade, though this is technically at the EU level sort of competence. This is the inevitable conversation really around the world. So we're very pleased to be now joined by the Greek finance minister, Kyriakos Pierakakis. Thank you so much for joining us today here in Brussels. So listen, we just had the press conference from Geneva, from the Swiss. We have this sort of a reprieve on the trade deal with the United States and China. Sitting here in Brussels, sitting in Athens, what does that tell you about what the United States is trying to achieve? And do you think that puts us closer towards some kind of resolution with the United States?
First of all, it's great to be with you. I think that the news are positive. It's a positive development, the one that we're seeing. Obviously, we will have to study the details of any agreement, as we plan to do in the Eurogroup and the ECOFIN meetings with my colleagues at the EU Council. But overall, our position as Greece, we're a member state of the European Union that believes in free trade, in a union that believes in free trade. We hope to lower the temperature in the room. And any such deal, any such development, it's already reflected in the markets, is quite positive.
And in terms of kind of what, because we also heard from Scott Bessent saying that the EU has fallen further back in the line in that press conference. He says that the UK jumped to the front, the Swiss are doing well. What is your sense of how close the Europeans are to actually reaching a deal with the United States? Their task is made more difficult, obviously, by the fact that there are 27 member states. Do you think that that puts us at a disadvantage here in Europe in terms of negotiating an actual outcome?
I had the chance to meet with Scott Bessent in Washington in the context of the IMF spring meetings, and my message to my American colleague was the fact that we hope to move quite fast, quite swiftly vis-a-vis achieving a very positive trade deal. The position of my Prime Minister, of Kyriakos Mitsotakis, was ideally we should have a 0-to-0 tariff relationship with the United States. As I said, we hope to lower the temperature in the room. Yeah. I think it's feasible. We are a 27-member state union, as you suggested, but I think that we can move quite fast.
And given what we saw from the UK, you still have those 10% tariff barriers there. Does that give you an idea of kind of what you can hope for from a deal with the United States? Because 0-to-0 seems fairly unlikely at this stage.
Well, look, we're going to shoot for the best. We're hoping to achieve the best. Generally speaking, we should try to remove trade barriers. But if you look at the EU budget, by the way, at the structure of the EU budget, I think around 13.7% of the EU budget already comes from tariffs as we speak. It's part of the overall EU trade architecture. But hopefully, ideologically, what we believe as Europeans should be to eliminate those trade barriers. Plus, we should be trying to remove the internal barriers that we already have within the European Union, the Draghi report, the Leto report, and this is part of an overall discussion of an overall new architecture that we should aim to strive for.
And one of the features of the trade war has also been extremely heightened market volatility that we've seen throughout the world. I remember a time that when you had that market volatility, you had German and Greek yields moving in the opposite directions. They have been moving in lockstep. We've seen basically, that story be a sort of haven assets within Europe. What do you think the opportunity is from the sort of U.S. policy in terms of attracting capital here into Europe, attracting talent? How does Europe capitalize on kind of some of the uncertainty we've seen out of the United States?
It's funny that you mentioned that volatility, because in the past my country used to play a role in this discussion. We created that volatility, and now we're a stability story 15 years later after a lost decade. Plus, to add to your point, we discussed tariffs. Uncertainty is a much bigger problem. So the positive premium of those discussions, of those trade deals that we're seeing on the ground right now on behalf of the United States, with China, with the United Kingdom, with us as a next step, is to remove that uncertainty from the table in order to have a positive growth dividend in this debate. Is it an opportunity for Europe? Yes, we should always view crisis as opportunities. If you look at European history, by the way, in every move of European integration, you had the crisis that catalyzed that integration, which we then metabolized as a positive institutional reform move. We should be able to do the same. The banking union, the savings and investment union, the capital markets union, all of those things that we have been discussing, as you very well know, for quite some time. It's a topic, again, of discussion at the Eurogroup meetings, at the ECOFIN meetings. It's an opportunity, and we should grasp it.
And when you think about that integration, kind of concretely, because again, as you know, we've been talking about the capital markets union for a decade at least, and now we have some renewed urgency. But I'd like to get a sort of an idea from you. When do you think we can make meaningful progress on this? And where do you sort of stand? Where do you think the sort of hurdles are?
The hurdles used to be that we had to negotiate a full spectrum of things, of details, of member state sensitivities in all of those discussions. But again, a crisis can help as a catalyst vis-a-vis removing those sensitivities, vis-a-vis removing those hurdles. I think that there's a real opportunity on the table, and we plan to be very constructive with regards to achieving a very positive result.
And I also want to get your take on some of the domestic issues going on within Greece. You are now rescheduled. You're paying ahead of schedule a lot of your first bailout debt. Is that something that we can expect more of? When do you think the first bailout can be completely behind you? Are we expecting that to come ahead of time?
It should be completely behind us by 2031. This is 10 years ahead of schedule, as we have been discussing both domestically and internationally for us. For my generation, for my government, fiscal prudence is not a policy choice. Fiscal prudence is a regime. After having a very difficult decade, a lost decade, we lost 24 points of GDP. Right now, we're growing ahead, much higher than the EU average, 2.3% growth. We had a headline surplus. 6 countries in the EU had a headline surplus. We were one of the 6. And we plan to continue de-escalating our debt. We don't plan to pass the bill to the next generation as all the previous generations in Greece did. And in this context, we hope to create positive tailwinds, even if we see negative headwinds in the international economy.
And part of the contributor to that surplus that you had, that surprise surplus that you had last year, that was quite ahead of what anybody had anticipated, was a drive to basically deal with tax evasion, to collect taxes. Again, is this something that we can expect more of going forward? And what is it going to mean budgetarily? Do you expect more surpluses in the future? And how big, do you have an idea of how big that shadow economy is and how much revenue could be there for you?
The first point would be that the expectation for the next primary budget surplus for next year, for this year, is 3.2%. So overall, we hope to achieve primary budget surpluses in all future scenarios. Second, if you look at studies that were conducted on behalf of the IMF in the previous years, the shadow economy was calculated to be in the ballpark figure of 30%. In the past, it was even 40%. In the last IMF study that calculated the shadow economy in Greece, the number was 15%. And right now, it's even lower. We plan to lower it further using digital technologies to capture tax evasion. We managed to do that and achieve the budget surplus that you mentioned before. We had a VAT gap. We have a value-added tax in Greece. Half of that VAT gap is already captured by our smartly shaped policies. We hope to do more. Overall, I would say Digitization is a success story for Greece. If you look at our government platform, gov.gr, it has more than 2,000 services offered digitally.
And I've talked to a lot of finance ministers over the last couple of months, and as you can imagine, the focus has been on trade. And I just want to return to that just for a moment. Do you have an idea, do you have your arms around how damaging this could be to the trade war is to the Greek economy, or is it still too early to say? Because every finance minister I spoke to the last few months said that basically it's incalculable. Now, do you have an idea of what the damage to the Greek economy could be?
I adhere to the position that it's extremely difficult to calculate the effects. The primary level effects in Greece, if you look at them, they are limited. We have less than 5% of our exports. 4.8% of our exports go to the United States. It's less than 1% of our GDP.
But it's a huge flow for trade.
But it's a huge flow for, we're a maritime nation. It's a huge flow for trade. We're primarily worried about the second order effects. What would happen, for instance, if the American economy moves into a recessionary or even to a stagflationary environment? What happens if you have a recession in certain European markets which directly interact with the Greek economy? All of those things worry us. This is why we believe that we should remove as much as we can the heat from the room.
And one of the topics that you'll be discussing today will be, no doubt, the defense plans within Europe in terms of dealing, and Greece is one of the sort of highest spending nations in terms of GDP, and the NATO commitment above 3%. The Trump administration would like to see 5%. Do you think that we need to get to a world where we're closer to 5% rather than 2%? And is there an avenue to get there without European joint debt? And where do you sort of appraise the debate on the question of joint debt for defense in Europe?
Well, I would say, first of all, that for us, defense spending was not a policy choice per se for us. It was geographic destiny. It was one of the things that we had to focus on and invest on many generations before. And we're hoping to do it better in the future with more spillover effects in the economy. There were certain Bloomberg reports in the past which underlined that Greece was not spending the defense amounts in the maximum spillover effects capability that it could. We hope to do more of this. For us, that would be a growth dividend. But overall, the treatment of defense spending as it currently takes place in the context of the EU Council, I think, is positive. We should have some exemptions vis-a-vis the new fiscal rules of the European Union, and the current geopolitical environment mandates those exemptions. And we paid our fair share even before. More EU member states should be able to do that. Germany is now doing that. I think that we should have those degrees of flexibility with regards to achieving this.
And just a sort of final question on trade, because this is another question that I think is a very big one, a difficult one to answer. When we look at the trade barriers that were erected between China and the United States, the big concern is that all of that overcapacity flows to rich markets. There really is only one that rivals the United States, that is the European Union. How do you treat some of that oversupply coming from China, potentially coming into the European market? And what we're seeing from the United States of rewriting this trade order, what have we learned about how trade deals should be structured and potentially differently in the future to protect, sovereign industry?
We don't yet know. There's lots of uncertainty. There is lots of uncertainty on the table right now in all of those discussions. We don't yet know if we're going to be in a zero, in a limited, or in a high tariff environment. The world that we're going to be at in 90 days, 100 days from now will directly affect the answer to your question. But what we do know is that tariffs are going to directly affect supply chains. If we look at what happened in the past, take the 1930s, it was a Smoot-Hawley Tariff Act of the United States. This had a very adverse effect for the global economy. We should do our best with regards to trying to avoid that at all costs, and this is what we plan to do at the Eurogroup and at the ECOFIN meetings.
Well, Kyriakos Pierakakis, I look forward to speaking to you in 90 days when we have certainty on the world that we're living in, and until then, I'll land it back to you in London, Francine.
Yeah, the world stops for 90 days, and then we see what happens at the end of it. Ollie, great interview, Oliver Crook there in Brussels. Now, very quick day book, because there's a lot going on this week. First of all, Donald Trump is in Saudi Arabia. Today, tomorrow, we have a bit of data out of the U.S., CPI. Thursday, we continue with earnings from Walmart, but also we have U.S. retail sales. Again, that will give us a bit of an indication going forward of what the U.S. economy will do. Jay Powell's also speaking. And then on Friday, University of Michigan Consumer Sentiment. This is the picture overall. In Europe, some stocks are up, some stocks are down. Defense actually down by quite a lot. Pharmaceuticals also down. And then if you look at some of the things that are doing better than others, probably the ones that are more exposed to China because of this agreement between the U.S. and China. Up next, Bloomberg Brief, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving,
your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. We have a deal. The U.S. and China shake hands, lowering tariffs for a 90-day pause.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels.
And the ensuing rush to risk. Stocks jump, the dollar jumps, treasuries and gold tumble. But drug makers take a hit after President Trump readies an executive order to cut drug prices in the U.S. We witnessed a major de-escalation in the very early hours of this morning. Trump had set the expectation at 80% tariffs with China. It falls to 30% for the Chinese side. To the U.S., it goes to 10%. And here's what the markets do. We unwind the Sell America trade. You can see NASDAQ outperforms up more than 3.5%. Your S&P 500 future session at 2.7%. All of these indices now trading well above the April 2nd Liberation Day level. We're now back to the highs around March. Still down for the year, I should point out. The dollar also experiences relief. Remember, this is an asset that had been hurt with the higher tariffs, with the policy uncertainty. It is now the worst day for the euro at this pace so far this year. We are also selling bonds this morning, moving into risk assets. You see yields higher across the curve. The pain, though, concentrated on the front end, higher by 9 basis points. We are just below that 4% level, only pricing in now 60 basis points of cuts from the Fed. Remember, at one point this year, that was at 125. So we have walked down a lot from that level. Your 10-year yield at 4.43 this morning. A lot going on markets. Let's look at some of the individual names. Here with that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So one area of the market we are seeing weakness is in pharmaceuticals, as Trump reckons he can rein in drug prices in the US, potentially using a system that looks to use the cheapest prices available abroad. And we are seeing weakness in Novo Nordisk ADRs, also Pfizer, Bristol Myers, Merck, all of those stocks slipping in the pre-market today. Then in terms of the sectors moving on the trade headlines, airlines really standing out for me, seeing decent moves in those stocks. Delta, United, American, all moving higher on potentially a boost from those trade negotiation headlines we got earlier today from Scott Besson this morning. Then finally a quick look at the Mag 7. Broad moves higher. The NASDAQ on track for its biggest gain in around a month. Again, these trade headlines really making our job a little bit easier this morning. As usual, keep an eye on the before the bell opening wrap available on the terminal shortly, Danny.
Maybe our job easier, but you got to feel for the sell-side analysts who now need to quickly revise any notes that they had drafted over the weekend. Joe, thank you so much for that. Bloomberg's Joe Easton there. Coming up this hour, a great hour, Seema Shah of Principal Asset Management will be sitting down with us alongside Amanda Lynham of BlackRock. But back to our top story, dominating this morning, substantial progress in U.S.-China trade talks, now a 90-day pause to the eye-watering tariff rates that each nation had opposed on the other.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%.
China also touted the progress made in talks that they described as candid and constructive.
The two sides held in-depth exchanges on trade and economic issues of their respective concern. The atmosphere of the meeting was candid, in-depth, and constructive. The meeting achieved substantial progress.
The new rates under this agreement, 30% U.S. tariffs on Chinese imports and a 10% tariff on U.S. imports coming from China. Planned sectoral tariff rates are ineffective. Team coverage on this starts now. Joining us is Bloomberg's Brendan Murray, who leads our global trade coverage, and senior editor Alan Wan in Shanghai. Brendan, let me start with you. What were the takeaways from this morning?
Yeah, I think the key takeaways are that both sides walked away saying that they thought they had a good negotiation, that they got the result that they wanted. But I think it's the more you dig deep into what's actually been announced, it's going to be hard for people in Washington, especially China hawks in Washington, to say that the U.S. didn't give up a lot here and got little in return. So I think there's going to be we're going to have this 90-day window to negotiate the major differences that still are out there, and that's not a whole lot of time. So we're in for a 3-month period where we don't know the goals of the talks under that 90-day period yet, but it's going to be a continued period of uncertainty, and I think you'll hear from the Chinese side that they feel like they diffused a situation that was damaging both economies.
Alan, let's talk about the Chinese side, because the press conferences, the briefings we got were very different from the U.S. side, quite detailed to the point of talking about where the actual physical talks happened. From the Chinese side, it seemed much more scant on the details, really just reaffirming of what we heard on the statement. What did you make of that?
Well, that's the thing. Like Brady just said, I think that there was a joint statement, a spirit of cooperation, and China didn't want to actually go beyond that. During the Ministry of Foreign Affairs briefing today, there were a lot of questions asked of the spokesman, and they said, well, please refer to the statement. But the overall message is that, was positive, that both sides agreed to de-escalate. I mean, it's easy to say that, China won. I mean, just because it stuck to its guns, but at the end of the day, Trump still has 30% tariffs on Chinese exports. But definitely, it was something that a lot of investors, markets did not expect today. I mean, there was a lot of damping down expectations ahead of the meeting, as well as Trump last week saying 80% possibly. So I think that overall is positive. And from the Chinese side, by saying little, is actually pleasing investors in many ways. You don't really want two sides to go to separate ways.
No, it is a fair point, Alan. I think you'd be hard-pressed to find someone who thought tariffs would come down to 30% and 10% for China and the U.S. respectively. Brendan, you hinted at this. Could you get more into the details of how difficult exactly the next 90 days will be to reach a deal, and whether it looks like we have a ceiling in for what tariff rates will be?
Yeah, exactly. I mean, one of the key things in that statement was the role of Treasury Secretary Scott Bessent. We already knew he was taking a leading role in negotiations on Capitol Hill and various other Trump administration priorities. but he is now the person at the head of the table, along with USTR Jamieson Greer, negotiating for the U.S. side, and it's clear that he is representing a less hawkish version of a Trump administration official than, say, Howard Lutnick would be. So I think there's going to be a more measured diplomatic approach to these negotiations. Again, we don't know what exactly is on the table, but major trade disagreements take a long time to hammer out. So it will be interesting to see what they can put together in just a 3-month period.
In listening to the press conference, Alan, I jotted down something that Treasury Secretary Scott Bessent talked about, this idea that the U.S. wants to rebalance, but it wants China to rebalance trade the other way. That is, it is overproducing and wants China to move into a consumption economy, saying we could rebalance together. Is this a project that China does want to undergo at the moment, Alan?
I mean, if you told me back in 2018 when they first engaged in the talks during the first trade war, I would say I'm not sure about that. But I think in 2025 is a different story. I think the government realizes that it has to rebalance away from exports and fixed asset investment into domestic consumption. And that's what the government did back in March during the NPC meeting. And it's a win-win for both U.S. and China. I mean, China needs more exports. I mean, needs more imports, buy more imports, in order to rebalance its economy away from exports. But it's also, it understands that, how we got here was because, China's massive trade surpluses, and not just against the U.S., but the rest of the world. So it recognizes the fact that, it no longer can sort of keep this model. So I think that it's a possible, it could be a win-win for both countries if China is willing to do what it needs to do. Unfortunately, the Chinese economy is slowing quite a bit. Property market is slumping. Employment is down. So, in order for domestic consumption to really rebound, all that has to sort of stabilize, and we haven't seen that yet.
Well, at least relief for now. We'll see where the next 3 months bring us. Brendan, Alan, thank you so much. Brendan Murray and Alan Wan on the latest trade talks out of Geneva. Let's get you now some other top stories that are trending on the terminal this morning. President Trump said that he plans to order a cut in U.S. prescription drug costs by mandating that Americans pay no more than the people in countries that have the lowest price. In a social media post, Trump said that he'll sign an executive order at 9 a.m. today that he claims could drop pharma prices by 30% to 80% in the U.S. Elsewhere, the Trump administration is likely to accept a luxury Boeing 747-8 jumbo jet from Qatar's royal family. That, according to ABC News, the aircraft is set to be used as Air Force One, with sources saying the gift is expected to be announced this week during Trump's Middle East tour. Trump has been seeking alternatives to replace the aging Air Force One since his first term. And UniCredit posted its highest quarterly profit ever as CEO Andrea Orcel pursues potential acquisitions. His pursuit of Germany's Commerzbank has sparked a backlash in Berlin, while his unsolicited bid for Italio's Banco BPM has triggered government resistance in Rome. A quick check on markets before we head to the break. And again, we are off to the races. S&P 500 futures back to the levels that they were at March, so we're above Liberation Day levels. The Bloomberg Dollar Index maybe not as big of a relief, but it is still relief. The weakest day for the euro so far this year. You can see it's down 1%. Sterling also lower this morning. That euro at 111. Coming up, we're going to dive deeper into the market's impact. How much do you need to rewrite the narrative this morning? We'll catch up with Principal's Seema Shah. That's coming up next on your Bloomberg Brief.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our reciprocal tariff rate will go down to 10% on the United States side, so it goes down 115%. We enter into a 90-day pause period for negotiations, which both the Chinese and the United States are very committed to, and the Chinese on their side also go down 115% to 10%, and they remove the countermeasures that they have in place.
That was U.S. Trade Representative Jamieson Greer on the details of the China deal, tariff deal rather, with China. Seema Shah of Principal Asset Management writing earlier, the economy will surely weaken in the coming months, but with this underlying momentum, the U.S. has a reasonable chance of averting recession if it can step back from the tariff brink in time. She joins us now. And Seema, I know you wrote that before this morning's deal because basically no one has had time to readjust. But I wonder, is this stepping down from the brink? How much does this morning's agreement change things for you?
Good morning, Danny. I think it has to change things. I mean, when we were doing the forecast and trying to analyze what the impact of China's tariffs could be, we were looking at a subtraction to U.S. growth of around 1.5% if you take into account the exemptions to electronics that had already been announced. So this is really meaningful, and take into perspective as well that the market was definitely not expecting anything as significant as this. I mean, I think the best I'd heard was the 60% tariff. So this is a meaningful change. Now, obviously, the market is going to try and pull through the details and try and find holes in it. But I think if it's telling us that at least the Trump administration is not going to be moving forward with tariffs at this kind of level or the level before today, I think that is definitely good news. And there's certainly going to be a positive impact for the U.S. economy and for the Chinese economy as well.
If we assume then, or do you assume, Seema, that 30% becomes the new global ceiling for tariffs given this agreement? And if it is 30%, what does the growth outlook look like?
So if we're looking at a 30% tariff for China, which is maintained, and certainly I know that there are question marks about whether we can actually see all the details finalized within a 3-month period. Well, of course, they can continue this extension, these 90 days, they can keep pushing it out. But if 30% tariff becomes the norm, and I think it's generally a good news for the U.S. economy. I mean, look, there will still be an economic slowdown because you're still pushing back on export growth and some impact on inflation and for consumer spending as well, but significantly smaller than anyone was anticipating. And I think all the forecasts for recession that have been out there start to get pulled back in the next couple of months.
I wonder just how much of an unwind we have. I was looking earlier this morning at a Bank of America FX and rate survey that still the highest conviction view was that we were in peak U.S. exceptionalism. Does that start to unwind? Do we unwind the Sell America trade starting this morning, Seema, and how far would that unwind have to go?
Well, certainly any traders that have reduced their exposures to U.S. equities and certainly had been sitting underweight will be feeling really uncomfortable today. I think maybe we have hit the peak, but I don't think that the discussion is going to go away entirely. I mean, importantly, for places like Europe, there have been meaningful advances with regards to talking around infrastructure spending, defense spending, and those are really going to strengthen their economies, not just for the next 2 or 3 years, but actually looking further out. So increasingly, this is going to be a discussion for investors. If you have a marginal dollar, you now have a discussion. Is this going to go to the US? Is it going to go to Europe? Is it going to go to another part of the world? I think US exceptionalism likely does stay, certainly if the news of this morning is something which is going to be sustained. But I do think the world is a bigger place, and I think it's been a really important reminder of that over the last 2 months.
Well, also on kind of the same note, Seema, you talk about the rest of the world putting investment into infrastructure. Just on the U.S. side, to what extent is there damage already done in terms of delayed spending plans, delayed hiring plans? Are there going to be scars even if we do continue to see a significant walk back of tariff rates?
I think you can expect there to be some scarring. I think that's the reason why we can still expect a weakening to come into play over the coming months, because, as you said, so many investment planning has come to a halt. And of course, we still have to see what happens to supply chains. But importantly, look, if that's just a pause and companies feel like they can see a way through, they will restart that investment spending. And importantly, the economic data has been so strong that we know that there was good momentum in the US economy before all of this hit. So that does suggest that you could get a fairly rapid recovery, of course, assuming that this 30% tariff is maintained and it doesn't just reverse back to a significantly higher level in the next 3 or 4 months.
There will be people this morning, though, Seema, that see the move higher in yields and get concerned. Concerned, to your point, that there might still be some weakening to come, but we're going to have higher yields, a tighter economy, and a Fed that feels like it can sit on its hands for longer now that we have these pause in tariff rates. Is there a risk that you do have a Fed that feels more comfortable not cutting with an economy that still might be on shaky grounds?
I think one of the key things that we're likely to see is investors, traders really pulling back on their Fed expectations for this year. As it is, because of the strength of the economic data, we've already had a number of people talking to us about no cuts at all for this year. But I think the important thing is that, look, if the US economy is on a fairly shaky ground, but at least the momentum is strong and you can see the investment spending return to the economy, it is possible that the Fed doesn't need to cut rates this year. I mean, I think that's a little bit early. We are still expecting 3 rate cuts to come: September, October, December. But let's see how things pan out. But I think this is, of course, a growing discussion, and we're going to see FOMC members really talking about this over the next couple of weeks.
And again, Seema, what we're seeing this morning, very much so, just the first gut punch reaction. It often doesn't stick. You've pointed out that we're going to continue to sort through details and what actually happens after 90 days. But the gut punch reaction, you can see it there. It is tech outperformance. Dan Ives of Wedbush, a tech bull, writing this morning about how consequential this change is, that it's a huge win for the bulls and the best case scenario for tech. Do you think that that aspect of the reaction that we're seeing sticks, that tech comes back as the market leader?
Well, it's been interesting because actually, increasingly, even over the last couple of weeks, we've heard more and more people showing some growing interest in technology, this belief that there's already been such a re-rating in valuations that actually, if you still believe in the long-term story, it was a time to get back into tech, and today's news is only going to reinforce that narrative. And of course, if you do see technology return as that front runner, then you are looking at pretty significant gains potentially for the S&P 500. I want to make sure that, look, of course, we're bullish and this is really good news. There will be some potential for pullback as you see maybe headlines over the next 3 months or so. So it's really important for investors to try and look through that noise. I think the biggest takeaway today is really, look, the Trump administration doesn't have any intention of keeping tariffs at these very, very high levels that we've had for the last month or so. And so most of the worst of the recession concerns are probably somewhat unfounded.
Seema, I think that's the perfect note to leave it on. Thank you so much for joining us this morning. Brilliant as always, Seema Shah of Principal Asset Management. And to that point, we are walking away from a lot of the haven currencies this morning. Yen and Swiss franc weakening versus the dollar, but everywhere else it is a story of dollar strength. The euro falling just about 1% versus the dollar for its worst day of this year. You're watching Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Welcome back to Bloomberg Brief on a day of relief for markets. I'm Danny Berger in New York. Let's get you some front page news, a look at what's making headlines, and pour one out for the front page editors this morning who have had to quickly re-scramble to adjust because this is on the front page of basically every major paper, the trade deal. The announcement, it is a step towards de-escalating a tariff war. The two countries had earlier reported substantial progress in their talks. It's buoyed markets. It's helped Chinese stocks recoup their losses since President Trump's so-called Liberation Day announcement on April 2nd. So markets greeted the report with progress, but history does suggest that it could take a long time to reach a detailed agreement if one is possible. In 2018, recall, the two sides also agreed to put their dispute on hold after a round of negotiations, but the U.S. soon backed away from that deal. That could be, as history, very instructful for where we go from here. Capital Economics also writing this morning, pouring cold water over the deal, saying that the tariff rates still remain high. The U.S. still looks like it's pushing partners to back away from trade with China, and that there's no guarantee that the 90-day truths will give way to a lasting ceasefire. Markets trading it as such. We are looking at commodities moving much higher this morning, along with risk assets. We'll have more coming up on your Bloomberg Brief.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about over-regulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. And we have a deal. The U.S. and China shake hands.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels.
And the ensuing rush to risk, stock futures and the dollar jump, treasuries and gold tumble. But drug makers, they take a hit after President Trump readies an executive order to cut drug prices in America. So it's major de-escalation, 30% tariff rate for China, 10% for the U.S., and the Sell America narrative unwinds. NASDAQ futures and Russell 2000 outperform, both up about 3.8%. Your S&P 500 future session up about 2.8%. We are back at the March highs. You also see some relief in the dollar. The euro off the lows of the session, but still weaker by just about 1%. We are still headed for the worst day of the year for the euro so far this year. Treasury markets, we also see selling there. Yields move higher, especially on the front end. As we move to price out Fed cuts, we only have about 60 basis points now priced in for the totality of this year. That's back from 125 at one point after April 2nd. So your 2-year yield's right below 4%, your 10-year yield at 4.42. Let's get some stocks moving underneath the surface. A lot to keep track of. Here with that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So one of the few areas of the equity market we're seeing weakness is in pharmaceuticals as Trump looks to rein in prices for drugs in the US, potentially going to introduce a lowest prices abroad method where they try and lower the prices in line with some of the cheapest countries. So we're seeing Novo, Pfizer, Bristol Myers, Merck all dropping in the pre-market today. But as I said, most of the sectors are green. Take a look at the Mag 7. Elon Musk will be feeling a little bit better this morning with this gain we're seeing in Tesla, leading the rise there, up almost 8%. And the other peers, Amazon, Apple, Nvidia, all gaining as well. Positivity across the tech sector. And another sector standing out for me was airlines. We're seeing a bit of a rebound in those shares. Delta, you remember that one, they cut their earnings forecast due to the worries around tariffs. So seeing that reverse today. American coming up, United coming up. It's going to be green pretty much across every sector, although that pharma sector looking weak, but pretty much green everywhere we look this morning, Danny.
Yeah, and I'm not so sure that this deal will convince Canadians that they need to come visit the U.S. Joe, thank you so much. Bloomberg's Joe Easton there. Thanks for your work this morning. Let's get back to that top story because tensions are easing as the U.S. and China agree on a temporary pause in tariffs that each nation had opposed on the other.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%.
U.S. tariffs on Chinese imports now go down to 30%. China's levies on American goods dropped to 10%, both down from 115% from previous rates. Planned sectoral tariffs, though, those remain unaffected. Joining us now is Bloomberg's Brendan Murray, who leads our global trade coverage. So, Brendan, what did we get out of the meetings over this weekend?
Yeah, so we didn't get a trade deal out of these meetings over the weekend in Geneva. What we got is essentially a ceasefire, or a much needed ratcheting down of the tariff pressure that was hurting both economies. I think what we're going to see going forward over this 90-day period is some uncertainty about what exactly the goals are to negotiate an agreement going forward. The longer-term arrangement that the U.S. wants to do with China to rebalance the out of balance trade situation. So we're going to see the Chinese will probably be very happy with this deal. The tariffs that they're now facing from the U.S. are much lower. They in turn lowered their tariffs on American exports, but of course that's a much smaller number than the number of U.S. imports from China. So Beijing got a pretty good deal out of this, some of the analysts are telling us, and we'll have to wait and see what President Trump thinks of it when he wakes up. But it seems like that we have a 90-day ceasefire, basically, and a lot of issues to work out in a fairly short period of time when it comes to the amount of time it takes trade agreements to be worked out.
Brendan, your point on Trump, I think, is well taken. I think there'll be a lot of folks looking and staring at their screens on Truth Social to see if the president puts out anything that could shake this up. But in the meantime, Ryan Peterson of Flexport tweeting immediately after, "Get ready for a shipping boom." Brendan, how much does this change things for global manufacturers that have been facing essentially a trade embargo between the two nations?
Yeah, exactly. We've been seeing the numbers of ships coming from China to the U.S. West Coast drop dramatically over the past few weeks with this effectively a trade embargo in place. What we're going to see now is a race to get those Chinese goods to the U.S. and all of that shipping capacity that's gone idle is going to get revved up again, and those goods are going to start pouring back into the U.S. to beat that 90-day deadline when the tariffs could snap back up to those higher levels that the U.S. has now suspended. So I think what Ryan Peterson is talking about is there's a window here for American importers to move if they can move quickly, and for Chinese exporters, it will give them the outlet to produce the goods that they're producing and get them to the markets where their biggest customer is.
Brendan, thank you so much for your coverage on what is already a very busy morning. Brendan Murray, and it is only 5:30 a.m. here in New York, and so much feels like it has changed. Joining us now is Amanda Lynham, head of macro credit research at BlackRock. Amanda, great to see you. Thank you for joining. Has a lot changed for you this morning?
Thank you for having me. Good morning. I would say from a step back, we have been comfortable selectively moving down in credit quality within credit. So I think that gives us further confidence in that move. I think this is unquestionably positive, directionally at least, for sentiment. I think the key will be twofold. One, do we have similar agreements across the board with a range of other countries? And then two, what does this mean for dispersion in the credit markets? Certainly, we've seen certain sectors that will be impacted by tariffs. So I think those two themes of further supporting the valuation and credit, kind of seeing the follow through, and then also kind of what sectors are impacted in either less or more negative ways, that will be really key for credit investors to monitor.
Well, you even saw Scott Bessent saying that we still want to do a restructuring, that there's certain sectors that we basically want to proof ourselves that we don't go through COVID again and we can't source things. So when you look at this sort of rally, do you not fully participate in it then? Because you want to await those details.
I think the areas, it's a great question. The areas where we are, I would say, more hesitant to fully step in are that kind of the so-called left tail parts of the credit market that were already under pressure before we saw any sort of deterioration in the hard data. Because even with this positive development, relative to the counterfactual, we're still expecting a more challenging growth inflation mix. We still have some tariffs relative to the previous baseline. So there is going to be a headwind in certain parts parts of the economy. Where we would be most hesitant are the parts that were already under fundamental pressure before we start to see that come through. You had mentioned the kind of the shipping data. I think we're expecting for some ongoing distortions in the economic data, so it will be hard to see that come through. A company level commentary will be really important in this regard. But I think that's really where we would have some pause, is kind of those sectors that were already under fundamental pressure that will just maybe be further exacerbated, albeit not to the extent that maybe before this news. Yeah.
I mean, your point on the data distortion is very well taken. It feels like we haven't gotten a clean read on data in quite some time. What does this do for a Fed? Is this a Fed that needs to continue to sit on its hands then?
So we think that the Fed's reaction function is more constrained. They've been talking about the potential for tension in their dual mandate. I think absent really a sharp deterioration in the hard data, they're not going to be cutting preemptively. We've had a view that cuts in the first half of 2025 are unlikely. We're still confident in that view. But I think actually today's announcements, to the extent that it removes that kind of left tail risk of a spike in unemployment, really the Fed can wait and see, which is what it's really been signaling even as recently as the press conference last week.
Does that worry you at all? Yes, we had a major de-escalation, but we still have to figure out what happens after 90 days. You still have a lot of companies that have pulled back on their spending and their hiring plans. Are there scars that still mean that this is a Fed that should be adopting something that looks more accommodative?
I think there's an overhang of uncertainty, but really our conversations with investors and market participants over the past few weeks have really emphasized that time is of the essence here. So I do think it's positive that there's some momentum in these conversations. I think the other thing is we've been really sensing a proactive approach to navigating this. We're not sensing that there's kind of a risk-off posture or retreating. I would say on the contrary, it's a bit more front-footed. So I think corporates and investors alike will want to navigate this to the extent that they can in a more proactive way. That's what we'll be watching for. Again, that company level commentary, just like during the pandemic, was really insightful. We're expecting it to be really insightful this time around as well.
I mean, you're seeing just this remarkable rally this morning. Is this a market that is primed to rally because of positioning, or is it something that had already been priced in? Because I think there was an assumption over the weekend that talking itself would be good and you can buy equities because of that.
For sure. I will say, at least on the credit side, there was a recognition of the what could go right risks. So I would expect credit spreads, all things considered, to end the day much tighter, or at least meaningfully tighter from here. But I would say there was a recognition from credit investors that we couldn't be too defensive, given that there were some potential for positive upside risk. That's, again, why we were selectively comfortable moving down in quality to a certain extent. And I also think the positioning of investors, if 2024 taught us anything, it was that there was an opportunity cost of being too defensive. So I think that has been looming large to a certain extent, but for sure, risk assets, as you can see in the pre-market in equities, are responding to this.
Well, much like shippers who want to get out ahead of these 90 days, what about issuance? I mean, are we going to be off to the races and companies now saying, now is our window if we want to get debt out into the market?
I think so. May is historically an active seasonal month anyway, as companies come out of earnings-related blackouts. I do believe that that will be a top-of-mind consideration, not just because of the improvement in financial conditions, but also I think corporates, even this is a lesson that started after the financial crisis, see the value in issuing when they can, not when they have to, and they have been historically issuing multiple years in advance. That's true in investment grade, in high yield. I think that's a prudent step for CFO and treasurers, and I think we will see that as well.
For the C-suite, though, we just came out of the busiest week of earnings season. We got all these various figures. It's a $5 billion hit for Apple, $5.5 billion for NVIDIA. Do you expect to see corporates update this market? Is that what investors need at this point? Because again, it is a fast-changing situation. 100+ tariffs on China is very different than 30% in terms of how it'll affect these companies.
I think to the extent that they can provide clarity, and maybe that will be a scenario analysis, maybe that will be sensitivity analysis. I think corporates will try to do that. It's very dynamic. It's very fast-moving. I think really what we've been emphasizing is kind of this back-to-basics fundamental credit approach. What are the companies that we feel have the confidence to navigate through this? Management teams, product diversification. That will, I think, be first and foremost for investors to watch over the next few months.
Amanda, it is so wonderful to get your take this morning. I know it is a lot to adjust to. No one else we want to discuss it with besides you. Amanda Lynham of BlackRock. And a quick check on markets this morning. As we do reprice, we unwind some of that Sell America trade. S&P 500 futures now at the highest level since March. You're also looking at the dollar backing off some of the losses, not as maybe enthused as we see for those risk markets. Your 10-year yield, that is up 4.7 basis points at 4.42. Coming up, one part of the market still under pressure. Shares of drug makers fall. President Trump plans to slash prescription prices. We're going to discuss that next on your Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
This is Bloomberg Brief. I'm Danny Berger in New York. Drug makers firmly in the red this morning as the rest of the stock market jumps pre-market. Novo Nordisk down as much as 4%. President Trump said that he plans to order a cut in U.S. prescription drug costs. He wrote on Truth Social that the U.S. will pay the same price as the nation that pays the lowest price anywhere in the world, and costs will be reduced almost immediately by 30 to 80%. Joining us now is Sam Fazeli of Bloomberg Intelligence. Sam, we have to start with the price action this morning. We were talking about this in the break. A double whammy for pharma because you have positive risk assets everywhere else, and this truth from President Trump.
Yeah, so Danny, we've got the sector's got a little bit of a problem today in that people are risk on, so the defensive character quality of the sector is not necessarily in play anymore. You don't need that. And at the same time, you've got this news that threatens the pricing power that they have in the U.S. So not a good day for pharma in general.
So on the announcement itself, on this executive order that we're expecting at 9 a.m. Eastern, lowering prices around 30 to 80%, matching the prices of the lowest nation. Sam, do we have any idea of how that would actually work?
No. Honestly, no. I mean, if number one, you can't price against the lowest nation. Where is that? If Ethiopia, is that? Which country has the lowest price? There is a reason they have the lowest price. They can't afford it. You're not going to surely price it to the lowest number out there, because the reason it's there is because those countries have got no ability to pay for drugs. So what are you saying here? Is it better for pharma companies to stop selling drugs in countries where access to medicine is really tough? I mean, that doesn't make any sense. So it has to be the measure has to be against countries that have got at least similar GDP levels, or although nobody else does, versus the US, that you can make some comparisons there. Europe, Canada, those are the places where I would suggest you look at if you were going to do this.
So Sam, what becomes the impact? Maybe it doesn't go to 80% reduction, but we get some sort of reduction. What areas of pharma, of medicine, become the most impacted by this move?
Yeah, so the most easiest area to go after, which is what the IRA did, is the Medicare negotiating powers. How quickly they can implement that, how much more work that needs. Is it all existing drugs, or is it going to be new drugs? How is that going to come out? We don't know, but we do know that negotiating prices for Medicare and then setting them lower will have an impact. Pharma companies have been able to absorb that now. But if that ends up being a much bigger price cut, then that's a bigger issue. If you go to Medicaid, Then we do know which companies are impacted by Medicaid most, you know, the two different government-funded programs in the US. The issue there is whether it bleeds into what's called the 340B program. The 340B program is what basically a lot of hospital drugs, which include oncology drugs, are included in. And that negotiation is really, really important here because oncology is one area where we're seeing amazing progress in terms of extended survival, etc. So you don't really want to be taking the rug away from under the feet of that innovation.
Sam, thank you so much for joining us this morning, trying to work through what that could actually look like, a difficult task. Sam Fazeli of Bloomberg Intelligence. Let's push ahead now to the rest of the week because President Trump is set for the first foreign visit of his second term. The president will visit Saudi Arabia, Qatar, and the UAE. That starts tomorrow. Axios reporting that the president is seeking $1 trillion in deals during this trip. For more, let's go to Bloomberg's Jomana Bersecci in Dubai. Jomana, great to see you this morning. What are we expecting from the president in the Middle East?
Yeah, so I'm here in Riyadh, and we're going to be covering for Bloomberg Television for the rest of this week. It is a really significant visit, and not least because it is Trump's first major overseas visit. He's going to be landing in Saudi Arabia tomorrow morning. After that, we'll be continuing his trip to Qatar and then later on to UAE. But as you were saying, the focus of this trip seems to be around business and deal making, and perhaps less on geopolitical breakthroughs and peacemaking is what some people are calling it. And we got some hints of that by some of the measures that were reported last week, namely that the U.S. are looking to perhaps loosen restrictions on sovereign wealth funds investing into the U.S., fast-tracking some of those investments. Expectations are high in terms of some of the headline figures. Remember, President Trump and the Crown Prince Mohammed bin Salman had a call very close to his inauguration where the Crown Prince pledged to invest $400 billion into the U.S. over the next few years, $600 billion rather, over the next 4 years. President Trump retorted that he would like to see that number revised upwards to $1 trillion. So yes, definitely there's going to be a goal on his part to get to those big headline figures. But where are we going to see the deals? We're hearing potentially on critical minerals, on a defense deal. There was reports of perhaps a $100 billion weapons and arms deal that's going to be signed between Saudi and the U.S. Artificial intelligence. We know that Saudi Arabia and UAE have been pushing for looser restrictions in terms of the chips that they can get access to. And then of note as well, there is a U.S.-Saudi business investment forum taking place tomorrow with the likes of Larry Fink and Jane Fraser attending alongside other huge newsmakers as well. So we will be paying close attention to some of those big headline deals that will be coming through.
A lot of possibilities to come out of this, Jomana, and already the media seems to be whipped into a frenzy from an ABC report that Trump would be accepting a luxury jet from Qatar to redo Air Force One, a Boeing 747-8 jumbo jet. Jomana, what are the details we understand about this deal?
Yeah, well, President Trump actually confirmed that the discussions are taking place because he posted about it on Truth Social with the caption, "Free gift." But of course, there are major legal and ethical considerations to think about here, not least because the president cannot accept such a substantial gift. And here we're talking about the value of a plane that's around $400 million worth as a gift from a foreign government without congressional approval. And so the fact that he is even considering acting on this unilaterally raises some serious ethical and legal considerations, which has prompted much of the reaction that we're seeing from across the aisle within the U.S. But the Qataris media attaché to the U.S. has said that nothing has been agreed yet. It's still part of a conversation. Perhaps they're thinking of loaning it only to the U.S., but still raises questions about conflict of interest and all of the business deals that Trump organization is looking to get done over the course of the next few weeks as well.
Jomana, really looking forward to your coverage throughout the rest of the week. That is Jomana Bersecci in Riyadh. All right, back to a check on your markets this morning because we are now at the highs of the future session. S&P 500 futures up close to 3%. I should point out Russell 2000 futures up 4.3%. So a lot of that fear being priced out, even though yields are moving higher. That's usually not a trade you see happen at the same time. Yields are moving higher by nearly 6 basis points for your 10-year yield. The dollar strengthens versus most assets. Coming up, we're going to set you up for your week CPI data. Chair Powell remarks, a lot to keep track of. We'll help you do it here on your Bloomberg Brief.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Sorry, but you still have a full week to get through. So much news, and it's not even 6 a.m. here in New York, but let's get you set up for that week. President Trump will be heading to the Middle East, visiting Saudi Arabia, Qatar, and the UAE. We'll also get the latest read on U.S. inflation. CPI comes tomorrow. Plus, Fed Chair Jerome Powell will be delivering remarks on Thursday. And now to that news this morning, a major de-escalation. Tariffs move to 30% for the U.S. on China, 10% the other way around. Look at what equity markets are doing. We are off to the races for Russell 2000 futures, vastly outperforming, up about 4 1/3%. For your S&P 500 futures session, we are up just under 3%. We're now at the highest level since March. Your bond market 10-year yields, those are at the highest since 1 month as well, too. A major repricing. Surveillance will carry the details forward for you. This has been your Bloomberg Brief.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Any kind of whiff of positive news around trade talks that could propel us a bit higher?
Just starting these conversations is going to be the #1 priority.
You need these trade deals done pretty quickly, because if not, the uncertainty shock hits the economy.
Starting the dialogue is the most important thing.
People need to start focusing on is where are we going to end up? What is that effective tariff rate that we're going to settle at?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday with a major de-escalation.
We have an agreement on a 90-day pause. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling. And what had occurred with these very high tariffs, the equivalent of an embargo, and neither side wants that.
The US and China ending an effective trade embargo, striking a 90-day agreement to slash levies on each other. The truce surpassing investor expectations, sending equities higher worldwide and fueling a bounce in the US dollar. We're kicking off a brand new trading week with a surprise agreement.
And here's the question. How much more does this signal about how the process is going to continue? This is a significant and much bigger than expected dialing back of tariffs. What have we learned? Number one, Scott Bessent seems to be in charge, which seems to be a good thing for markets. Second of all, that 90-day time frame might just be a start in terms of the delays, given the fact that Scott Bessent said that things could continue beyond that as long as talks are constructive, John.
So the good news, Bramo, here is that the worst of the trade talks might be behind us. The worst of the tension might be behind us. The worst of the data might still be in front of us, and trying to process what the data looks like in the coming weeks and months is still going to be tremendously difficult.
It is going to be incredibly messy given the fact that there's a whole pull forward type of mechanism here and that it takes a long time for some of this data to show up. Let's take CPI, for example, which we're going to get tomorrow. The last time around, it took 2 months for the washing machine increase in terms of pricing to hit CPI data. Will it be faster this time given the scope of potential items affected, and how much can people look through the mess of the pull forward demand and some of the other disruptions that we're seeing in the short term in markets?
CPI on Tuesday, then on to retail sales on Thursday. Chairman Powell on Thursday. Also on Thursday, earnings from Walmart. These retailers that have had to position their inventory going into this mess, all of a sudden you get a double dose of front loading. All of a sudden, everyone's going out there scrambling to secure imports from China.
So this is going to be, I think, the event of the week, potentially. How Walmart is dealing with this, as well as how they're potentially passing along those price increases or not to their consumers. Remember, Walmart came out and said they want to compete on price. They don't want to compete necessarily when it comes to anything else, which means they are going to absorb it in their margins. And maybe we'll get a better sense of just whether it's margin absorption or passing along that we get from a corporate response to some of these tariffs.
Equities bouncing hard so far this morning. Good morning to you all. Up on the S&P, on the NASDAQ, on the Russell, big time. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock. As US-China trade tensions cool off, we'll catch up with the former Trump White House trade official Kate Kalukowicz, and we'll catch up with Torsten Slok of Apollo, ahead of key inflation data. We begin this hour with stocks rising as the US and China agree to lower tariffs for 90 days. Bloomberg's Tyler Kendall joins us from Washington for more. Good morning, Tyler Kendall. What a weekend and what a result this Monday morning.
Yeah, hey, John, good morning. Well, a major reduction in tariffs designed to give both sides time here to reduce those trade tensions. The pause will go into effect by this Wednesday, May 14th. And to reiterate, the U.S. is set to lower tariffs down to 30%. That appears to be that 10% baseline so-called reciprocal tariff stacked on top of a 20% tariff that's been in place over fentanyl concerns, while China is set to lower its rates down to 10%. And both sides really seem to tout the fact that they had created this mechanism mechanism to further talks and prevent other escalation, which really just reminds us that at the end of the day, they need to further these talks, and trade talks do take time. Now, the USTR Jamison Greer appeared to suggest that differences between the U.S. and China weren't as large as previously thought, but we do know that those differences are pretty wide-ranging. He said that he felt that progress could be made on fentanyl, and the Treasury Secretary Scott Bessent said that purchase agreements will likely be part of any finalized deal. Plus, we had China release a statement saying that they are set to reduce or suspend any non-tariff countermeasures, likely referring to some additional export curbs that they've put on critical minerals since April 2nd. But, John, those are just a few examples of those differences that do need to be addressed. And when the Treasury Secretary was asked directly by Bloomberg News, what will it take to prevent the tariffs from going up after these 90 days, he said, as long as there's good dialogue, they'll continue to move forward.
Tyler, that's a pretty low bar. We'll catch up with you a few times this morning, but just a quick question from me. What would it take to get a meeting at the leadership level? Was that discussed over the weekend?
Well, President Trump said that depending on what Treasury Secretary Scott Bessent advises him to do, he would be willing to hold a call with Xi Jinping. We know that he has previously extended that invitation. That used to be what that watermark was in order to jumpstart these talks, that the White House wanted to hear directly from Xi Jinping himself. Call up President Trump like we've seen other leaders do in the past. At this point, it really does remain to be seen the joint statement, a rare joint statement, in fact, that we got from the U.S. and China really seemed to make clear that it's Treasury Secretary Scott Bessent who's leading the U.S.'s path forward here.
Tyler Kendall with the latest. Here's the latest in big tech. If you check out the pre-market, a few big movers, the likes of Apple, Amazon, NVIDIA. I want to pick up on Apple. Apple right now, report from the Wall Street Journal. Apple mulling raising iPhone prices without blaming tariffs. Now, Bram, I wonder what happens here, because there's no direct assertion here that this is about tariffs, but ultimately people might read between the lines and say this is probably about tariffs.
You think? Maybe? I mean, this basically is what a lot of people have been expecting, that as soon as there is some sort of realization of the lack of shipments coming here, that Apple in particular is going to be singularly identified and subject to having to increase their prices. This is going to be tricky. How much does Donald Trump use this as an example to jawbone them down, given the fact that in the past he has said the American people are not going to see these prices increase, and this was the running platform for him heading into this election. So this is going to be a real test on both sides.
Apple higher in the pre-market by 7%. One of the stocks to watch this morning, one of many. Here's the view on Wall Street so far. Russ Kostrick of BlackRock writing the following: the stabilization in equities and other risky assets makes sense based on A, some progress in trade negotiations, and B, generally supportive economic data and earnings. Russ Kostrick of BlackRock joins us now for more. Russ, we've got this odd tug of war, this short-term reaction to the progress we're making in trade talks, real progress between the US and China, and then long-term, just realizing the tariffs are higher now than they were at the start of the year, and that could be disruptive for growth in the future. How do you weight one versus the other?
Well, good morning, Jonathan. You know, it's funny, whatever you write 2-3 days ago probably is stale, given the pace at which headlines are coming out. But I think you're right. I think we are in a tug of war. Obviously, this morning we got some very good news. It reduces the risk that we're going to see a serious economic contraction. It reduces some of the uncertainty. It reduces some of that left tail. Having said that, we still have to contend with a few things. One of which is there's still uncertainty. The second of which is how much did the previous disruption hurt economic activity, whether it was at the consumer level or at the corporate level. And third, and again, valuations are not the best short-term timing tool, dealing with the fact that even with the pullback we had earlier in the year, S&P's back to trading at 21 times future earnings. That's a big number given all the other things going on. So I do think it's a tug of war. I think we're still in a range, although that range is probably higher on the upside and lower on the downside than it was on Friday.
Did we learn anything, Russ, that makes you materially change your allocation given some of the uncertainty that remains out there?
I don't think we would change our allocation. I mean, a lot of the themes we were thinking about on Friday are still in place. You know, one of the things that we were looking at that I do think is going to probably work in the back half of the year, you know, we had that big rotation earlier in 2025. Everyone piled into defensive parts of the market, whether it were staples, utilities. I don't think that was right. And that really made sense only if you expected a recession. To the extent the odds of that are lower, we're probably going to muddle along with the economy. I do think some of the large mega cap tech names that struggled earlier in the year can actually do well in an environment in which growth is okay, rates are contained, And many of these big themes that we were all talking about back in 2024, they're still very much in place. So that's one area of the market I do think is a place to be in the back half of the year.
It looks like a lot of people agree with you, Russ, because it looks like we're entering something of a bull market in big tech, possibly up 20% from the trough on April 8th. So you can see this kind of knee-jerk reaction. When you take a look at what's changed, what's not back to that pre-April 2nd relationship of markets, it's the dollar. The dollar is still not completely back to where it was, and it raises a question, has anything materially changed since Liberation Day, given the fact that we are seeing a walking back of a lot of those tariffs? How much is the dollar fundamentally and structurally in a different place today than April 2nd, even with some of the ratcheting back of tensions?
Well, I think there's definitely more uncertainty. And you've got to ask the question, are we going to see some diversification out of dollar-based assets from international investors? And I think that's still very much an open question, given the fact that trade is going to look different going forward than it did, 2, 3, 5, 10 years ago. Having said that, it's interesting. There's been a lot of agonizing about the dollar, and I think that's right. But having said that, the dollar has basically been in a range mostly between about 100 and 110 in the DXY. It was down at the lows around 11, 12%. We had seen similar pullbacks in the last 5 years, even without these generational or potentially generational shifts in trade. So I think the outcome on the dollar is still very much a question mark. And we may not know that for a period of time as we start to see how international investors really are behaving.
Russ, in some ways, it's part of the same question. How to manage your exposure to U.S. Treasuries. What have you and the team done? Has anything changed for you guys over the past few weeks? And would it flip back based on the discussions we heard over the weekend?
So, Jonathan, it's really interesting. Our duration position has not changed much this year, despite all of the volatility. We've been slightly underweight our benchmark in duration. Most of that is on the long end of the curve. As we've spoken about in the past, we do like credit. And I think that's still probably about right. We've seen that back up in yields this morning. So I think, as of now, that positioning seems to be about where we want to be. But it's worth keeping in mind, even before we started talking about the dollar and we started talking about whether or not international investors would abandon the dollar, there were those concerns about supply, that concern about the deficit, about whether or not that was going to have some negative impact on the long end of the curve through the term premium. Those concerns are still there. So I do think while we are closer to benchmark, a little bit of an underweight on the long end probably still makes sense.
Those concerns, Russ, as you know, are pretty durable. They're not going anywhere. The big question was whether international investors would be willing to finance that deficit or whether we would need one or the other or a combination of the two, which is a weaker dollar or higher bond yields. Do you think we've settled some of those issues or do they remain as well?
No, I think they remain. I think it's certainly too early to declare all clear. And I think a little bit of caution, particularly given the fact that we do have those structural deficits, you're exactly right. And the term premium is not so high that you're being generously compensated to go out on the curve and take that risk. The other point is, do you really need to? Rick Reeder has spoken about this on many occasions. If you have an environment where credit spreads are maybe not great, but the absolute yield you can generate on a high-quality credit portfolio is 6 or 7%, do you really need to take a risk going out to 10-year on the U.S. Treasury? Maybe not.
Hey, Russ, appreciate your time. As always, it's going to be another busy week. Russ Kostrick there of BlackRock. Russ, thank you. Want to go back to big tech. Check out Apple, Amazon, NVIDIA in the pre-market. And let's sit on Apple. A story dropping just moments ago. Apple up in the pre-market by 5, 6, 7% now in early trading. This from the Journal just moments ago, if you're just joining us. Apple considering raising iPhone prices.
When you take a look at the details of the story, one thing that stands out is Apple found what Walmart found, which is they cannot just make up for any increase in tariffs by job-owning suppliers to lower their prices. They have to either take a margin hit or they have to raise prices. They're opting to raise prices to preserve margins. If they don't raise prices, their margins will take a hit. There is a bigger question here. Let's say 30% is the new normal. How much does that also impede the profitability of some of these companies that highly rely on China for both manufacturing as well well as for sales.
The new normal seems to change from week to week at the moment. The new normal apparently is 30% after it was 145% just a few days ago.
So if this is the new normal for 90 days, then maybe another 90 days, how much of a hit is that? That's manageable. It's not a trade embargo, but at the same time, how do you price that in, and does it warrant the same levels that you saw before April 2nd? And that, I think, is going to be an increasingly big discussion.
Apple up in the pre-market by 6.8%. Futures this morning on the S&P higher by 2.9%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Starting with the major story of the day, the U.S. and China have agreed to temporarily lower tariffs on each other's products for the next 90 days. The U.S. reducing its levies from 145% to 30%, and China dropping its duties from 125% to 10%. Treasury Secretary Scott Bessent saying, quote, neither side wants to decouple. Meanwhile, Ukraine's Volodymyr Zelensky is set to meet with Russia's Vladimir Putin in Istanbul on May 15th for direct negotiations. The meeting is conditional on Russia beginning a 30-day ceasefire today, with European allies threatening to increase sanctions if Putin refuses. And the Trump administration is likely to accept a luxury Boeing 747-8 jumbo jet from Qatar's royal family to be used as Air Force One. ABC News is reporting the gift is expected to be announced this week when Trump visits Qatar. The president appeared to confirm the gift, calling it a very public and transparent transaction. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, a major de-escalation.
We have reached an agreement on a 90-day pause. Neither side wants a decoupling.
The Treasury Secretary saying all the right things earlier on this morning in Geneva, Switzerland. Equity futures up by 2.8%. Up next, the former Trump White House trade official Kate Kalukowicz, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
A 90-day truce between the US and China unleashing a major rally worldwide. Equity futures on the S&P up nicely. These movers in the pre-market, the ones to watch. Apple, Amazon, Nvidia, big tech is rallying and rallying big time. Apple up by 6.8%. Amazon up by 8 percentage points. And the outperformance this morning on the NASDAQ 100. Check out the S&P, the NASDAQ 100 and the Russell. On the NASDAQ 100 up by 3.8%. And the additional outperformance coming from the Russell The Russell up by 4.6%. Go over to the bond market, 2-year, 10-year, 30-year, unlocking higher yields across the curve, particularly at the front end of the curve, as once again we reassess rate cut bets from the Federal Reserve. The 2-year up 10 basis points to 399.56. And off the back of those moves, this move in foreign exchange, potentially the worst day for the euro, going all the way back to the day after the election. Euro dollar positive here by a roundabout, or rather negative on euro dollar by 1.4%, at least at a 110.96 on euro dollar this morning.
It is fascinating to see how much of a whipsaw this is. There is a just market structure aspect to this, how many people had piled into the sort of long euro trade. But when you take a step back, this reassesses kind of the whole narrative that we've seen so far, where suddenly the U.S. is decoupling from the rest of the world. The U.S. is going to get hit hardest. How much does this have legs, though? Because the dollar is not yet back to where we were before April 2nd.
How sustainable is all of this? My head is absolutely spinning, and I'm sure yours is too. Under Savannah's this morning, a major de-escalation.
We have reached an agreement on a 90-day pause, substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling.
So here's the latest this morning. The US and China are agreeing to a 90-day cooling off period. The US reducing its levies on Chinese imports from 145% to 30%, while China cuts duties on US goods from 125 to 10. Joining us now is the former Trump White House trade official, Kate Kalukowicz. Kate, welcome back to the program. It was a surprise, not the direction of travel, but the number we landed on. And there was something that stuck out for me over the weekend, hearing from USTR rep Jamieson Greer. Greer turned around and said, when we walked into the room, the differences weren't as great as we thought they would be. How big do you think the differences actually are between these two sides?
Well, you know, it's hard to unpack what we're dealing with here. On one hand, you have this enormous escalation in tariffs. So I think both sides probably walked into that room with the same goal in mind, which was to find some way to provide an off-ramp for those tariffs. So I am not surprised to hear that both sides entered the room with some significant goals in mind, and that was to bring the tariffs down.
And the tariffs are down, and now we have a 90-day pause. And we're all trying to work out, Kate, what happens after 90 days, because you know what happened last time around. You were living it. This took 18 months. Can this be resolved in 90 days?
Well, remember last time during the first Trump administration, we had months and months of a domestic investigation, which led to a number of demands from the U.S. side around forced technology transfer, you know, this intellectual property theft that was going on, openings in key services and goods export markets. Here, we've just had the tariffs go up and up and up with very few clues as to what the Trump administration is seeking to address here, besides what they call balanced trade. So for me, it's still an open question as to what we're hoping to achieve here.
How much does it really surprise you, Kate, that we saw heading into the weekend, President Trump put out on Truth Social, that 80% seemed about right, but it's up to Scott B. Scott B comes out and says 30% sounds better, and that's what we're going to stick with. How much reliance can we put into the 30% number if it's not coming from the president? And what do you make of this sort of mismatch?
Well, on one hand, it shows that the president has tremendous trust in Secretary Bessent, which I think is a great signal. It's a great signal for him as he walks into these talks. And so I see that as an optimistic sign. I feel pretty comfortable that we're at this 30% for at least 90 days. You know, Secretary Bessent has been pushing for additional time on this and the other trade negotiations that he's leading. So I feel fairly confident that this is the number that we're going to be at for a while.
How much is this the roadmap ahead for others that have to get some sort of deal done? And I'm talking about Japan. I'm talking about the European Union. I'm talking about nations that traditionally have been allies of the United States that seem to be having a harder time even coming to the table to ratchet down some of the tensions as they are currently.
Well, you know, even amongst this backdrop, it's hard to remember. Less than a week ago, the president announced a trade deal with the United Kingdom, which was quite important in the signals that it sent to these other countries. I would argue the UK deal perhaps means more to countries like Japan and Korea and others that are seemingly close. The China deal, though, of course, puts other countries on notice that the president is serious about deals. He's serious about moving forward. And so I think this may incentivize other nations nations to quickly get their deals in hand.
Okay, I can't decide whether this is good news or bad news for Europe. Europe specifically. What do you think it means for the EU?
Well, you know, the last time we spoke about how difficult transatlantic relations are, and I think they continue to be very difficult. The European Union, as you know, one of the true believers in the multilateral trading system, does not like this notion of balanced trade, which is what language came out of Switzerland this weekend. They're really going to continue, I think, to struggle with how they negotiate with the United States, what this, you know, significantly less pressure on the U.S.-China relationship means for them globally. And so I think they're going to have to meet in Brussels and figure out their next steps after this last trip to Washington.
Okay, it looks like the direction of travel between the US and China is to revisit the purchase agreements that we struck all those years ago. Can the Europeans actually do the same thing in practice?
Well, you know, there are some purchases I think Europe is looking to make, particularly in the military sector, that would represent a significant go in the direction of where President Trump would like to be, and also satisfy some of the European Union's goals as well. But I don't think purchases alone are going to satisfy the president when it comes to the transatlantic relationship. There are years and years of non-tariff barriers, these regulatory challenges that have posed significant problems for U.S. companies, and I think the president wants to see some wins there.
Okay, appreciate it as always. What a weekend, what a morning. The former Trump White House trade official, Kate Kalukowicz there. Got two options here, Lisa. Here's option one. This sets the tone for deals. It's good news for the Europeans. Option two, they need to make an example of somebody and go hard on somebody, because right now they haven't really got hard on anybody.
Well, that's exactly what I was thinking about this morning. Who are the allies and who are the non-allies, and exactly how different is it who you debate with and who you sort of take a harder line with? Right now, the fact that we're talking about VAT taxes as the ultimate barrier, the non-tariff barrier between the United States and Europe, shows how thorny this is going to be to resolve. Do you really think that each independent district is going to remove or change their VAT taxes, which is a major revenue source and is legislated, in order to appease Trump? Can they even do that logistically?
I think it's fair to say the Europeans are at the front of the line based on what we've seen over the past few days.
That's a direct answer.
That's at least one takeaway. Up next on the program, we'll be catching up with Hugh Van Steenis of Oliver Wyman on the potential end of U.S. hyper-exceptionalism. Live from New York City this morning, you're watching Bloomberg TV.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What a start to the week. Tariffs were 145 on China, now just 30%. Just 30%, nothing. Equity futures on the S&P 500 positive by 3% on the S&P 500. On the Nasdaq up by 3.9. On the Russell up by 4.5. With 3 hours until the opening bell. Many movers out there with your morning movers. Here's Danny Berger. Hey, Danny.
There's a lot, John, and you'll be hard-pressed to find something that isn't moving to the upside, but it is the Mag 7 that is outperforming this morning. Apple among them. Those shares up 6.8% this morning. Dan Ives calling it the best-case scenario for the tech bulls, but another story to contend with this morning, the Journal reporting that Apple intends or is at least contemplating raising their prices, but not tying it to tariffs, or at least trying not to make it look like that, tying it to various feature launches. Also moving to the upside, a lot of consumer names. I've chose Nike to put up here, up nearly 7%, but you could look at Lulu, Target, all of them putting in similar work this morning with supply chains exposed. How much relief does this bring them? Ryan Peterson of Flexport saying, expect a shipping boom over the next 90 days. How much are these companies going to move to try to get inventory in for what comes after 90 days? Now, I said you'd be hard-pressed to find something that's moving to the downside. Well, there is one sector that is clearly doing that, and it is pharma. Trump, over the weekend on Truth Social, saying that he would look at trying to lower drug pricing, signing an executive order. We're expecting that this morning, lowering them between 30 and 80% by matching nations that have the lowest prices. Questions as to how that would work, but for the moment, you can see the reaction. Some of these pharma companies down as much as 3.6%, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, our top story, the US and China striking a 90-day agreement to slash tariffs on one another. The US cutting levies to 30% and China reducing its duties to 10 following talks in Switzerland over the weekend.
So what have we learned? Because it's been kind of whack-a-mole, right? And this is a huge shift in the potential levies on China and on the United States. We still don't know what the ultimate goal is. However, what we have learned, first of all, is that what Donald Trump says sometimes can be taken literally, sometimes can be taken seriously, and that 80% level was something to be taken seriously, but maybe not literally. The fact that there can be a 90-day delay that is potentially extendable, only with simply good faith talks ongoing, highlights what could be the road of travel for the other potential major trading partners with the U.S.
I think we learned something quite simple. Both saw this as unsustainable. They'd already said that. What was surprising was the extent to which they saw it as unsustainable and brought tariffs down as much as they have done. Point one. Point two would be, I think this is where things get interesting. What is the actual ask? What do we want from either side? What does either side want from us? Because at the moment, I don't think those asks were really made over the weekend. This is about getting them down, getting to a place where the Chinese want it to be, where you can get to the leadership level of talks further down the road. And I don't think we're anywhere near that just yet.
To your point, the fentanyl tariff's still on. To your point, not a lot of clarity when it comes to some of the chip reductions and potential barriers to export chips to China. Not a lot of discussion about some of the other potential grievances. Nonetheless, they are negotiating, and a lot of people are saying that alone is a great thing, just putting aside the fact that 30% is quite considerably higher than it was, say, 2 months ago.
Yeah, the bar was low going into the weekend, let's put it that way. The hard work starts now, not just for China, but for others too, including Japan. Japan's Prime Minister saying the country will not accept a US trade agreement that excludes autos. This is trade negotiations between the two countries are set to accelerate later this month. Japan's chief negotiator saying he's hoping for an agreement in June.
Yeah, saying that they're not going to sacrifice their agriculture industry for the auto industry, and putting forward really the ultimate conundrum for Japan, which is their economy has been slowing. Their economy relies on their auto industry in a massive way, and potentially some of these tariffs could really impede it. It highlights how difficult it's going to be for the United States to take a friendly line with allies at the same time that they're conciliatory talks with China. And it raises a question of what the United States ultimately wants from some of these classic trading partners.
So that's the latest on Japan. Danny mentioned this. If you look across the equity market this morning, most things are trading high with the exception of maybe pharma stocks. The president is planning to sign an executive order at 9 a.m. Eastern time to reduce drug prices, saying drug and pharmaceutical prices will be slashed by 30 to 80%. And here's the quote, Bramo, almost immediately.
So there are a lot of questions here. President Trump, in his first term, tried to do something similar to this, and it was shot down in courts. The expectation is this is probably just going to have to do with pharmaceuticals involved in the Inflation Reduction Act, or maybe Medicaid and Medicare. It's going to be challenged legally, but there is this question of how significantly it will draw down prices. Look, a lot of people have said this is unfair. A lot of people don't think it's fair that the United States should be subsidizing the innovation for the rest of the world in the pharmaceutical industry. Question is, how do you do that without impeding that innovation in the pharmaceutical industry in the United States and frankly and elsewhere? And that, I think, is going to be the big battle in the weeks and months to come.
And this has been the ongoing tension, as you point out, for years and decades. Let's get back to our top story. International investors weighing the impacts of tariff uncertainty, with some potentially turning away from the US over the past few months. Hugh Van Steenis of Oliver Wyman writing the following. Some large international assets owners are weighing trimming US holdings by 5 to 10% from having been max overweight as they fret about whether this is the end of US hyper exceptionalism. Hugh joins us now for more. Hugh, good morning. Good to see you.
Good morning, John, mate.
Big change all over again, so we've got to keep up with all of this. Let's just think about the last month or so, the round-the-world tour that you've done, and can you share with us just to what extent international attitudes to US assets have changed?
Well, look, the shock of the tariff announcements has clearly, weighed upon international investors, and I think they're trying to rebalance their portfolios. But the bottom line for me is they're trying to think through what is a more diversified portfolio from here. So let's take the easy piece first. If you're an international insurer or pension fund, you've got liabilities in your own currency. International investors have been running at the lowest hedge rate for 8 years. European investors, for instance, own 25% of US credit. So they want to keep owning the US credit, but they need to hedge more. So they're probably going to increase the hedge ratio 10 to 20 points. But coming back to the point about then what they might trim, certainly there's this nervousness about should you trim maybe 5 to 10 points of US exposure. I don't think anyone's doing it now. This is more a kind of question of how does this play out? And events like today will clearly weigh on that. But there's also an element about private equity exposures. People feel a little bit too much in private equity and want to get their weight down, again, maybe about 5 points.
Do you see it as a push dynamic, policies in the United States pushing capital out, or a pull dynamic, better policies abroad pulling capital in?
Well, it's a great question. I think particularly in Europe, where there is now this, fiscal stimulus and a need to really invest in rearmament, infrastructure, energy, and so forth, there's a real expectation that European credit could be more interesting. The yield is already wider, and therefore actually the bid is interesting. And I think without the FX risk, it becomes sort of doubly interesting for a European pension fund, European insurer, and quite frankly for a European investor. And I think we're seeing the same in Canada with the Maple 8, where they're also thinking about do they need to support some of the actions of Prime Minister Carney. So I think the pull factors shouldn't be underestimated.
How much are they saying this in conversations because they're angry? And they feel frustrated, and they feel like they want to be heard. And so they say, we're going to sell our U.S. assets, but we haven't done it yet, and we're just looking around the edges. How much is that kind of what you're feeling?
Well, it's a great question, because I think we tried to put this into sort of like a quantitative survey, and no one was then to put numbers behind it. And I think that speaks to the point of good investing, which is you have to make some tactical moves. And clearly there were some people who wanted to get their weight down or reduce their FX exposure. But now it's more about, quarterly committees for strategic asset allocation. No one wants to make intemperate moves. I mean, it's clear that if you go to Canada and France, there is some anti-Americanism brewing, just as there was in the early 70s. So I wouldn't underestimate that as a factor. But I think for most professional investors, they're trying to sort of think through the very short term to what does this mean for the medium term?
Well, when you say that, what does this mean for the medium term? You just noted that a lot of people were looking to trim their exposure in private equity. I find this fascinating because so many people come on this show and talk about how private assets are the way to go to shield you from the volatility of the past couple of months. And you're saying it's the opposite. And that people are saying, actually, we want more transparency and maybe we ought to trim that, especially if there is this volatility and structural changes happening in real time. Is that your takeaway, that actually this could be an asset class that sees quite a bit of volatility, even if it's not priced in real time?
So I think we need to distinguish here between the private equity and private credit. Already coming into this year, public markets have outperformed private equity for the last 3. There was a concern about some of the most recent vintages. And so some of the conversations we've had around, well, can I top slice this a bit? And as maybe the exits have been pushed to the right, and there's real concerns then about, well, maybe I'll recommit, but only when I get the cash flows out. And so as the cash flows get pushed to the right, just simply the maths of it means they're pushed to the right. But as John said, if they then say, well, look, I wouldn't mind then keeping a little bit just behind just to invest domestically. And actually the biggest theme I've picked up is Canadian, European investors wanting local currency-denominated private equity funds, that, or at least hedged asset classes. If that's a thing, that's an area where there's interest. I think on credit, though, there's huge demand for credit still. And I think the polarization of portfolios between ETFs or less liquid, I think the Cambrian explosion of new products here I still think is very interesting.
So I'm the journalist. I'll come up with a catchy headline and you can give me the nuance. The Great Repatriation. How much is in that? A lot of investors just bringing their capital home, seeing the rest of the world is increasingly risky, and bringing that money home and investing domestically.
Well, it's a great headline. That's why you're in the media. I mean, the way I see it is rebalancing rather than exodus. I think it's much more about a rebalancing of portfolios to try and look. The bottom line from this is that investors all want greater diversification in their portfolios. They've rode the dollar strongly. It's been a very virtuous cycle. US has been hyper exceptional. As that somewhat trimmed, I think there's a need to maybe reduce a little bit of the dollar exposure, even if it's just through hedging.
How do you see that, beyond just hedging? Is there a bucket of currencies that you want to get equal exposure to? How are people thinking about that? The universe used to be the dollar's at the epicenter of it and everything revolves around it. What is it now and how is that changing, if at all?
Well, I think this is where we need to distinguish between different types of investors. So if you're, I don't know, a Dutch or a Danish pension fund, then clearly you've got to think about the rules and regs in your jurisdiction and make sure you're not having too big a mismatch. Same with the Taiwanese insurers, obviously, which you were talking about only two weeks ago, or last week. But I think that, I was with a central bank governor in the last 2 weeks as well, thinking about what they're doing. Actually, it's very tricky to think about what the art move is. Actually, gold was the conversation which came up instead.
How many times has that come up around this table? Gold. Not this table, because this is a different table this morning. We're trying to get back to the old table once we fix the studio. Around the old table, how many times has that conversation came up?
So many people love gold. Everyone's saying that it's the ultimate hedge because it's the only currency substitute that doesn't have hair on it and that potentially could be a constant. That said, gold can only take you so far. We were talking about this last night at the dinner table. Do you bake it down into jewelry so you can take it when you escape? I mean, do you have gold bars? I mean, these are the sort
of discussions. What did the teenagers say?
Well, the teenagers were talking about gold bars, and I explained that they're incredibly heavy and that when you try to carry them from Heathrow to the United States in your big suitcase,
it's difficult.
It was really hard. It hurt your back.
So in the 70s, they put Kruger into a briefcase instead, and it was little, it was coins. The coins instead. And actually, the gold vault in Zurich used to be on the main train station, 50 meters from the train station, so people could put it when they came off the flight.
We can share some old stories about that in a moment. Gold's down this morning, by the way. Speaks to this story. We're down about 3.5%. Hugh, it's good to see you, sir. Thank you very much. Hugh Van Steen is there of Oliver Wyman. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Apple shares are rising in the pre-market, up 6.5% after reports it's considering raising prices for its fall iPhone lineup. Sources telling the Wall Street Journal the tech giant does not want to attribute the price hikes to U.S. tariffs on China. Instead, they report Apple will attribute any price increases to new features on the phones. Meanwhile, President Trump heads to the Middle East this week. In the first state visit of his second term, Trump is set to land in Saudi Arabia tomorrow, then visit Qatar and the United Arab Emirates before the end of the week. He's looking to encourage the wealthy Gulf nations to invest in the U.S. And Hamas says it will release 21-year-old Israeli soldier Eden Alexander, the last living American hostage held in Gaza. This comes amid renewed talks between the U.S. and Hamas for a new Gaza ceasefire agreement. Israel's government saying today the release could happen within the next 24 hours. And in a post on Truth Social, President Trump called the developments great news. That's Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, playing down tariff impacts.
Prices are going to stay stable. Don't buy into these economists who are just not in the real world.
We'll talk to someone in the real world in just a moment. Torsten Slock of Apollo, live from New York City. You're watching Bloomberg TV.
Missed it on the China show.
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
Don't miss the China show live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Must-watch conversation coming up in about an hour from now. Don't miss this. The Treasury Secretary, Scott Bessent, live on Bloomberg TV at 7:45 Eastern Time, following a 90-day truce with China that slashes tariffs on either party. That's unleashed a major rally this morning in the equity market. Good morning to you all. On the S&P, on the NASDAQ, on the Russell, we're up by 3% on the S&P. On the NASDAQ, we're up by 3.9. On the Russell this morning, up by almost 5. Under surveillance this morning, playing down tariff impacts.
Prices are going to stay stable once this policy is done. You got to give the president a chance to run it, but over the next 3 months, this policy is going to show trade deal after trade deal, opening markets, reshoring manufacturing, and no tariff charged if you make it in America. Don't buy into these economists who are just not in the real world.
Here's the latest this morning. Investors counting down to US CPI data due out tomorrow and looking for potential impacts from tariffs on prices. Joining us now is Torsten Slock of Apollo. Torsten, good morning.
Morning.
Major agreement over the weekend to absolutely slash tariffs on both the US and on China. Just want your early reaction to that, your first thoughts.
This removes a major tail risk from the economic outlook. And what's most interesting is that of course, means that the growth downside risks that everyone has worried so much about that's coming from no longer having trade between the US and China is just no longer the risk that we thought literally 24 hours ago. So the bottom line is that if we no longer have that risk that was so difficult to quantify, that was so uncertain about how long time it would last, even uncertain about what level of tariffs we were at, we can now look forward and begin to think about what are then the traditional things the Fed worries about, namely inflation, unemployment, and therefore the normal business cycle.
Well, I think everyone noticed then you turned to growth straight away. You said we've removed the growth risk. What about the inflation risks?
Well, that's where Fed pricing at the moment is very interesting. The market is currently not just only pricing 2 cuts. Last week, we were pricing 4 cuts. So it's very clear that by removing this tail risk and this risk of a recession, we now have the market saying, well, maybe the growth outlook is not that bad. And maybe, therefore, yes, inflation will still go up. But if we still have that GDP growth is going to be still okay, at least for now, we may eventually get a tailwind as a result of removing this tail risk.
You just said something that was very important, which is inflation will still go up. What has already been baked in based on the supply chain disruptions to date that you see as prompting inflation to be on an upward trajectory?
That's right, Lisa. That's why the data, including tomorrow, will be more messy and more complex because we still don't know now yet what will be the end result. And if the end result really is 30%, then of course we will have a different outlook for inflation than if we are 145%. So, but the bottom line is still we will see upward pressure on inflation. We will likely also now see some upward pressure on growth. So maybe the discussion is that maybe even 2 cuts from the Fed is pricing in too many cuts. The dot plot is revealing that the next move will be cuts. But who knows, maybe we can now get a confidence gain. If we regain confidence among consumers, if we regain confidence and restore confidence among corporates, and also if we restore confidence among foreigners, those 3 forces could potentially be a tailwind to the growth outlook, which ultimately could mean that the Fed might not even be cutting in September as the market is pricing at the moment.
There's a larger question here, which is ultimately, was the time of potential disruption and tariff hysteria short enough to not have really injected any damage, true damage, to the United States economy? Is that your take on this?
I think that is correct, because think about how businesses plan. You get a shock. If the shock is one day, you say, okay, that came and it went. If the shock is a month or a little bit more, 5-6 weeks, as it was this time around, companies begin to think about, hey, do I look at other opportunities? How do I plan even my workforce? We didn't see jobless claims go up throughout this period, which is very good news. But we definitely saw on the corporate side, when it came to CapEx planning, when it came to new orders, when it came to prices paid, that we've seen some very significant differences. So we now need to see in the market those things begin to reverse to more normal levels. So that's why what really was clear through this episode was that corporates were fully aware of how serious the situation was. Consumers didn't really completely, at least in the data, reflect the seriousness of the situation. So maybe the consumers, which is 70% of GDP, is saving us that they were never really impacted in the significant way that corporates had begun to change their behavior.
So should we just ignore the data for the next several months?
Well, at least the CPI number tomorrow is, of course, going to be much less relevant now that we have this change. But I do think that it's still very important to see, well, maybe companies did plan to say, we're going to raise prices on our goods no matter what, even if tariffs do come down. So that's why we still need to figure out this discussion, as Beth Hammack was saying on Friday at the Hoover Institution conference, namely companies are beginning to say, well, even if I'm not hit directly by tariffs, I'm actually raising prices because some of my competitors are raising prices. So the fear is that if some of this becomes more ingrained, and this is the core of the Fed's problem, then of course it could begin to lift inflation more.
Consumer price tolerance is important here. We've been debating that for the last several months. That debate just doesn't disappear because we've gone from 145% tariffs to 30, does it?
And let's not forget that core CPI today is still 2.8. And if we now just agreed that there is still a lift coming to inflation, well, the lift might not be the 1% that the Yale Budget Lab and the Penn Wharton Budget Model and the Tax Foundation had suggested. But if that lift is still 0.75%, you still have the problem that inflation is not going down towards the Fed's target over the next 6 months. It's actually moving higher, even with a 30% tariff. And that creates a lot of different challenges, including, of course, on rates and the fiscal problems that we used to also talk about.
To build on what John is talking about, there was a theory that actually if tariffs were only raised a little bit, it would be more inflationary because it wouldn't dampen growth enough to offset some of the inflationary pressures. Are you seeing that as a likely reality going forward?
Absolutely, and there's a huge academic literature about the so-called ratchet effect. Once prices go up of something, it's really, really rare that you see them go down. So if we have a ratchet effect, that now we have ratcheted prices up a bit, well, maybe people now have begun to price in, well, maybe I do need, if I'm importing consumer goods from China, maybe I do need to settle for a new situation where prices will just be permanently higher. So the risk is, and some of the daily data also that's been coming out, is that imports from China of goods has seen also higher price increases. So maybe the worry you can have is that exactly there's a ratchet effect in inflation, and inflation now be more sticky, and therefore, again, rates will remain higher for longer.
If there hasn't been any permanent damage done to the economy, there's this larger question of what has changed, right? Other than the fact that we do have higher tariffs, what has changed in the past some days since April 2nd? And there's a real question about the dollar. There's a real question about treasuries and whether there's been structural damage done to the haven status. Do you think that that's the case, or do you think that this too is a genie that has been put back in the bottle?
The key now is restoring confidence. Confidence among consumers, restoring confidence among firms, and restore confidence among foreigners. Because foreigners, of course, have also looked at this somewhat turbulent episode and begun to think about, well, what are the consequences of this? Is this permanent? Is this only this week? Is it also next week? And that high elevated level of uncertainty has been a problem literally for any economic agent, domestic, consumers, corporates, and also foreigners. So to your question, Lisa, I think the bottom line is we need now a period of calm, and where it's very clear where the period is ahead of us, what we need to see, namely restoring of confidence for both consumers, corporates, and foreigners.
And nobody can guarantee you a period of calm at all for this year or beyond that. Torsten, it's question time for the Treasury Secretary in 50 minutes' time. What would you like to hear from Secretary Bessent at 7:45 Eastern Time?
Well, of course, what's very, very important now is that if there is really 90 days coming, I know we have other 90 days until the 8th of July for the remaining countries, but if there is now a period of calm ahead of us, that means that businesses can begin to plan. Businesses can begin to look ahead again and say it's less cloudy than what it was just a few days ago. And I do think that that becomes very important. And the second thing I would also ask about is, well, now we suddenly have this discussion of, well, maybe rates are not going to come down as much, definitely not in the front end, and maybe in the long end, the term premium has also been going up. That brings back the discussion of the fiscal situation and fiscal sustainability, which was less of an issue for the last several weeks, but is now becoming an issue again because now there's more upward pressure on rates, and that creates all these challenges about where on the curve is the T-back issuing and all the things that come around what is fiscal sustainability doing.
Torsten, it's good to see you.
Thank you.
And we will be talking about fiscal sustainability not before too long, that's for sure. Torsten Slok there of Apollo. Lisa, we've got to talk about it. 7:45 Eastern Time, the Treasury Secretary Scott Bessent joining us on Bloomberg TV. Lots to ask about. A lot of people believe framing matters. How do you frame this? Do you frame it where we are relative to where we were on Friday, or where we are relative to where we were at the start of the year? Because the tariff story, explained that way, is very different.
And how do you explain where this is in the journey to what end, right? We still don't really understand exactly what the goal is. If both sides are saying that they agree they don't want a decoupling, what do they want? Sustainable investment, sustainable transactions? Do they want some sort of concession from China's side with respect to chips? These are the types of discussion points that are important to unpack.
Equity futures absolutely flying early this morning. Up next, the second hour of Bloomberg Surveillance. We'll catch up with Kevin Gordon of Charles Schwab, Henrietta Trays of Vader Partners, Jill Carey Hall of Bank of America, and the U.S. Treasury Secretary, Scott Bessent, live from New York. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for VVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Markets, I think for now, we're in this holding pattern.
Now we're at least getting to some sort of balance, but still definitely a lot more wood to chop ahead.
We're definitely past peak uncertainty, but it doesn't mean we're past peak negativity.
The American exceptionalism trade lives on.
The balance of power and trade remains here. I'm not moving away from kind of the U.S. exceptionalism argument.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, good morning to you all. The second hour of Bloomberg Surveillance starts right now as we secure a 90-day truce between the US and China, leading to an aggressive cut in tariffs on either party, unleashing a massive rally in this equity market. On the S&P 500, equity futures higher, on the NASDAQ up, on the Russell up by almost 5% on the Russell 2000. This unlocks higher bond yields across the curve on a 2-year, 10-year, and 30-year. Torsten Slock of Apollo saying this aggressively removes recession risk. In the bond market, that means yields are up by 12 basis points on a 2-year, back through 4%. And with yields up like that, expect the euro down like this. Euro dollar negative by 1.5%, the biggest move lower potentially since the day after the election. Euro dollar 110.78. That's the market set up. Plenty of questions for the Treasury Secretary later on this morning. We'll have that conversation with him. 7:45 Eastern Time. Bloomberg Surveillance and the Treasury Secretary of the United States, Lisa Scott Besson.
Yeah, there are a lot of questions about exactly what the path forward is. Right now, markets are removing that tail risk to pick up on what Torsten Slock was saying. 2-year yields now effectively removing, and Fed funds futures removing 2 Fed rate cuts for this year. So only 2 rate cuts getting priced in currently as people take some of the worst case scenarios off the table now. For Treasury Secretary Scott Besson, the question really remains, how sticky is this? How much can that 90
90-day sort of pause as they negotiate this with 30% tariffs on China. How long can that continue? To 180 days, to 360 days? And is this the new ceiling? Are we seeing that the ceiling is at 30% and the floor is at 10% and everything else is going to be the negotiating ground?
The good news is no longer 145, it's 30. The bad news is it's 30 and not what it used to be. And the framing, I think, matters here. What is more important to you? I think from the market seat, what's more important to you is where tariffs were on Friday. From the economist seat, I think it matters that tariffs are going to be materially higher still than where they were at the start of the year.
Which is a reason why Torsten Slok emphasized that there's this ratcheting up theory in economics, where if you actually increase tariffs just a bit, or not just a bit, 30% is more than just a bit, but not necessarily to a full trade embargo, it actually is more inflationary because people can absorb those price increases and it doesn't necessarily torpedo growth in the same way. So how much does this structurally increase inflationary expectations, even if it's not the worst case scenario?
Session highs in the equity market, the S&P 500 higher by 3.2%. Coming up this hour, we'll catch up with Kevin Gordon of Charles Schwab as a risk-on mood returns to markets. Henrietta Trays of Veda Partners on a major US-China trade breakthrough, and Jill Carey-Hall of Bank of America on why she's still cautious on small caps. We begin this hour with stocks higher as investors rush back into equities on the heels of a US-China trade deal. Kevin Gordon of Charles Schwab writing the following: the best-case scenario mostly unfolded. That said, as we're going to learn from other countries, it will likely take a while for meaningful trade deals to form. Kevin joins us now for more. Kevin, good morning.
Morning. Nice to see you.
It's a much bigger move than we expected going into the weekend. How important is this move to you?
I think it's important, well, clearly the market's treating it in a behavioral sense. This is sort of classic behavioral economics where you're coming down from, an insane triple-digit percentage tariff rate to something that is, obviously less aggressive, less extreme. But if you were to just take 30% in isolation, to your point, that's still pretty high. It's still a pretty meaningful shock. But I think to the point around what was mentioned in some of the press releases from the weekend, what I found most fascinating was that they're still pointing to, U.S. trade officials are still pointing to the trade deficit as some sort of national emergency. So I wonder if that's going to be still the cornerstone of all the negotiations, not just for China, but for all the other countries that we're trying to do trade deals with. If that's still going to be the cornerstone, I wonder if that's going to be, a pretty big block in front of us in trying to get to some sort of agreement. Because we have to keep in mind, this is just a framework for getting to some sort of talk, to get to some sort of deal, to maybe get to some sort of form of purchase agreement. So that's a long process, and I think that sequencing is really important to keep in mind.
We're going to have to do some hand signals now, okay? You're going to have to work with me. Soft data is down here.
Yes.
Hard data is up here. How do the two reconcile in the weeks to come? Clearly soft comes up. Yeah. What does the hard data do? And do we ignore it?
I'm not so sure. I mean, clearly anything can happen between now and the next few weeks in terms of what goes on with other countries, but I'm not so sure we can expect this massive jump in the soft data, especially because I think what was driving a lot of the weakness in the soft data was just this huge cloud of uncertainty in terms of tariffs being this moving target. That's still the case. Tariffs are a moving target. For China, tariffs are a moving target clearly for the rest of the world, even if you look at the agreement to have some sort of discussion with the UK. There's still that 10% baseline, but there's now going to be some, adjustments around even things like autos after you get to the first 100,000 imports of cars for the UK, so on and so forth. So I think that, and not knowing the firm established rules of the game for companies, at least in the United States, that to me is actually what has depressed the soft data, probably what keeps it a little bit in this kind of muddle through or stasis scenario. I don't see any miraculous resumption until you get a firm, sort of setting of what the actual tariff rate is and what the actual rules of the game are.
That said, have we taken the worst case scenario off the table?
I think, near-term recession risk-wise, what your discussion with Torsten shortly, just a bit ago, I think you've probably taken that off for now. I think, but going forward, if you were to, again, look at this, let's say by the end of the year you get to some sort of established framework for what the baseline is going to be for the rest of the world and then what the baseline is going to be for China. You're still presumably looking at a pretty aggressive increase in the average tariff rate for the U.S. So if you were to just take that, it is still a meaningful supply shock to the economy, but from there, we have to start to work in what the effects are to the economy, but also, to the point you were making at the opening of the show, what is the effect on inflation? How much are companies able to pass this on? Presumably a little bit more so if you're going to have a lower tariff rate, that consumers can maybe digest more, but that also hinges on the labor market staying in a relatively healthy spot.
I was looking at the Apple Supermax Pro ultra thin product that's going to be released this fall, and they're considering potentially raising tariffs, raising prices on their goods without mentioning tariffs in order to not take it on their margins. I just wonder if stocks are more insulated than bonds right now, given the dynamic you just explained, that potentially we're not going to go into recession, which means that pricing power might be a little bit better, but inflation concerns still very much front and center.
Yeah, I don't know if they're as well insulated, just because if you look at inflation at this part of the cycle versus what we experienced a couple of years ago, I mean, the inflation surge that we had in 22 into 23, I mean, that was aggressive, but it was also happening at the same time that the labor market was rebounding in a pretty considerable fashion. We don't have that kind of labor market rebound this time. And I would argue one of the main differences now, and you're already starting to see it in some of the data, especially in the tourism sector for the U.S., the services risk, I think, is pretty real at this point in terms of our hit to demand for services here in the United States. And there's often so much focus, whether it's from the trade side of things in the administration or whether it's from analysts and strategists on Wall Street, there's so much focus on the goods deficit. The services surplus that we have with most of the world rarely gets a lot of attention. And I think any potential hit and reduction to services demand here definitely puts us at risk economically because it's a larger part of the economy, but also because so much of the labor rebound has been in the services part of the economy. So if you have more of a risk there, even though everything maybe seemingly comes down temperature-wise on the goods side, I think you have to pay attention, at least as much, if not more, to services.
It sounds like you don't agree completely with Torsten Slok that there wasn't any damage done since April 2nd. Is that correct?
Oh, no, I think there was certainly damage from a confidence perspective. It's still, we have that wide gap between weakness in the soft data, weakness in the hard data. But, that could be just elongated now, or it goes away if you do continue to muddle through. But I think that if there is a risk to services demand, especially in a labor sense, if you get into the summer season when areas like leisure hospitality tend to account for the bulk of hiring in the U.S., you could still go through that hard data slowdown, but you would have to parse through sector by sector, where the weakness is.
Okay, we're getting into something important. The Federal Reserve's favorite phrase, we're data dependent. And often what we ask is how dependable is the economic data? Yeah. How dependable is the data going to be through the summer?
I mean, dependable, yes, but whether it gives you a clear signal on where the economy is going, that's hard. Because I could see a scenario, actually, where maybe you flip the dynamic that we had over the past couple of years. We had been talking a lot about rolling recessions in the economy. That was purely concentrated on the manufacturing and the goods side. Now, if that stabilizes, because you take a lot of this tariff uncertainty risk in terms of, high percentage rates of tariffs off the table, but you still do have a little bit of slowing in services, then that gives you another dynamic where, yeah, you could have this rolling weakness under the surface, but it doesn't bring overall GDP, down into recession-like territory. Same thing for the labor market. If you still have, relatively constructive data on manufacturing or goods or the cyclical parts of the economy, but services does go through that slowdown, you basically have a flip dynamic from what you had a couple of years ago.
Lisa, this could be a mess for the next several months. I think it's the short way of putting things.
I think that's correct, because you're going to have a data point, the market's going to react to it, and then there are going to be all the people saying this is the reason why you can't look at this data with any reliability, because it's either bringing forward or it's pushing back. So suddenly it's a real mess. How does the Fed really operate with this and talk about data dependency as their sort of catchphrase to push people off course?
Chairman Powell speaks on Thursday. I think he's addressing the framework update at the Federal Reserve. That's probably good news for him, isn't it? He can just avoid all this.
Yeah, I mean, I think the goal, even at the press conference last week, I think the goal was to avoid all this because of the constant response of, we don't know. And actually, when you think about now in the context of what's happened over the weekend, Fed looks to be in a pretty good spot in terms of keeping rates steady. You talk about, the market pricing out a lot of rate cuts this year. Clearly, that's for better reasons, because you don't expect some sort of slowdown to hit from tariffs. But if you have maybe a little bit of a firmer floor under inflation now, the Fed does look to be in a pretty good spot because growth is still firm. I mean, private demand in the first quarter was still running just above 3%. Clearly, we were coming into this year with relatively strong momentum. So I think that, they're probably right to stay where they're at right now because there really is still no visibility. I mean, this is a moving target every single day.
Every single day, yeah. And for the next 90 days particularly. Kevin, good to see you. Thank you, sir. Kevin Gordon there, Charles Schwab. Equities this morning up by more than 3% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Yohara Anand with more. Hey, Yohara.
Hi, John. We start with today's top story. The U.S. and China temporarily lowering tariffs on each other's products in a 90-day cooling-off period and stepping back from the brink of decoupling. The U.S. reducing its levies from 145% to 30%, and China dropping its duties from 125% to 10%. Treasury Secretary Scott Bessent saying negotiations are ongoing and could include purchase agreements to balance the trade deficit. Meanwhile, President Donald Trump sharing plans to sign an executive order later this morning to reduce prescription drug prices by 30 to 80%, mandating that Americans pay no more than people in countries that have the lowest prices. The announcement put foreign drug makers under pressure, and we're seeing weakness among U.S. drug makers as well. And U.S. Transportation Secretary Sean Duffy saying Newark Airport will see, quote, several weeks of reduced capacity after 2 radar and communications failures in recent weeks. The most recent happening yesterday, an FAA equipment failure leading to a temporary ground stop at Newark due to a telecommunications issue at an air traffic control center in Philadelphia. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, a trade breakthrough.
We have reached an agreement on a 90-day pause. Neither side wants a decoupling.
That conversation up next with Henrietta Trays of Veda Partners, live from New York City this morning, with equity futures up 3% on the S&P. Good morning.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Huge rally this morning, up by 3% on the S&P 500, up by more on the NASDAQ and on the Russell. The Russell 2000 higher by 4.7%. This move in the bond market, 2-year, 10-year, 30-year, unlocking higher bond yields as we push back against the expectation of recession risk. Yields are higher by 11 basis points on a 2-year, 3.99, and in foreign exchange, euro-dollar taking a dive. Euro-dollar 110.94, a move of 1.4% against the single currency. The dollar a whole lot stronger in this morning's session. Under surveillance this morning, a trade breakthrough.
We have reached an agreement on a 90-day pause, substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling.
It's the latest this morning. The US and China are agreeing to slash tariffs on one another for 90 days. The US cutting levies on Chinese imports from 145 to 30, and China lowering duties on US goods to just 10%. Bloomberg's Tyler Kendall joins us now for more. Tyler, have we got a feel, a view for what takes place over the next 90 days?
Yeah, hey, John. Well, once the pause goes into place by this Wednesday, the countdown's really on. So we're going to be looking for any clues on what it takes from the U.S.'s side, at least, to de-escalate this on a more permanent level, considering that Bloomberg News had asked the Treasury Secretary Scott Bessent earlier today what it would take to not raise those levels back up. And he said ultimately it would be good faith and good dialogue. Now, there are a few differences that we're, of course, tracking. The Treasury Secretary said that he thinks that progress can be made when it comes to fentanyl concerns and that likely purchase orders would be included in any agreement. In an interview earlier today, he said that the Phase 1 trade deal would likely be a good starting point. We're also going to be watching for those non-tariff barriers as China confirms that they're set to remove any non-tariff countermeasures, likely referring to some export controls that they put on critical minerals since April 2nd, long a sticking point with this White House. But at the end of the day, the USTR Jamieson Greer did say that he felt the differences between China and the U.S. weren't as large as previously thought, but we do know that there are still going to be those sticking points going forward. John, one example, we got a new statement from the China's Commerce Ministry earlier this morning, and while they said that this was all a good first step, ultimately they hope that the U.S. takes steps to completely rectify the mistake that is unilateral tariffs, as they called it.
Tyler, I'm just wondering if anyone in Washington, D.C. who you speak to can give you color about why there has been such a shift in tone, say, from today, since Friday even, when you're talking about 80% potential number on China.
Well, Jamieson Greer was actually asked about this directly, and he said negotiations are fluid. They're always going to negotiate. We often hear from U.S. officials here at the White House that everything is on the table. Yet at the same time, they still contend that President Trump, of course, is directly involved in the talks and does give his input as Jamieson Greer and Scott Bessent really lead up to the negotiations. But of course, going into this day, as we've been covering at this point for months, there really has been an uptick when it comes to consumers' fears and how particularly the tariffs against China could hurt trade and those prices here at the U.S. The other side of this, too, though, is how it could hurt farmers and agricultural products. That is a really big component that we're going to be watching here, and we know that Republicans are particularly protective when it comes to farmers. As our reporting indicates, the administration was looking at potentially a bailout for farmers down the road if it came to that.
Tyler, appreciate the update. Tyler Kendall from outside the White House. To extend the conversation, Henrietta Trace of Veda Partners. Henrietta, how do we ensure that 90 days doesn't become 18 months again?
Well, I mean, I think that a lot of the folks that you've had on the show this morning have done the Lord's work in getting the White House to back off of their 145% tariffs. Torsten Slok deserves, in my opinion, a lot of credit with the direction that he's taken in trying to compel the White House to see that tariffs do not work and that everybody loses a trade war. I was sort of reflecting on Mother's Day. There are some kids you can talk to and say, hey, the stove is hot, don't touch it, and they won't. And other kids that have to touch it and find out the hard way that the stove is hot. So the White House found out. They tried. It did not work. I think it's really important to note that an 80% reduction in the tariffs would not have alleviated the embargo on trade. You had to get below that 50% threshold to get corporations to continue to bring components or products in. So landing at 30% or so is really what we need to continue the flow of trade. And I think that really is a piece of the puzzle between the 80 and 30%. You had to get below 50.
I was the kind of kid that touched the stove. Ramo? Touch the stove?
Well,
test limits?
Yeah, I had to,
push
yes.
boundaries?
I would once put my finger directly on it, and my parents got very upset. That's pretty much.
That adds up. That tracks. Henrietta, I'm not going to ask you which one you were. We know you're obedient and you listen to your mum.
I feel seen.
30%. How sustainable is 30%? The Treasury Secretary said 145 wasn't sustainable. He gave us a decent indication these tariffs would come down. They've come down. Do you see 30% as sustainable if we have no success over the next 90 days?
I do see 30% as sustainable, and here's why. As we learned from the first Trump administration, you can get the White House to capitulate when you offer them concessions along the lines of Phase 1, which is additional soybean purchases, pork, beef, sorghum, lower some of your sanitary thresholds, things along those lines. We do need, as you just discussed, we have seen the Republican Party in the throes of asking for a $60 billion bailout for farmers. That's very expensive, more than double what we saw in the first Trump term. And quite frankly, the conference is about to pass a $5 trillion tax bill. They don't have $60 billion lying around to throw to the farmers. The number one thing that we need to shift to now is if we do not have tariffs on at 145%, we're obviously not going to be getting the $2 trillion in revenue that the president told us all we would be getting as a result of the tariffs. And I think the tariffs on the rest of the globe, the other 90 or so nations that he's put Liberation Day tariffs on, are also not going to come into effect. So Howard Lutnick discussed this last week. We've collected about $46 billion in revenue from tariffs. If we're passing a $5 trillion bill and a big portion of that was going to be offset by the by the tariffs, then we're obviously not going to get that going forward. So we need to find a new offset there. That's why the president is talking about taxing millionaires, et cetera. There's a long way to go.
Henrietta, this is so fascinating, and I'm so glad you brought up the budget. We did get sort of the reconciliation bill, at least in its draft form, on Friday, and people were saying that it would add $5 trillion to the deficit over the next 10 years. There is this question of where the offsets will come from. Based on that bill, what is the expectation for how many revenues get brought in from the tariffs? What's the expectation of what the outlays have to be? You talk about, say, a bailout to farmers. How much is left for that?
Yeah, this is going to be a massively deficit increasing package. To put it into perspective, when I say a $5 trillion package, $3.8 trillion is already spoken for and will be completely deficit financed through the budget gimmick known as current policy baseline. The Senate Republican Conference will not score that $3.8 trillion in spend as costing a dime. So that will be pure deficit financing. Then on top of that, we have to realize that we have narrow margins in both the House and the Senate. So we got to throw money at the SALT caucus, the child tax credit, the earned income tax credit, low income housing. We need to maintain Medicaid subsidies. We cannot cut SNAP nearly as much as they want to. And then we haven't even gotten to the components that President Trump campaigned on, which are massively expensive. The no taxes on Social Security cost $1.8 trillion. We just literally don't have the money for any of this. I think at the end of the day, the market should expect short-term extensions of a lot of this policy. Anything on the business side will be 2, 3, maybe 4 years. They put sort of a 2029 marker in the sand in the reconciliation bill when it was released on Friday night. But most of this is going to be explosively deficit increasing. At the end of the day, I would say anywhere between $4.5 to $5.3 trillion in deficit hikes.
The reason why it's important to analyze this, going back to the tariffs and the reductions between the U.S. and China, there has been a big question: what is the Trump put? Where is the place at which President Trump does change his tone from hardline to playing nice? And there's a question about whether it's been polls. There's a question about whether it's been budget realities and some of the bailouts or inability to pay for them. And there's a question of how much ultimately it's going to rely in markets. From your perspective, which is it?
This time around on the tariffs, it was the markets. I feel pretty strongly about that. I mean, I sort of balance straddle the line between both of those. And I talk with members all day long. And of course, they're upset about the tariffs. They're seeing their constituents come to them and say, you know, my shoe company is going out of business. I can't sell toys. My business has to close. But those members don't really have recourse in the White House. From my seat and talking with investors and seeing the way that they've approached this White House, it has been driven not by the stock market and the ups and downs in the Dow, but by individual analysts trying to make the case to the president about what exactly it is the tariffs do, how this hurts shippers, truckers, the cargo areas, retailers. This will spike unemployment. I mean, they literally had to teach the White House in real time exactly what the economic feedback was going to be and show them consistently for weeks exactly how bad it could get. And I think they were the ones who deserve the credit here.
Henrietta, appreciate the framing. Henrietta Trace there of Veda Partners. I go back to that weekend when the president's on Air Force One, and Marie's alongside him, and in the background is the Treasury Secretary, Scott Bessent, and the bond market's just made a move. And I think we know what unsettled the administration. When growth expectations were coming down and bond yields were going up, that's when this administration started to get a little bit nervous.
It was sort of a 1, 2, 3 punch, because you saw the bond yields go up, and then you had that meeting with Walmart and Target executives where they laid out clearly, we don't know the exact contours, but it seemed like they laid out what would happen and the potential for empty shelves. And that real-time playing out in markets and rhetoric seemed to have really shifted things in the White House.
And this right here is the latest stage of negotiations. To be clear, the negotiations continue, this time with a lower tariff level, but still around 30%. Equity futures on the S&P up 3% this morning, up more than 20% from the lows around the first week of April. This rally has been vicious. Up next on the program, on a vicious equity market rally, Jill Carey-Hall of Bank of America. this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
2 hours away from the opening bell, and equity futures near session highs, up by more than 3% on the S&P 500. The Russell, the small caps, up by close to 5%. So many movers out there this morning. Let's get 3 of them for you. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Look, there have been questions that if we eased off of tariffs, that there was de-escalation, what would lead? It seems that at least for today, we have the answer, and it is Mag 7, and it is big tech, the entirety of the sector higher. Apple in particular interest this morning up 6 1/3%, because along with that, there's also a journal story out this morning that they're considering raising prices of their iPhone, but trying not to tie it to tariffs. Instead, if they do it, it'll look something like they're tying it to product launches. So those shares moving higher. Also higher this morning, all of the airlines, another sector that is a clear outperformer. Take a look at Delta, for example, up 7.3%. They're one of the first companies out of the gate to say that they are removing their outlook and concerned about the consumer. Perhaps those concerns, at least some of them, get erased if we don't have to price in a recession, so airlines do better. We'll see if there are any updates from the corporates on those levels. One sector, though, decisively into the red, not participating in the rally, is healthcare. A 1-2 punch. This is a safety sector, so you don't really need it as much if we are risk on. And second, over the weekend, Trump posting on Truth Social that he is looking at lowering drug prices between 30 and 80%, matching the lowest rate that countries pay for drugs. So shares falling as much as 4% for Gilead. John.
Hey, Danny, thank you. We'll get back to that story in just a moment. On our radar this morning, our top story, a US-China trade breakthrough. Both sides agreeing to lower tariffs over a 90-day cooling off period. The US slashing levies on China from 145 to 30, and China slashing duties on US goods from 125% to just 10%.
There are a lot of details that still need to be revealed, a lot that still remains unknown. Nonetheless, this feels like a sea change. It certainly is being reflected that way in markets where suddenly people are saying, and we heard this from Torsten Slok, the worst case scenario of recession has been taken off the table. The tail risk has now not necessarily materialized in the same kind of way. The cooling intentions has removed that chance. And you could see that in the Fed funds future with now just 2 rate cuts priced in for the Fed this year.
You can see it across the board. It's being priced as a positive growth shock this Monday morning. Tariffs dropping by much more than people thought they would, anchored by the president going into the weekend, who suggested something closer to 80, and we've landed at 30. Yields are up, the dollar's stronger, equities are higher by 3%. Later, you'll hear from the president. At around 9:30 Eastern time, the president's set to sign an executive order aiming to cut U.S. prescription drug costs. Trump saying on Truth Social, quote, prices will be reduced almost immediately by 30 to 80%.
It seems like 30 and 80% are really making frequent appearances here in terms of numbers. Look, this is an issue that has been a longstanding one in the United States. U.S. consumers spend a lot more per drug than other people in other countries, and drug makers argue that this higher price is necessary to subsidize some of the innovation that they do, as well as new drug creation. President Trump in his first term tried to do something similar. It was knocked down by the court system. This is likely just to target the Inflation Reduction Act and drugs covered under that. There also is probably with something that he'll try with the Medicare and Medicaid. It raises the question, what can he do? And also, how much are the courts going to really knock down in all of the ongoing negotiations and proposals that we keep seeing?
It's also what they charge insurance companies as well. That's the big problem too. Living here in the United States for the last decade or so, just unbelievable when you get the breakdown, what's actually being charged to insurance, and how inflated, can I say inflated, how inflated it all feels?
Well, because what they charge insurance is a fraction of what you would get charged if you were out of pocket. And if you're uninsured and you go to a hospital, for example, and you're given care, it's often 3 or 4 times as much as somebody who comes in and then has to go back and charge the insurance companies. There are all sorts of strange and seemingly unfair aspects of the healthcare system. How you're going to undo some of that with an executive order, I think a lot of people remains to be seen, but I think the overarching idea is something a lot of people can get behind.
The system is incredibly complicated, that's for sure. The president will go on a road trip very shortly. He's traveling to Saudi Arabia, Qatar, and the United Arab Emirates this week. Axios reporting Trump aiming to return with $1 trillion, yes, with a T, $1 trillion worth of deals and investment pledges in place.
There is so much that potentially could happen, especially as the Iran-U.S. talks continue, especially as we talk about that plane that Qatar is going to potentially gift President Trump. A really interesting aspect of this, and this is something that a number of people have written about, is there seems to be a convergence of some of the personal and presidential interests in this region that seem to be converging and potentially will lead to a friendlier atmosphere. Curious to see what potentially comes from these trade negotiations.
Anne-Marie on the ground in the Middle East. We'll hear from Anne-Marie tomorrow on the president's trip. Let's turn back to equities. The Russell is absolutely flying. Small caps seeing a boost as the US and China agree to reduce tariffs for 90 days. Jill Carey-Hall of Bank of America staying cautious, writing, corporate sentiment has plummeted for small caps this earnings season. Small caps still struggling to get out of their earnings recession. Jill joins us now for more. Jill, good morning.
Good morning.
This clearly helps sentiment. Does it help anything else?
It does help sentiment. I think the question is, how are the headlines going to progress from here? How much damage has already been done? There's a lot of uncertainty, and volatility certainly doesn't help small caps. So, if we're in an environment where the corporates still hold off on spending, small caps do tend to be very sensitive to CapEx as beneficiaries. And they've been in this environment where everyone expected more than a year ago that last year, small caps would have seen a big recovery out of the earnings recession. That never happened. It got pushed out. It's continued to get pushed out. And this earnings season, we saw that corporates were pretty cautious. In both large and small caps, guidance was weak and more sparse than it historically is. And as mentioned, small caps did see, when corporates were talking about conditions on earnings calls, a much bigger deterioration.
Just to sum up earnings season so far, how were we rewarding both beats and guidance coming from some of these companies?
Yeah, guidance definitely mattered more when we looked at the S&P 500 reactions. The companies that beat, there wasn't necessarily much reward. The ones that missed got punished. But the companies that were issuing guidance, when we looked at annual and quarterly earnings guidance, that tended to drive reactions more. And that was in tandem with, as we said, guidance that was a bit sparser than history. More uncertainty on the outlooks. We saw the same during COVID. A lot of corporates pulled annual guidance. So that tends to happen during these uncertain periods.
I remember long ago and far away in December when people were saying that small caps would actually benefit more than the big caps because they were more leveraged to the United States economy, which is the rocket ship, and not necessarily exposed to international trade in the same kind of ways. Why has that fundamentally so failed?
Well, I think, I think more than ever, this is a time when you need to be selective in small caps. It's not as easy as just buying or selling the Russell 2000. The index has seen shifts over time. It's become more global. So, the gap between the foreign exposure of large and small caps has been narrowing over time. These companies, even though they are more domestic, they may not be as nimble to shift, supply chains and things as conditions change. And they have been struggling, in this earnings recession. They have struggled to get out of it. They've seen a deterioration in quality of earnings over time. So I do think that these companies, there's still a lot of opportunities given how cheap the size segment has gotten. We do like mid caps over small, so I think tilting up the cap spectrum within SMID makes sense. Less sensitivity to volatility and tariffs. The earnings revision trends have been better in mid, but focusing on small caps that have, stronger, more solid margins. Those stocks have been outperforming in this environment with tariff uncertainty. Focusing on stocks that have positive revisions as revisions were still coming down. Focusing on quality. I think that those attributes make sense.
I'm so struck by Walmart when they came out and they said, we're going to invest in price. This, to me, was the clarion call of how much power some of the largest players have in the commerce sector in particular. The idea that they can absorb some of the increase in costs in order to keep customers and possibly gain market share. How much are we going to see that pretty much across the board, with essentially the largest players gaining even more market share and the smallest ones really losing?
Right. I mean, I think the ability to increase prices is a key factor. Small caps historically have generally had good pricing power when we've been in inflationary environments historically. But as we've seen, the quality of the benchmark deteriorate over time, and the fact that we're in an earnings recession still for these companies, that's one challenge. We're also in an environment where if the Fed is not able to cut and inflation has been staying high, that's another big factor that's been driving the Russell 2000 is, Fed expectations, since these companies are very leveraged relative to history. They have a lot of shorter-term or floating rate debt, so the Fed has been a big driver as well.
Retail's had a massive role to play. Lisa, I'm so pleased you brought up that headline. That was one of these standout comments of the last few months. And when we speak to Oliver Chen later this morning, we need to talk to him about it. Pricing strategies. How do they shift now? We've had this massive shift again over the weekend.
And we heard from Apple how they're potentially toying with a new pricing strategy of potentially raising prices, because right now it is becoming increasingly clear, even at 30%, this is not going to be something that can easily be absorbed by suppliers. It's either going to have to come from margins or it's going to have to come in the form of price hikes.
Apple up in the pre-market by 6%. Jill, it's good to see you.
Thanks.
Thanks for dropping by. Jill Carey-Hall there of Bank of America with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. is suspending imports of live cattle, horse, and bison from ports along the southern border due to the spread of the screwworm pest in Mexico. Mexico's Agriculture Secretary expressed disagreement with the measure, but hopes for a swift resolution. The import suspension will be reviewed in 2 weeks. Meanwhile, after 4 days of clashes, India and Pakistan agreed to a ceasefire on Saturday. The U.S. says it helped mediate the de-escalation, but India maintains the truce was a result of bilateral talks. A top Indian envoy telling us here at Bloomberg the dispute over Kashmir is bilateral, not international, rejecting any external mediation. And Nissan will eliminate 11,000 more jobs than it previously planned. That would bring the total number of layoffs to 20,000. That's according to Japan's national broadcaster, NHK. The automaker's moves come as part of a wider plan to restructure its business as it deals with weak sales in the U.S. and China. That's Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, a major de-escalation.
We have reached an agreement on a 90-day pause. Neither side wants a decoupling.
Up next on the program, we'll catch up with the man himself, the Treasury Secretary, Scott Bessent, joining Bloomberg TV next.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Live from New York City this morning. Good morning to you all. Equity futures near session highs on the S&P 500, firmer by 3% on the S&P, up by closer to 5% on the Russell 2000. Under surveillance this morning, a major de-escalation.
We have reached an agreement on a 90-day pause, substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling.
Here's the latest this morning. The US and China agreeing to a 90-day cooling off period. The US reducing its levies on Chinese imports from 145% to 30%, while China cuts duties on US goods from 125% to 10%. Joining us now to discuss, the Treasury Secretary, Scott Bessent, a driving force behind trade talks in Geneva over the weekend. Mr. Secretary, welcome back to Bloomberg Surveillance, sir. It's good to see you.
Good afternoon from Geneva, Jonathan.
Great to catch up as always, sir. Let's get into these talks over the weekend. One standout line for me and for many others was the line that the differences between the two sides weren't as large as we thought they would be. What were those differences, sir, and why were they smaller than you expected?
Well, I think, Jonathan, what's important to know is for the tariff program, we had a plan, we had a process, but we did not have a mechanism for engaging with the Chinese. So China was the only country who escalated their tariffs in response to our reciprocal tariff level. So that resulted in an unfortunate escalation. So we now have a mechanism to deal with that. Neither side wants a generalized decoupling. The U.S. is going to do a strategic decoupling in terms of the items that we discovered during COVID were of national security interest, whether it's semiconductors, medicines, steel. So we still have generalized tariffs on some of those, but both sides agreed we do not want a generalized decoupling.
These things take time, as you know, sir. We've got 90 days now to work with. Last time around, it took 18 months to reach an agreement on purchase agreements. I think you yourself have said in the past that it can take 2 to 3 years to have a full comprehensive trade agreement with the country between the US and China. What do you think is achievable, sir, over the next 90 days?
Well, Jonathan, we're going to see, but what has to happen is it has to be fair for the American people. But in January 2020, President Trump produced a template. We had an excellent trade agreement with China, and the Biden administration chose not to enforce it. The Chinese delegation basically told us that once President Biden came into office, they just ignored their obligations. So, we already have a large framework. The other thing to remember here, Jonathan, is that this is a pause down to 10%. The April 2nd level for China is 34%. So we will be working to see where their final reciprocal number ends up. And the negotiations are a combination of tariffs, non-tariff trade barriers, currency manipulation, and subsidies of labor and capital.
Just to build on that, as I listen to you, do you consider the new levels as a ceiling or a floor?
Well, it's obviously a floor that they are now with everyone else who did not retaliate. So the levels have come down to the pause level. And what I would say is 34, which is their assigned April 2nd level, would be a ceiling, which is what I went out and told people on April 2nd, which is why I was surprised market participants panicked, because we had capped the upside for every country, and if they didn't retaliate. So this unfortunate turn of events happened because of retaliation, but now we have a process in place to avoid escalation like that again.
Secretary Bessent, just to build on that, are you saying that tariff rates will only go up from here if this really is a floor of 10% on the Chinese side and 30% on the U.S. side?
I'm not saying that they're going to go up, but it would be implausible that they would go below 10.
One thing that you've been talking about is a generalized decoupling as something that's not necessarily in the interest of either side, and neither side wants that. What about a strategic decoupling? What is the appropriate rate of tariffs that could potentially cause some sort of strategic decoupling in the sectors that you are talking about?
Well, look, bringing back our strategic our important strategic industries can be a result of tariffs, but it's also a result of national will. So this administration is running full speed to make sure that what we saw during COVID never happens again. So it's a combination of, it can be tariffs, but again, it is the administration moving as quickly as possible to make sure that we are self-sufficient in the strategic industries.
I think that's completely understandable from the United States side. And I wonder, Mr. Secretary, whether the Chinese understood that. Did you get the sense they do understand that that will be the road forward for the United States?
Well, I think they understand that, and I think they understand that we are focused on fair trade, that this gigantic deficit that we have with them, that it didn't happen last year, it didn't happen the year before, it's happened over decades, and that this has to be remedied. The China shock gutted our manufacturing sector, and we want to bring that back. On the other side, Party Chair Xi has said that he would like to increase consumption, but to date, the Chinese have just increased manufacturing. So we would like to see them increase consumption. We would like to see them open their market to American products. So there are two ways to rebalance. One is fewer Chinese goods in the U.S. market. The other is more American goods in the Chinese market, and my guess is that the answer is somewhere in between.
Some of this, of course, takes us back to the purchase agreements of the first term of the president. Is it different this time around? Is it as simple as just revisiting those purchase agreements, or do you see additional sectors being targeted?
Jonathan, I think everything's on the table, but the phase one purchase agreements is a very good roadmap, because I will point out that during 2020, China met their obligations under that agreement. It was only under President Biden where they neglected them. So we are getting we are starting there. And look, the world has changed, products have changed, product mix has changed. So I think everything's on the table. But the main thing here is we have to have a fair deal for the American people. And keep in mind, too, that we also have 20% fentanyl tariffs on. So we are at, for 2025, we have put on 30% tariffs. They have put on 10. And my economic observation is that businesses just need time to calibrate. That we saw approximately 20% tariffs from President Trump's first term. Businesses calibrated, supply chains moved. We have seen 20% tariffs President Trump put on in February due to the fentanyl crisis, calibration, very little disruption, and now a 10% additional tariff should mean very little disruption.
Mr. Secretary, a lot of people are wondering what caused the softening in tone. The reason for both sides to come together and be able to have this kind of negotiation and chart a path forward where there will be further negotiations in the near term. What's your interpretation of what caused both sides to come to the table?
Well, I think that the two levels on the reciprocal tariffs, when they both ratcheted up to 125, caused the equivalent of an embargo. And that wasn't good for either side. We're the deficit country, so less bad for us. But I think there was the unintended consequence of this very fast ratchet. And so now both sides are at 10. We will be moving forward with a 90-day pause. And the important thing to remember is that we can always go back to the April 2nd level. But my sense is we had very good discussions. My counterpart was very firm, but very engaged, and I think we have set the stage for meaningful discussions.
Mr. Secretary, is there already a scheduled date for Xi Jinping and President Trump to meet in person at any point in the near term? Do you think that that is something in the cards as part of these negotiations?
I think that there would be a phone call before a meeting, and there's nothing on the calendar, but I could imagine that that could happen in the coming weeks or months.
Going into the meeting, as you know, the president put out a social media post. He referred to you as Scotty B. I won't go there. We'll keep using Mr. Secretary. And he said you could go as low as 80. Can you share with us how we went from, say, 80 down to 30? Where did that number come from, sir?
I think that in the president's mind, 80 was a number that did not cause an embargo, so we could still be at 80 and have trade flowing, but we were able to both move down by 115%. And Jonathan, I think the other important thing here is I think this is the first time that the Chinese have addressed one of the president's real priorities, which is ending this fentanyl crisis in the United States. So they brought their trade team, and they brought a vice minister for state security who met with our national security team. It was a separate meeting, and they had a very robust and detailed discussion on ways to stop the transport of precursor drugs from China to North America that ends up in the hands of the cartels that is then killing several 100,000 Americans a year. So I'm very optimistic that President Trump, we have solved part of the fentanyl crisis by securing the border, and I think this is the next step on that. So if over the coming months we were to see excellent engagement from the Chinese and solutions towards solving the fentanyl crisis, I think we could see some amount of the fentanyl tariffs perhaps come off, but that is going to take actions from them.
What kind of action specifically, sir?
Well, we can see where these precursor drugs are coming from. At Treasury, our financial criminal enforcement network has very good visibility into international finance. We can see these Chinese companies that are selling the equipment for making the pills, that transferring the precursor drugs to the cartels. U.S. Treasury has declared the Mexican cartels foreign terrorist organizations. So working with Chinese leadership to stop this would be a very tangible symbol. In China, the narcotics distribution is punishable by death. And we're not pushing for that necessarily, but we are pushing for very, very strict enforcement, similar to what they do at home.
Mr. Secretary, I imagine you're incredibly tired, and a lot of people were very excited to see you taking the lead in these discussions, certainly in the market. Are you going to be taking the lead going forward with other difficult negotiations around the world with different trading partners?
I've been involved in most of the Asia negotiations. We had a very good negotiation with, or we've had 2 rounds of negotiations with Japan. I've been involved with Korea. I've met with Vietnam and, excuse me, also Indonesia. So my focus has been on the Asia region thus far. And then the trade team had a great victory with the UK, putting together the contours of the first trade deal. The other thing I want to say, too, is my partner here in Geneva, Ambassador Greer, was an incredible asset. He has years of experience, a broad and deep knowledge of trade negotiation, of the numbers and the nuance, and we would not be here today without Ambassador Greer.
Mr. Secretary, just before you go, you've promised us a lot of time. We've used up most of it already. Just a final question. What does victory look like for you? In 6 months' time, when we get to year end, and I know it's frustrated you that we've only been talking about trade, that we haven't focused on the full policy platform. Where do you want to be by year end?
Well, look, Jonathan, this administration is doing peace deal, trade deal, tax deal. I try to stay mostly, as you know, in my econ lane. So from that lane, victory to me looks like the three-legged stool that really, or the 3 parts of our program really kicking in. So we will have most of the trade and tariffs settled. The tax bill is moving along very well, better than I could have imagined. Speaker Johnson, Leader Thune are doing an incredible job with President Trump's leadership. So we will have tax done. And then the final piece that is longer lag, but perhaps the most important, is deregulation. And deregulation, we are deregulating across all industries every day. President Trump is committed to, for every new regulation, 10 comes off the books. And deregulations should start kicking in the 3rd and the 4th quarters. So tax, trade, and deregulation all coming together at the end of the year, I think it's going to be very powerful for President Trump's economic agenda.
Mr. Treasury Secretary Scott Bessent, we appreciate your time, sir. From Geneva, very generous with your time. Thanks for being with us right here on Bloomberg Surveillance. From New York City this morning, good morning to you all. If you're just tuning in, a major rally in this equity market on the S&P 500, higher by more than 3% on the S&P, on the NASDAQ up by 4%, on the Russell 2000 up by 4.6%, as the United States and China strike a 90-day truce, which also leads to an aggressive cutting of tariffs on either side.
Going down from 145% from the U.S. side on China down to 30%, and on China's side going from 125% to 10%. What we heard there just now from Treasury Secretary Scott Bessent was that 10% is likely a floor. It is implausible that it's going to go below that. It is significantly below, however, where they were before April 2nd. So here are the questions. What are the contours of negotiations, and can they get something done by the end of the year, which he said as well?
Stack 60 Minutes coming up to react to all of this. Coming up in in just a moment. We'll catch up with Mira Pandit at JP Morgan. As the US and China reach a breakthrough, we'll talk to Oliver Chen of TD Cowen, looking ahead to retail earnings this week. Seth Carpenter of Morgan Stanley out of the latest read on inflation tomorrow morning. But we begin this hour with global stocks soaring as the US and China take down the temperature. Mira Pandit of JP Morgan writing, we do not want to be lulled into a false sense of security. While the volatility we saw in April may have been the high watermark, that doesn't mean volatility is behind us altogether. Mira joins us now for more. Mira, good morning.
Good morning.
Have we put all the bad news behind us?
Not necessarily. What we have to be mindful of is volatility and the nature of it. It comes and goes. And while we have another recalibration moment, we had April 2nd announcement of tariffs. We had April 9th pause on tariffs. Now we have a big reduction for a period of time in the Chinese tariff rate, but there are still risks ahead. We have to continue to follow the ebb and flow of trade optimism, trade disappointment, and there's also a distinction here between when the market stops caring, but the economy is still going to care. Think about Brexit. You know, we're 10 years on almost from Brexit, and it's undoubtedly still an impact on the economy there, even though it's not showing up in markets on a day-to-day basis. So this is the squaring of the circle that we're going to have to go through over the next couple of years, because having a 2% average import goods tariff rate last year to something probably still in the double digits when all of the dust settles is going to have that longer term pass through to the economy. And that means where the economy and markets meet is around profitability.
Before we get into the next couple of years, can we deal with the next couple of months? How will you digest the incoming information? What will you ignore? What will you choose to put some weight on?
What I want to choose to put weight on the most is how are prices impacted? Because as I mentioned, the link between markets and the economy in the long run is going to be the profit picture here, and profits are really going to determine how well stocks can do. Because ultimately, we're already in an environment where valuations are still, compared to their long-term averages, 20% higher than they perhaps should be on an average basis. And so when we think about what underpins that, we have to see that profitability. Now, we have to recalibrate a little bit around economic growth expectations. We were at a 50-50 recession probability coming into this. Perhaps now that is skewed towards slower growth as opposed to definitive mild recession. So in that case, still slowing growth means slowing profit growth. How do we continue to see profits playing out this year? What are the risks from tariffs? Well, you have potential revenue slowdown. How much? You have potential pricing increases. How much gets passed on to an exhausted consumer versus how much get absorbed by historically very high margins? And then you think about even the structures within the S&P 500. Could areas like the Mag 7 be a saving grace this year as some of those areas are more resilient? And we see yet another delay in terms of broadening out of profits. There are so many angles to this tariff and non-tariff as we reconsider what this pause means.
I can feel a bit of frustration, if not for you, for me. I was reading your notes and you were talking about a 50-50 recession call, and I was going to ask you about that. You already brought it up and said probably it's skewed more against recession than for recession. But how do you switch your views so quickly, right? I mean, we're going to see just a complete downgrade of the potential for recession risk across Wall Street if these new rates of tariffs stick.
You have to think about scenarios, and certainly in this environment, extreme scenarios. What if tariffs come off altogether? What if we go right back to where we were April 2nd? Where do we land in between? And clearly, we're probably going to be somewhere in between, and that in between is so hard to figure out when we think, okay, look at what's going on with yields, for example. You're seeing yields start to perk back up. If one of the factors that's been weighing on yields has been lower growth, and all of a sudden that is potentially alleviated to some extent, then you have yields moving in a different direction here. I mean, everything in the market, whether it's equities or fixed income, has been so sentiment-driven this year. It's really hard to ground yourself. It's trade fears versus trade optimism, and you're switching back and forth. So we are trying to figure out where to ground ourselves in the in-between state, which we're likely going to end up in.
Where is that place? Is that gold?
Well, not necessarily. I mean, when I think about portfolio positioning, in a way, that's what's changed the least because of some of the starting points that we're dealing with. I mean, there's still definitely two-sided risks to bond here when we think about maybe you don't see so much of a growth slowdown, so there's a lot in terms of term premium that could potentially be pushed up when we think about uncertainty. On the other hand, when you think about the basic dynamics of if we were to see on the ag bond index a 1% rise in rates, certainly not what we expect, you'd be looking at a sell-off of about 1.5% over total return a year in your bond allocation. So you're still actually looking at somewhat of a contained impact there. And despite overall yields biased upwards, you've actually seen that most areas of the bond market have been positive. On the other hand, a 1% fall in rates, not something we expect either, would give you at about an 11% return given that income cushion. So being broadly diversified within fixed income has worked. I think it will continue to work. And on the equity side, you're still dealing with high starting valuations and growth. We want to make sure we're geared towards some of the areas that have been a bit more favorable, whether it's value, outperforming growth about 6% this year, or international, outperforming 14% in dollar terms this year. None of that really changes despite the 30%, 80%, 50% tariff rates.
You're getting to something really important, something that John and I were discussing earlier this morning about how much structurally there has been a loss of dollar exceptionalism and a loss of haven status. And the shift to Europe has been something more sustainable and not just a knee-jerk reaction that was a positioning squeeze. You're saying on one hand, maybe a little, but not necessarily wholesale when it comes to the loss of treasuries as a haven status. How do you sort of understand what has changed since April 2nd?
I think what has changed is certainly that uncertainty level where when there is uncertainty, people want to go to treasuries. And more recently, when there is uncertainty, people don't because a lot of that uncertainty is emanating from the U.S. I think it's also just the compounding effect over time of having unsustainable debt and deficits and that really starting to feed into the bond market given higher rates and the cost of servicing debt overall. These things putting that upward pressure on yields. And I think that people are putting a microscope to some of those elements because it doesn't feel like we're in an environment where some of that direction of travel is going to be for a more grounded place.
This comes to scarring. How much scarring will we see post-April 2nd, even if we do secure some major deals in the coming weeks?
There are some things you can't unsay. I think that's going to be the theme for the rest of the year, where even if you do come up with a number of trade deals or more likely frameworks for longer term deals, there's always that possibility that things can potentially come back around. And so there is that scarring there where if you're a business, you're seeing a lot of buybacks. Hey, what's the best use of my money right now? Let me just double down on my company while prices have gone down as opposed to put forth money for future investment. So maybe it's less about people changing their plans, but just putting their plans on hold. And in some ways, over time, that can be equally damaging.
Mira Pandit of JP Morgan Asset Management. Equities at the moment, if you are just joining us, positive 3% on the S&P 500, seeing a bigger move on the NASDAQ, a bigger move on the Russell. In the bond market, yields up across the curve, particularly at the front end of the curve where yields have been higher by close to double digits through most of this morning. And that has underpinned a massive move in the dollar. The dollar a whole lot stronger against things like the euro. The question mark over the last few months is whether we would see some scarring on dollar-denominated assets. And the question this morning, Lisa, is how repairable some of those issues are.
Yeah, and the fact that we haven't seen the dollar reclaim some of the highs or some of the levels that we saw the strength before April 2nd is notable. Also notable, how much is being driven by just a relief trade and how much is being driven by a rate differential. Again, all of these things people will be discussing as this chapter is not done. Let's just be real clear.
We've got a 90-day truce. The dollar is stronger by more than 1%. Up next on the program, we'll get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent telling Bloomberg Surveillance it would be implausible for U.S. tariffs on China to go below 10%.
This is a pause down to 10%. The April 2nd level for China is 34%. So we will be working to see where their final reciprocal number ends up. I'm not saying that they're going to go up, but it would be implausible that they would go below 10.
His comments, of course, coming after the U.S. and China agreed to lower tariffs over a 90-day cooling-off period. Meanwhile, President Donald Trump sharing plans to sign an executive order later this morning to reduce prescription drug prices by 30 to 80%, mandating that Americans pay no more than people in countries that have the lowest prices. The announcement put pressure on foreign drug makers, and we're seeing weakness among U.S. drug makers as well. And a check on Apple shares. Those are rising 6% in the pre-market after reports it's considering raising prices for its fall iPhone lineup. Sources telling the Wall Street Journal the tech giant does not want to attribute the price hikes to U.S. tariffs on China. Instead, they report Apple will attribute any price increases to new features on the iPhone. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next, the morning calls. Plus, we'll catch up with Oliver Chen of TD Cowen as the retailers get set to report this Thursday retail sales and earnings from Walmart.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
The opening bell 1 hour and 16 minutes away, with equity futures near session highs on the S&P 500 higher by more than 3% as a trade truce between the US and China unlocks some big gains in the equity market and some losses in the bond market. Let's get to the bond market. 2-year, 10-year, 30-year yields are up by 10 basis points at the front end of the curve, around 4% through most of this morning as we push back rate cut bets and reduce recession risk. That means with those moves, a stronger dollar against the euro. Euro dollar a whole lot negative. We're down by 1.3%, 111 on the euro. That's some of the cross-asset price action. Let's get you some morning calls. First up, Wedbush removing Alphabet from its best ideas list, citing uncertainty around the impact of AI. The stock is up this morning. Like all the other stocks, it's up by 2.7%. Your second call from Jefferies upgrading Marriott to buy, expecting its business model to grow despite an uncertain climate. That stock also higher by 2.6%. And finally, Bernstein downgrading Target to underperform, saying credit card data points to, quote, a bleak picture for the company's first quarter. That stock also a whole lot higher off the back of that trade truce. Target's higher by more than 5%. Let's stick to the retailers. Consumer spending in focus this week as a slew of economic data and Walmart earnings set to show tariffs' impact on prices and sentiment. Joining us now is Oliver Chen of TD Cowen and the Columbia Business School. Oliver Chen, good to see you, sir.
Pleasure to be here. Thanks.
Big deal over the weekend. They got a big excuse to raise prices if they want to. Are they going to take it still?
We'll see. The consumer is fragile. And retailers that we like, such as Walmart and Costco, focus on low prices and passing through as much savings as possible to the consumer. That being said, the prior tariff scenario did necessitate price increases, especially with apparel and toys and electronics. So we'll see. I think what we'll see at the best retailers and the most scale retailers is not passing through prices as much as possible. As you know, Costco is not even a retailer, it's a membership model. So it's looking to really give you the best deal humanly possible on a lot of goods.
A lot of these companies have tried to shift their exposure to China, but let's just work with China. Tariffs have come down, or are coming down, from 145% to 30%. Clearly a big difference. What's the difference between where they were at the start of the year and 30 for these retailers?
Yeah, as we look across the sector, EPS cuts in our models were 30% plus. Now it's around 10%, and it depends on the nature of the price increase you can get. It also depends on the nature of sharing this with the supplier. Those retailers that were most vulnerable were very discretionary, like Target, like Gap, like others in department stores. They'll see the most upside today on this rally, as they were the most impacted. That being said, our investment thesis continues to be bifurcated. When you own Walmart, you're owning needs plus wants. You're owning discretionary plus grocery. And that's a great strategy in terms of what we're thinking thematically, because you'll capture that discretionary and you'll still capture the grocery, the value orientation of the consumer.
I love the idea of companies adapting and adjusting, Tom. You used to talk about it all the time, and I think that we're seeing that increasingly. And there's this question of how much can companies negotiate with their suppliers, and how much do they have pricing power, and how much do they have other lines of business that can really bolster their margins, so that they can really compete on price. How much is Walmart setting the standard for competing on price, for investing in price, for essentially trying to get market share by not necessarily raising prices at all.
Yeah, it's the history of the company, the everyday low price strategy and passing to the consumer. At the same time, Walmart's been pushing into AI, pushing into marketplace models, pushing into digital advertising, where those are high revenue streams that they can balance against the everyday low price, a low margin grocery business. So it's a bit of the mixture. As you think about agility, AI, adaptive retail, and supply chains, speed is the name of the game. We focus on this at Columbia. The simple fact of retail is getting things faster between supply and demand. And they've done a better job than Target at lead times, for example, in the home category. So that's something all retail is focused on. Bottom line, Walmart has so much scale, so much negotiating power with suppliers. That's a key positive too.
How much consolidation are you expecting on the heels of this? I mean, it sort of accelerates a trend that already has been in place, which is that the big get bigger, the more luxury get more luxury, and they consolidate some of the demand. How much are you seeing sort of a winner-takes-all type of moment in retail?
We're definitely seeing that. I toured a lot of the facilities with Walmart, the supply chain facilities, and it's intense robotics. It's a lot of use of AI. So what's happening is these marketplace and scale players, such as Costco, Walmart, and Target, are getting bigger, and we have to really watch balancing that against small businesses, innovation. That being said, some categories like beauty have tons of great founder-led brands, but margins in this business can be thin. The exception is beauty and some luxury, given that the cost of goods sold is somewhat low relative to how much they charge.
How much leverage do you think this sector has over the administration? There was an important meeting, and Lisa referenced it earlier on this morning, between some of the biggest retailers in this country, meeting with the president and warning him several weeks ago about what could happen in the coming weeks. Do you think they've played a major role in what we're seeing this morning?
I think they have, because the nature of business and capitalism and how Walmart is so well regarded across managing through these tough times. And also thinking about the U.S. consumer, 90% of the U.S. within 10 miles of a Walmart. So people see egg prices, they see toy prices, they see electronics prices. And Walmart has pharmacies. So I grew up in Natchitoches, Louisiana, going to the Walmart pharmacy. It's a part of the thread of America. So I think it has been important. And Doug McMillon is a great ambassador in terms of understanding short and long term, as well as thinking more broadly about stakeholders and employees in the age of AI.
Managing this inventory story through the last few months must have been phenomenally difficult. Can you share with us what you were hearing from individual companies about how they have navigated the last few months?
So I was on the call with Hong Kong like most nights, and it's been pauses, it's been disruption, it's been high-speed shipping, it's been confusion. It's also been unclear. The price raises were still being determined. We're going to see some interesting stuff come Q4. Late August and October and September, we'll see some incomplete, interesting apparel collections, because basically a lot of retail has reduced orders and was trying to chase. And that may or may not be possible. It just depends.
So Torsten Slok of Apollo, who was on earlier this morning, put out a chart over the weekend that shows that there are lower inventory to sales ratios for retailers today than there were going back to 2019 before the pandemic. Just how close were we to shelves actually being empty?
Well, we'll see emptiness in August, and retailers have been working on this whole journey to get the supply chains a lot faster, but that puts them at risk with these rapid changes too. I think we'll see selective empty shelves, but the consumer is still fragile, and that consumer confidence has been a cautious point. And as people have paid more for food and still feel inflation now, they've been skipping trips on apparel, skipping trips on things they don't necessarily need, and also trying to avoid high ticket. So it's something we're watching, and the seesaw of consumer confidence is key.
You know, there was this image in my head of the ships that weren't coming from China, that were not necessarily on their way, and it takes a while for those ships to get here. You said that there still are shelves that are going to be empty. Are you still seeing the potential for some delay in between when those ships arrive, when the orders are placed for particular retailers?
Well, what's good is, as we get through earnings season, is spring, summer goods are in pretty good shape, and they've arrived. What's problematic is back to school. So there may be some missing classifications. Also, if retailers indeed did order about 20% less, we're starting off a little bit negative for back to school, but that was the right choice you or I would have made to protect margins in this unknown scenario. But right now, maybe we're going to get different phone calls where, hey, we want those shorts now. What can we do? They're going to be a little bit more expensive, but that's happening probably, this morning.
Everyone's hustling. Oliver, it's good to see you. Thank you, sir. Oliver Chen there of TD Cowen on the latest with the retailers. I understand we've got Mike McKee standing by who can talk about how disrupted the economic data will be over the next several weeks. We've got CPI tomorrow morning. We've got retail sales on Thursday. You'll hear from Chairman Powell as well before we get to the end of the week. I understand Mike McKee can join us right now. Mike, let's talk about how disrupted that economic data will be, not just through the next several weeks, but maybe even the next several months.
Well, it's going to be disruptive because we still have tariffs in place. We still have the 30% on China. And to the extent that interrupts what's going on in terms of commerce between the two countries, that will be something to watch. In terms of inflation, that will be something to watch. We've got other tariffs that are going to be coming on that the president has announced. And we've also got the 10% universal tariffs around the world. So prices are going to be a little bit higher. They may not be as high as they might have gone, but it's still going to be hard to know exactly the impacts on the overall economy. We can figure that companies will do a lot of ordering in this 90-day period to try to get ahead of whatever might happen at the end of it. But after that, what happens? And do companies still want to hold off on spending a lot of money on investment because they don't know where this is all going to end up? So a lot to watch in the data. Tomorrow, especially with CPI, isn't going to matter much to the Fed in the short run, but at least we'll get some clues as to where maybe some of the inflation aspects of this are going to start popping up.
Mike, stay close. We'll come back to you in just a moment. Need to talk about the Federal Reserve as well and what we might hear from Chairman Powell this coming Thursday. I imagine he's pretty happy that he didn't say much over the last month.
Well, this is exactly what they can say. Of course, we're in wait-and-see mode because we were waiting to see exactly for this. I will say that Neil Dutta of Renaissance Macro put this out saying he doesn't see why much has changed for the Fed, saying that there had already been weakness built in and some damage done. So the debate will continue, but there is a question here about how much they can kind of take a victory lap for wait and see.
Major rally in this equity market. We waited and we see a lot lower tariffs this morning. Equity futures up by 3.2% on the S&P 500. In the bond market, yields are higher across the curve, particularly at the front end of the curve. The two-year yield higher by 10 basis points, going into a week full of economic data. Tomorrow morning, we get US CPI. On Thursday, we get retail sales. But maybe for many of you, the most important economic data point of the week might come from a company and not the economic data. It might be Walmart results this coming Thursday. We'll hear from Chairman Powell too. We'll get Mike McKee's thoughts in just a moment, and we'll catch up with Seth Carpenter of Morgan Stanley and Earl Davis of BMO with CPI data just around the corner and their reaction to a big announcement over the weekend. Waking up this morning to much lower tariffs on both the US and China, a 90-day truce between the two biggest economies on the planet, and ending an effective trade embargo. From New York City this morning, good morning. This is Bloomberg. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bit of cheer of Academy this morning. Was it all just a bad dream? It was real. Equity futures on the S&P 500 positive by 3% off the back of a trade truce between the US and China. Big rally elsewhere on the NASDAQ. On the Russell, the Russell 2000 futures up by 4.6%. With some morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John, you can see it on that board there. Some real market leadership coming not just from small caps, but tech. Look at what some of these Mag 7 names are doing. Some real outperformance. Amazon and Tesla seem to be leading the pack, up at least 8.4% for the two of them. Apple also higher in the pre-market session, up 6.5%. Some also journal reporting that they're planning on raising iPhone prices, but trying not to seem like it's tied to tariffs. Elsewhere, to the downside, it is healthcare, a double whammy. For one, it is a safety sector, so why would you buy healthcare when all risk is rallying? But two, Trump planning on an executive order, putting this out on Truth Social over the weekend, saying that he wants to lower drug prices from somewhere between 30 and 80%, matching the lowest rate of the lowest country out there. So you can see across the board, Pfizer, Lilly, Gilead all dropping by around 3 or 2%. Finally, John, you mentioned before the break that we're going to get Walmart earnings this week. It is a solid day for the retailers and consumer-oriented companies, for both a recession risk being priced down, perhaps easing of supply chains, Nike being one of them, up 6.5%. Ryan Peterson of Flexport saying the next 90 days, we're going to see a shipping boom. These retailers may be trying to pull forward and get ahead of what changes might come after those 90 days, John.
It's going to be busy, that's for sure. Danny, thanks for this morning. Busy week for economic data. Earnings too. Walmart on Thursday alongside retail sales. And you'll hear from Chairman Powell as well. Mike McKee's back with us. Mike McKee, for the Fed speak, I imagine it stays pretty consistent. Does it change after the weekend?
Yeah. The Fed is going to be watching the data like everyone else and watching to see what the results of all this are. We don't know yet. I mean, this is sort of an interim step in terms of this long process of tariffs playing out. But we do have price week in effect this week with CPI tomorrow. PPI coming up on Thursday, along with retail sales, import prices on Friday. So by the end of the week, we'll have a pretty good idea of what PCE will be. Interesting thing here is probably that Thursday's retail sales report and Walmart report are going to be the big issues of the week, because the question is, did consumers continue spending? And we'll get some headlines, of course, from CPI. Wall Street focused on that. These are some of the areas to watch, because these are some of the areas where we might see prices rise because of the tariffs that had been in place and the threat of tariffs that had been in place. You can see what happened in March. The Fed put out a study on Friday, you may have missed this with all the other news going on, saying that they are looking at ways to track inflation brought on by tariffs, and they already see it in some data. So we'll see how this all works out over the next couple of days as we get all these price numbers.
And Mike, clearly it makes a difference that we come down from 145 to 30. But do you think the Federal Reserve is still focused on the ramp up, not the move down, the move from where we were at the start of the year to where we are now?
They can only deal with what we have, and so they will be looking for any inflation effects, and whether it's the 145 or the 30% or wherever we end up. It's going to be a question not just of how fast the numbers go up, but how far they go up, whether it's a one-time thing or not. But it does give them more breathing space not to do anything is kind of the conclusion coming out of this. I do want to mention Jay Powell on Thursday. If he wants to talk about it, he can. But this is a Fed Listens event to talk about the framework agreement, the review that they're doing. So I wouldn't expect much from him.
He's got the option to ignore it if he wants. Mike McKee, thank you, sir. The latest from Mike McKee on the Federal Reserve and the economic data. Seth Carpenter of Morgan Stanley joins us around the table. Seth, good morning to you, sir.
Hey, Jonathan.
Quick thought exercise. I'm okay. If the Federal Reserve knew what they knew this morning, would they have changed the statement in the way they did last Wednesday?
I don't think they would have. Look, where are we right now? We're going to get a CPI report tomorrow, and it's going to be pre-tariff for the most part, maybe a little bit in autos, but essentially that's also going to be pre-tariff. And they're going to want to look at that to see, are they learning anything on inflation? And so what they said at the last meeting was there's uncertainty. There's uncertainty on the inflation side. There's uncertainty on the growth side. Does the news that we've got in the past 24 hours change that? I'm not really convinced that it makes a massive difference because the announcement was that tariffs will come down from the peak, still be above where they were at the beginning of the year. And I think we have seen a few times in the past few weeks, times where one announcement gets made and then it's reversed 24 hours, 48 hours later. I'll believe this is real when I've seen it in place for a while and it actually starts to affect the trade flows.
Your assessment of the risk, though, for inflation, for growth, are they still tilted to the downside for growth and tilted to the upside for inflation? Is that how you see the risk?
Unquestionably. So we do still, no matter how you slice it, have higher tariffs this year than we had coming into the year. And so that's got to push up inflation. Now, in 2017, 2018, 2019, I said, much like what you've heard from Powell, the inflation side of things from tariffs likely to be temporary. Might even use the word transitory if it hadn't become taboo. That's still very likely to be the case. However, now versus then, we have lived through years of higher inflation, and it's not at all clear where businesses and households' minds are for how inflation dynamics get going. So I think there is still upside risk to inflation. The downside, businesses that plan, businesses that are going to undertake investment spending, businesses that are going to make hiring plans would like to have some certainty, and we have none of that. And again, just because there was a statement that there was a plan to make a plan to have a deal does not take away that uncertainty. So again, the risk to the downside and growth, I think, is real and present danger.
A number of guests have come on the show this morning and said that at the very least, it does make recession look more like a remote possibility rather than a 50-50 type of possibility. Do you agree with that?
So I think it probably has to lower the probability. Remote seems a little bit optimistic. Again, how much of an effect does the overall uncertainty affect business spending? I think I know pretty clearly what the direction is. I don't think I have any conviction I know exactly what the magnitude is. And so to be able to say it's going to slow things down a little bit, but not so much to tip us over, that's our baseline view. Don't get me wrong. I just don't know how you have conviction there to call it remote.
It sort of raises the point of the Fed's reaction function. It's something that's interesting when you look at Fed funds futures this morning. You're only seeing 2 rate cuts getting priced into the market from 4 last week. It highlights this idea that without some sort of rapid deterioration akin to a recession, you're not going to see that rapid response from the Fed that could be 125 basis points of rate cuts like Citi's Andrew Hollenhorst has called for. How much do you take signal versus noise from the market's reaction? I mean, would you agree with the current assessment?
I would not. In fact, we've been far, far, far out of alignment with the market pricing has been. We have said even before this announcement about the possible de-escalation on tariffs, we had said the market calling for 3 or maybe 4 rate cuts this year was overdone. We don't have any cuts in our forecast for this year. The market's coming towards us, which is always a comfortable place to be. But the Fed's got a really tricky challenge. Tariffs, even if it's at a lower level of tariffs, they will push up inflation, and that probably happens faster than any hit to growth that we're going to see in the hard data, which is where the Fed is really living. And so what does that mean? They have to watch things come in, and they can't take anything for granted.
We often cite you and Mike Gapen, because you are at zero cuts for 2025.
And because we're both tall and good looking.
Of course, that too. That's why I do it. Andrew Hollenhorst of Citi, another tall and good looking gentleman, is at 125 basis points of cuts for 2025. And we've said repeatedly, you can drive a truck through those estimates. They believe the labour market weakens in the coming months. What gives you the confidence that it won't?
I think a few things. One, the U.S. economy tends not to shift quite so dramatically. We do have a big slowdown in our forecast for the next several months. So I think that in that regard, it's likely to happen. But the first thing you need to see is businesses pull way back on the hiring, and then you're likely to see businesses start the firing process. And you need both of those to happen first before the Fed can go into a full-fledged cutting cycle. Very difficult to see they get there to get that amount of cutting this year.
Seth, it's good to see you, sir.
Thanks
for dropping by. Thank you. The tall and good-looking Seth Carpenter there of Morgan Stanley. Let's get over to Earl Davis of BMO, another tall and good-looking gentleman, just before people start getting jealous. Earl, welcome to the program. In the bond market, we're seeing yields reprice higher, 2-year, 10-year, 30-year. Earl, do you see it this as a good place to get back into the bond market, to buy at these levels across the curve?
Very close. I believe last time I was on the program, we said 425 to 450 was a buying level. We actually stopped at 450. That doesn't happen often, and then went back down to 410. So we were fortunate to take advantage of that and go underweight duration, which we are now. So our strategy now is to cover the underweight at 450, but we believe it could go up to 475. We see that as a strong buying level. So, and the reason why we see that as a strong buying level, the market only has the ability to focus on one thing at a time, and right now it's not growth. We think the growth focus or lack thereof will be the summer focus, but right now there's a bit of euphoria in the market.
As you know well, this morning off the back of this tariff announcement, a lot of people have come on the program and said we've removed some of the growth risk. Open question remains as to whether we've removed some of the inflation risk. Where do you stand on that?
Let's go back on the growth risk. I don't think we've removed some of the growth risk. I think the growth risk is definitely still there to the same extent. The magnitude of the growth risk has been reduced. So let's be clear there. Inflation's the same. You know, the numbers, like, we're still at 3%. 10-year bond yields are at 4.5 to 5. We're at 2.5 inflation. Real rates look real attractive. The only reason we're not buying now, and we think it could go to 475 over anything, is supply. There's three things that drive the market: growth, inflation, supply. We believe supply is what will drive yields to new highs, but that's not going to be a story until the fourth quarter of this year. So that's why we don't mind buying this back up. We think the market's getting ahead of itself, but justifiably so.
I'm glad you went there, Earl. There's this question about the budget discussions, which are ongoing, and we got the reconciliation budget on Friday. There's a question about inflation, and then there's this question of who's going to buy all of this supply and whether that has structurally changed since April 2nd. What's your view on that? How much have you seen a real shift, pullback from investors in your Canada that may not necessarily want to buy U.S. dollar-denominated assets?
Yeah, I don't think the economic buyers have changed. They just buy at a different level. And what is that level? We think ultimately U.S. 10-year yields, if you get to 5%, is very, very attractive. And how do we justify that? We justify that quantitatively. What we look at is if you buy at 5% and get how much interest rate hikes are you protected for? You're basically protected for 100 basis points of hikes from 5%. So we think that's very attractive. We think you'll get real money buying at that point in time. And we believe also by that point in time, growth will be a concern as well, too.
This raises this question. You said that you're still tactically overweight U.S. assets, even with some of your concerns about yields going higher and, frankly, growth concerns, although that might actually help the case. Why is it that you're not leaning into what we're seeing elsewhere, which is buy everywhere else? I mean, does it make a difference what we've seen overnight, or is this just something structurally that you think the U.S. is going to be a higher income space than the rest of the world for a prolonged period of time?
Yeah, I smile because I've been in the market for 30 years, and it always reminds me of the Keystone Cops. The market always has a tendency to run one way and then try to turn and fall over itself. It's while they're falling over themselves that where we look at value and try to pick up value. So now let me answer your question more directly. We like U.S. assets still and risk assets in general for two reasons. One is there's global easing going on. Even though the U.S. is not easing, there's global easing going on. So people are trying to offset the tariffs globally, which has an impact on the U.S. as well. And there's significant amount of money on the sidelines that is not going to be making as much yield as you could be in risk assets. And we believe that will start piling into risk assets as well. Having said that, similar to the way we're looking at duration and go against the market, we are coming close to levels where we'll start reducing our risk asset exposure, still being overweight, but reducing because we do think there will be growth concerns around July-ish, August, as those sort of tariff numbers, economic numbers start coming in.
Just, Earl, build on that, please. I mean, which assets are you thinking of in particular? Is it in the credit space, the riskier credit, where you think things are getting a bit lofty, given what you see going forward?
Yeah, actually, in April, and don't get me wrong, there were some gray hairs that happened there. We allocated to high yield. We bought select names in high yield. And the reason why was we went right up the capital, or very safe high yield, call it double B is what we were looking at, because we believe there's protection there. You're being rewarded 9-10% all-in yield, very attractive now, great risk reward. And there was no signs of a recession. The economic numbers were still good. Yes, all the surveys were bad, but the economic underlying numbers were still good. We see it in employment, we see it in growth now. There'll be a slowdown, but there's so much cash on the sideline. The deregulation, people forgot about that. And one of the Trump era, or President Trump's era things, is deregulation, very stimulative. So a lot of reasons to be selectively choosing credit. We don't foresee a recession in 2025. We haven't. We've always been very consistent in that. 2026, we'll analyze at the end of this year. But right now, things look good. And you know what? Up to today, you were being rewarded for going more and more into risk assets.
Earl, as you say, up until today, what do you do after today?
It's exactly as I said. There's no catalyst for us to go higher, for risk assets to sell off right now. No catalyst. We believe that catalyst will be a July-August catalyst. But the risk reward. So we are reducing our exposure very slightly on any sort of exuberance. We reduce. And I'll tell you the reason why. I don't know if you've been into the doctor, you get hit on the knee with the rubber hammer and the leg goes up. Our question is, how long does it stay up for? Is it just a reflex? Our feeling now, it's going to come back down, which is why we're reducing risk exposure to risk assets, but staying overweight.
Interesting. Earl, thank you, sir. Appreciate the analogy. Earl Davis there of BMO Global Asset Management. Earl, thank you. Thinking some of the growth risks might return later on this summer. At the moment, the 10-year yield is higher by 7 basis points, 2 years up by 10. Earl thinks we're getting closer and closer to that buy zone in the bond market. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump heads to the Middle East this week in the first state visit of his second term. Trump is set to land in Saudi Arabia tomorrow, then visit Qatar and the United Arab Emirates before the end of the week. He's looking to encourage the wealthy Gulf nations to invest in the U.S. Meanwhile, Japanese Prime Minister Shigeru Ishiba says the country will not accept a trade agreement with the U.S. without an accord on autos. Meanwhile, Japan's top trade negotiator adding the country will continue to look for a reprieve from all U.S. tariff measures and hopes to reach an agreement in June. And in sports, the Indiana Pacers are 1 win away from the Eastern Conference Finals after blowing out Cleveland in Game 4. Elsewhere, the Thunder evened up their series against Denver. And tonight, the Knicks look to pull ahead against Boston after losing Game 3 at home. Meanwhile, the Timberwolves take on the Warriors in San Francisco, up 2-1. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next on the program, we'll set you up for the week ahead, and we'll head down to Washington, D.C. to get you an update from Bloomberg's Tyler Kendall. From New York, this is Bloomberg.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Live from New York City this morning. Good morning to you all as we count you down to the opening bell. Equity futures here up nicely. Positive by 3% on the S&P. On the NASDAQ up by 3.9. On the Russell up by 4.3. Your trading diary for the week ahead. A sneak peek. It looks like this. At 9:30 Eastern Time, President Trump holding a news conference, signing an executive order to lower drug prices. Tomorrow, we'll get some CPI data, plus Trump heading to Riyadh for the first stop of his Middle East trip. On Thursday, PPI, retail sales, and another round of jobless claims, plus remarks from the Fed Chair Jay Powell, plus Walmart earnings. Thursday's a busy one. Busy morning already. We caught up with the Treasury Secretary, Scott Bessent. He recapped the trade talks with China over the weekend.
This is a pause down to 10%. The April 2nd level for China is 34%. So we will be working to see where their final reciprocal number ends up. I'm not saying that they're going to go up, but it would be implausible that they would go below 10.
From the White House, joining us now is Bloomberg's Tyler Kendall. Tyler, welcome back to the program. Have we got an understanding now of what the next 90 days is going to look like?
Yeah, hey, John. Well, the Treasury Secretary sort of outlined some of the threads that we can be watching for. He told you that the Phase 1 trade deal is going to be a template for the negotiations with China going forward, so we can watch how U.S. ag imports start to factor into the conversation and whether or not the White House really starts to talk about those enforcement mechanisms that are going to be needed in order to hold China accountable to any future purchase agreements. The second part, of course, though, is that he also emphasized to you and Lisa the importance of cracking down on fentanyl, and when you pressed him on exactly what he wants to see from China, he ultimately said that they would like Beijing to really start to crack down on the suppliers when it comes to the ingredients and the chemicals that go into fentanyl shipments, saying that the Treasury is closely tracking how those shipments are making their ways overseas. Now, ultimately, of course, it was pretty remarkable to hear him say that that 10% levy is likely not going to fall lower, that would be implausible. But you probably noticed that he did say that that 10% levy is also what's in place for our other trading partners, and our reporting indicates that going into these negotiations this weekend, China wanted what was described as non-discriminatory treatment. They wanted to be treated like these other trading partners. So perhaps, John, this is part of sort of that softening of rhetoric that we're seeing as this major de-escalation begins.
Tyler, it raises questions about what will happen with their other trading partners. We've had a deal of sorts with the UK, an agreement of sorts with China, and the question we keep returning to is, where are the Europeans? I've heard plenty of headlines on Japan, India, Korea. Where are we on a deal with the Europeans?
Well, at this point, it appears that very little progress has been made when it comes to the EU, and there's a few different mitigating factors here. Of course, they are negotiating as a bloc instead of individual member states, which really does raise some concerns when it comes to how this administration wants to see non-tariff barriers addressed, such as the VAT or digital services taxes. The other part of this is that the EU also factors into another priority of this White House, perhaps more than other trading partners, and that's when it comes to national security and defense spending. We can't forget that NATO spending and boosting defense spending has also made its way into these trade negotiations as we start to see the rhetoric heighten when it comes to a potential Ukraine-Russia deal. That could also potentially come back into the fold here.
Tana Kendall with the latest from the White House on a trade front following a 90-day truce between the United States and China, unlocking a major rally in this equity market. Going into the opening bell, Lisa, in about 37 minutes' time. We're looking ahead to data, earnings from Walmart, and you'll hear from Chairman Powell later this week.
Yeah, which is going to be the most important. I'm still thinking about what Earl Davis said about that rubber hammer on your knee, and when your knee goes up, your leg goes up, and it's sort of, how long is it going to stay there? Is this just sort of a reflexive response, or
what was
is this
the hammer, the
something
tariffs?
That's Yeah.
Is that what he's getting at?
I think that the hammer is the headlines that we keep getting.
The headlines?
The headlines.
On the tariffs?
On the tariffs, and they cause the leg to move. And then the question is, do they just come back down? Is this going to be another whipsaw of the whack-a-mole headline hammer that we keep seeing? So here's the question going forward. What sticks? And I think that you've done a great job highlighting how it is going to be ultimately the question about how inflationary the tariffs that are in place right now are going to be and how you feature that into the conversation. Does Fed Chair Jay Powell reflect that in his conversation, or did he say, did you guys not hear me say wait and see? Because I said it about 25 times, I'll say it again right here.
Chairman Powell set himself up for a pass this coming Thursday because Chairman Powell is already going to do an address on the framework update for the Federal Reserve. So if he doesn't want to talk about this, he's got the option not to talk about it. What we've got to figure out is whether this economic data in the coming weeks is useful or not, and whether it's useful for what.
This is a real tricky thing, considering the fact that a lot of people are saying that it's incredibly messy. Think about the bring forward types of purchases with Lori Calvasina buying an iPad for her toddlers, although they said that there wasn't any bring forward there. There is this question about how quickly you will see the inflationary pressure. Michael McKee talking about how a Fed's indicator stripping out tariffs at the same time that you're seeing increases in prices in, say, toys.
It's going to be a messy few weeks and months potentially for the economic data, maybe a messy year. Coming up tomorrow morning, Peter Cheer of Academy Securities, the former Biden economic advisor Mike Powell will speak to Emily Rowland of John Hancock and David Kelly of JP Morgan Asset Management as we count you down to the opening bell with equities very close to session highs. The S&P 500 up by 3%. Live from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Italian Open update for Bloomberg TV and radio from Tennis Channel. World number one Arina Sabalenka punched her ticket into the round of 16 with a comeback win over former major champ Sofia Kenin. After taking the titles in Miami and Madrid, the 27-year-old has now won 21 out of her last 23 matches. And don't forget, you can watch all the action live daily on Tennis Channel.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
In case you missed it, on the China Show,
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
Don't miss the China Show live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Get ready for a rally. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a major de-escalation. The U.S. and China will slash tariffs for 90 days in a move to cool trade tensions. Buy America sweeps across global markets, but Morgan Stanley warns U.S. stocks are not in the clear yet. And this hour, President Trump says he'll sign an executive order that aims to slash drug prices by up to 80% here in these United States of America, Katie.
And on that note, let's take a look at some of the individual pharma stocks moving on Trump's plan. Eli Lilly, Pfizer, Merck, and Bristol Myers Squibb all lower this morning. You can see Eli Lilly taking the biggest hit right now. A White House official just said that weight loss drugs will be the focus of these price actions.
Make America skinny again. But it's the Magnificent Seven that are leading the charge on trade optimism, with NASDAQ 100 futures set to re-enter a bull market. You can see big gains on Tesla, Amazon, Apple, and Meta platforms. Katie?
Investors embracing risk in a big way as the U.S. and China make progress on trade talks. That news spurring a dramatic ratcheting down of tensions between the two nations. Treasury Secretary Scott Bessent spoke on Bloomberg Television earlier this morning.
It's obviously a floor that they are now with everyone else who did not retaliate. So the levels have come down to the pause level. And what I would say is 34, which is their assigned April 2nd level, would be a ceiling.
Joining us from the White House now is Bloomberg's Tyler Kendall. And Tyler, the stated goal heading into this weekend was a de-escalation, bring down the temperature a little bit. And looks like we got that and then some.
Yeah, hey, Katie, a major de-escalation when it comes to bringing down those tariffs to give some time for both of these sides to ultimately work out a more permanent solution, because once Wednesday rolls around, that 90-day pause goes into effect, and then the countdown's really on. And the Treasury Secretary Scott Bessent was asked, what will it take to keep tariffs low after that 90-day pause? And he said that ultimately it's going to be good dialogue and good faith, but as you heard him there, those tariffs aren't going to fall below 10%. He called that implausible. Now, moving forward, we do know that there's some differences that are on the table that they want to address. The Treasury Secretary told Bloomberg Television he felt that some progress could be made when it comes to fentanyl. We have to keep in mind that 30% tariff, 20% of it is that original tariff enacted over fentanyl concerns. Then we're also going to be watching how purchase agreements phase into any finalized deal. Bessent said that we could ultimately see the phase 1 trade deal sort of serve as that template. So we're going to be watching closely here how agricultural imports into China start to make their way into this conversation. Ultimately, at the end of the day, the USTR Jamison Greer suggested that the differences between the U.S. and China might not have been as large as they appeared, but we do have to keep in mind, we know that there are still some big differences here on the table. And Katie, in a new statement this morning, China's Commerce Ministry even went as far to say that this is a good first step, but that ultimately they hope that the U.S. rectifies the mistake that is unilateral tariffs.
Tyler, you are at the White House, and the president there, before he leaves for the Middle East, is going to sign an executive order on pharmaceutical prices. What do we expect?
Right, so in a post on Truth Social, he announced this, saying that it is expected to bring down those drug prices. And this would basically mandate that the U.S. pays the same price for drugs at the lowest rate that any other country is paying for them. He said that this amounts to most favored nation status. Now, we know, of course, that the U.S. is one of the most expensive drug markets in the world because oftentimes single-payer healthcare systems can negotiate the drugs on a larger scale, and the U.S. is tending to pay those higher prices. Now, at the end of the day, we're going to have to see exactly which categories of drugs this applies to. It appears that it's going to apply to weight loss drugs, and how this factors in also to government benefit programs like Medicare and Medicaid, which make up about 40% of drug makers' revenue.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there, standing by at the White House. We will bring you the president and that executive order signing as soon as it comes across. Now, Mag 7 stocks have surged on the back of trade news. Apple reportedly considering raising prices for this year's iPhone lineup, but trying to avoid blaming any increase on tariffs. That, according to the Wall Street Journal. Joining us now for more is co-host of Bloomberg Technology, Carolyn Hyde. And so they want to raise maybe the price on the base iPhone, right? Because typically what they do is they offer you a Pro or a Max or something special and upgraded, and that's how they get more money. But they haven't raised prices on the base iPhone since 2017.
Yeah, for years. They wanted to remain relatively stagnant in terms of that price point, but instead you're paying for your memory, or you're paying for the fancy bells and whistles. Now, it's worth reporting that our own Mark Gurman has been reporting on this for months, that yes, we might have to see some nuances coming from Apple's pricing strategy. A lot of that has to do with China. Now, remember, they're now exposed to 20% tariffs on Chinese goods coming from China into the United States, where, of course, still an awful lot of their iPhones are made, even though they're shifting to overall India. They're excluded because of a smartphone perspective from that 10% reciprocal tariff, but still that 20% that was put on to tackle fentanyl is still in place. But remember, they've got a load of court orders that are not going in their favor. We've got the worries about revenues coming from the App Store. Bloomberg Intelligence saying that could be $1 billion hit to revenues if, because of Epic Games, they now have to allow people to purchase some of their items off App Store in other websites. And then you've got the worries about whether that $20 billion is going to be coming from Google in the long term as well. All of this means that likely to protect margins, you might start to see a ratcheting up in price points, exactly as Mark Gurman's been telling us about.
So great context there. You do have Apple shares absolutely surging pre-market. Yeah. That's really about this overall enthusiasm we're seeing coming out of the U.S. and China in Switzerland this weekend. There's still a lot of question marks when it comes to companies such as NVIDIA, for example, which is also at 4.5%, because it's unclear whether that strategic decoupling that Scott Bessent was talking about on Bloomberg Television a little bit earlier, it seems like that's going to apply to semiconductors.
There is still such a weight of uncertainty hanging over all of these companies. Look, the enthusiasm seems to be ignoring that at the moment, but you've had a takeaway of the AI diffusion rule concerns, but now each and every country is going to be basically making part of the trade and tariff negotiations as to whether or not we're going to have individual relationships with individual countries as to how they access NVIDIA chips going forward, how much they can still sell into China, which really Jensen Huang thinks you should be allowed to sell into China in the longer term. So there's weight on there, but semiconductors, of course, also managing to be avoiding that 10% reciprocal tariff from China, and they only get the 20%. Amazon is the one to watch as well. E-commerce plays doing really well. Look, they get so many of their goods from a first-party perspective and a third-party perspective coming from China, so huge relief for Amazon if they're able to dodge some of these tariffs. 145% was just eye-watering, so you come down to 30%, few. But still, all of this is going to be maybe a bounce back into bull market. You said it, look, the NASDAQ 100 is going to be more than 20% off of its lows. So too are all of these stocks like Apple and Amazon.
Yeah, that benchmark currently up 3.8% pre-market. We'll see how that finishes up today. That is Bloomberg Technology co-host Caroline Hyde. Also happening this morning, as we've been talking about, President Trump says he will sign an executive order to cut U.S. prescription drug costs. The news sending pharma stocks sharply lower, with most of the market right now rallying. Let's break it down with Bloomberg's Jerry Smith. So there's a lot we won't know until we hear from the president himself, but it seems like the plan here is to peg the U.S. drug costs to what the international prices are.
That's right. I mean, President Trump has felt like, U.S. consumers are getting ripped off because people in Europe are paying lower prices. So he plans to have this executive order that links the price that the government pays for drugs to what they're paying overseas. We're just seeing headlines right now on the Bloomberg terminal saying that weight loss drugs are going to be a focus of this. That's obviously a concern for investors of Eli Lilly and Novo, and we're seeing that in Lilly shares this morning. Also it's going to be Medicare is going to be a focus of these negotiations. So I think a lot of investors are trying to figure out which pharmaceutical companies have the greatest exposure to Medicare.
I wonder, so most favored nation status, how does that translate into this executive order? And do we need to lower prices to the least, the lowest price nation, or could we just go with Europe as a baseline?
Yeah, I think there's a lot of unanswered questions that we're waiting for the president to give us more clarity on right now. But that is the idea, is that other countries, particularly in Europe, pay a lot less for drugs than America and the U.S. government, and so he's trying to lower that. And investors are really concerned. I mean, this is an industry that has really gone out of its way to try to gain favor with President Trump. Executives making trips down to Mar-a-Lago, and yet they're getting hit with announcements like this that clearly are not what they wanted.
All right, Bloomberg healthcare reporter Jerry Smith, appreciate your time and your reporting. Of course, we are awaiting that executive order signing from President Trump, expected sometime this hour. We'll bring you that news as soon as we have it. A quick check on futures here. You can see that we are off to a rip-roaring start to this week. In the pre-market, the S&P 500 up 2.9%. It's big tech that really is out in front right now, with the NASDAQ 100 up 3.8%. And the small caps in charge this morning. The Russell 2000 up 4% as this risk-on rally just really gained steam across asset classes. We're going to break that down with Lori Calvasina. She is RBC's head of U.S. equity strategist. We're going to discuss the next catalyst for U.S. stocks. This is Open Interest.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Let's get now to high interest. Look at what's making headlines around the world. Investors